I doesn't really work it. Okay, so ladies and some men in the back, welcome to the third edition of the We Are in Macroeconomics and Finance Conference. I just want to give the floor to Aino, our Vice Governor. It's a pleasure to have you here, so the floor is yours.
Thank you so much, Daria. I'm very pleased to welcome you all. It's quite an honor to have the welcome address here at the third edition of this conference. It's a joint venture by the Riksbank, the CEPR, the ECB, and the BIS. So in 1992, Mattel's famous doll Barbie was complaining, math class is tough. Fast forward 30 years, the very same doll is having an existential crisis in her latest movie. And here I am speaking to a room full of female PhDs in economics and finance and looking forward to 2 days of discussions on monetary policy, financial stability, and climate change. Topics that are really relevant to us as policymakers. So how did we get here? Gender inequality, as measured by multiple composite indices, has been substantially decreasing this last century. And I'm lucky enough to be born in a country with the highest gender equality index in the world. So how did I get here? Well, when I was young, I played with my Barbie dolls. I wore pastel clothes. I loved dancing and ballet. However, my favorite subject in school was maths. And I dreamed of becoming a diplomat, a veterinarian, a journalist, or an astrophysicist. Now I'm here. I'm deputy governor of the Riksbank, and I have 2 boys and 1 daughter. Gender equality has made it possible for me to be here today, and it's also the basis for my children to have equal opportunities in the future. I've been given the chance to develop and grow by a number of wonderful men and women to whom I'm really grateful. But my conclusion is that still a lot remains to be done in terms of both equality and diversity, also in the future. This is something we need to talk about, do research on, in order to make sure that development that we have seen will also continue in the future. It's a chance for me also to give some personal advice, maybe to some younger women in this audience. I would say, definitely say yes more often when someone offers you an opportunity. I quite early on decided that if somebody is willing to spend money on me to give me a job, then I'm most likely worth it. But also move on. If you feel that things are not going your way or the environment is not going to make you grow, don't stay and complain. It won't make you happy and it probably won't change things. Also make sure that you get help and take help so that you don't get stuck with all the mundane tasks and have no energy left to look at all those energizing and interesting things that we can analyze for the future. I would also say, don't believe those who say that you need to develop sharp elbows and push your way forward. The fact is, the higher you get up in an organization, the more dependent you are on the people below you and their loyalty. So instead, when you succeed, make sure to start lifting people up and make them grow, and they will also help you in the future. But this is no Barbie land, and the statistic on gender gaps in economics do not look good, like I said. There's a substantial underrepresentation of women in our field. It starts at school and it worsens at the top. In Europe, 2 in 5 students enrolled in economics programs are female, but the gender gap worsens as we progress in our professional career. In economics departments, women account for 38% of the junior faculty, but only 24% of professors. In finance and macroeconomics, these figures are even gloomier. Outside academia, the picture is no rosier. According to the latest Women in Economics Index, the worldwide share of women economists holding chief economist positions in large companies is 24%. In the banking sector, it's 15.8%, and it drops to 9.5% in the insurance sector. In the public sector, the share of women central bank governors is 10.6%. Why should we at all care about female underrepresentation in economics? Well, economists are employed in a wide range of occupations. They inform policymakers and they advise on the decisions that will make and affect the life of all of us. According to research, men and women have different views on economics policies and outcomes. Some studies show that women worry more about inflation, inequality, and the environment. At the same time, inflation, inequality, and climate change may affect women more. But ultimately, of course, research shows that diversity in groups improves decision-making, and female underrepresentation in economics is not only a problem for women, but it's a problem for all. And we do have some problems to solve. Economics is a social science, and the past years have really challenged us as policymakers. We went from a period of very low interest rates to the shock of the global pandemic and a war here in Europe that brought on not only human suffering, but of course changed our energy market dramatically. Firms and consumers changed their behaviors and preferences. This challenged our models and forced us to look for new data and new places to see how we could predict the future. Of course, on this we add geopolitical tensions, climate change, and an aging population. And of course, we have technological advancements such as AI that will change the way we work in the future. We need all the good brains that we can get to understand the future. So one of the often cited reasons behind limited diversity in our field is the lack of role models and the scarcity of networking and mentoring opportunities for women. And therefore, I'm particularly grateful for the CEPR and the CEPR Vice President, Helen Ray, who brought us here today. I would also like to thank the other conference organizers, Fiorella De Fiore from the Bank of International Settlements and CEPR, Daria Finocchiaro from Sveriges Riksbank, Katarina Mendicino from the European Central Bank, as well as the program committee. I'm looking forward for these 2 days to strengthen our network and exchange ideas on topics that are of high priority for us central bankers. We will hear about how firm-level data can inform us about inflation and the conduct of monetary policy, the role of financial market and carbon taxes in the transition to the green economy, how financial markets can increase interconnectedness among open economies, and finally, we'll discuss how different economic policies can improve the allocation of credit to firms. It will be a pleasure to meet 4 promising PhD students who will present their work during the poster session after lunch. And my colleague at the Riksbank, Anna Breman, will talk about the potential effects of climate change on the macroeconomy and financial stability. Finally, you will also notice that you will finish 1 hour ahead of what was initially planned the last day, so that will give you some free time. And I hope that during these breaks, we can also discuss our experience as economists. It what sometimes can seem as a mojo, dojo, casa house, for those of you who saw the movie. Okay, thank you very much and welcome all women and men for this conference. Thank you.
Thank you. So now we can start with the first session.
So good morning, everyone. Thank you very much for being here. I'm really honored to be in this conference. So I'm Beatriz, and I'm going to present a joint work with Galo Nuño from Banco de España, Dominic Thaler from the ECB, and Silvia Ritze from the IMF. I'm going to present firm heterogeneity, capital misallocation, and optimal monetary policy. So in the recent year, we've seen like a growing literature trying to answer how firm heterogeneity might affect the transmission of monetary policy. So how the distance to default might affect the transmission of optimal monetary policy, like Otonello Winberry, how the liquidity and leverage can affect this transmission, like Jenas, the age of the firm, like in Kloin, Younger et al., they're looking at the differences in maturity of their debt and how this might affect this transmission. And this is something that is relevant. One particular channel that is of interest is how this heterogeneity in productivity and changes in the allocation of capital might matter for the transmission of monetary policy. And Victoria here has worked on that, Rice, Gopinath et al. And this is especially relevant in times of unprecedented hikes in interest rates. So the question of this paper is which are the implications of firm heterogeneity and financial frictions when capital misallocation matters for the optimal conduct of monetary policy? And this is the question we're going to ask in this paper. So what do? We're going to build a tractable model with heterogeneous firms, financial frictions, and nominal rigidities. And we're going to show that in general equilibrium, the joint dynamics of real and natural rates will matter for misallocation. So not only how real rates are changing, but also how natural rates change when we're facing this shock. So for instance, we're going to see that when we have a demand shock that lowers both the natural rates and the real rates, we're going to have a fall in TFP. However, when we have a monetary policy shock, with this shock, the natural rate stays constant, but the real rates are decreasing. We're going to have that TFP increases, okay? And you might say, okay, fine, this is your model, but do we see this in real life, in the data? We're going to go to Spanish firm level microdata, and we are going to show that this is indeed the case. So that expansionary monetary policy is going to increase the investment of high MRPK firms relatively more, hence shifting the capital allocation towards these high productivity firms, and this is going to increase endogenous TFP. Then now, so up to now, we're talking about the mechanism and how the model works. Now we're jumping to optimal monetary policy, which is the core of the paper. So we're going to propose a new algorithm to solve non-linearly for these Ramsey optimal policies with heterogeneous agents in continuous time. Alais has worked also like in this optimal monetary policy literature. I'm for sure not going to have time to talk about this today, but if anyone's interested, we can talk later. And next to our findings, what do we find? Well, we find that this the existence of capital misallocation creates a time-inconsistent motive for the planner to temporarily expand the economy. So if the planner wakes up today and he can exploit this initial condition, she's going to expand the economy to benefit from this transitory increase in endogenous TFP. However, when we are looking at the timeless response, so when the planner behaves as if the promises were made from far in the past, so the planner cannot exploit this initial condition, then we're going to find that the same result as in the representative agent New-Keynesian model holds, which is a divine coincidence. So by setting inflation to zero, we can close the output gap, and this is what is optimal. However, we're going to show that the difference in the dynamics of the rates are going to make that if we are hitting the zero lower bound, it is optimal to stay low for even longer when we have this heterogeneity in place. So let me jump right into the model. So this is the model in a nutshell, in a figure. So we don't have much time, so I'm going to be talking mostly about the entrepreneurs and how they work. The blue boxes are the standard standard parts of the new Keynesian model, and I'm very likely not have time to go through them, but I'm going to explain them more or less how everything works here. So the key difference with the standard representative age and new Keynesian model are these entrepreneurs. These entrepreneurs are heterogeneous in productivity, which is this set here, and the capital these entrepreneurs own, which is net worth, this A. So they can choose to be operating or to be not operating, and when they're operating, they're facing financial constraints. This productivity is following an Ornstein-Uhlenbeck diffusion process, which is the continuous time counterpart of an AR1. So it just tells us that the shocks are persistent. Then these entrepreneurs are going to produce using labor and capital and a constant return to scale technology. And they're going to be renting capital and renting labor from the household. The entrepreneurs that choose not to be operating, they're not going to be operating their productivity. They're just waiting to receive a good shock. And they are renting out the capital they own to these operating units. Then we have, the entrepreneurs can borrow. That's why they can rent this extra capital, these guys here. But they can only borrow capital subject to a borrowing constraint. So the capital they can use for production needs to be lower or equal than gamma times A, when gamma is greater than 1. So they can borrow this extra capital. Then the rest of the ingredients are relatively standard. So we have the household that rents labor and capital, the aggregate capital producer that is subject to capital adjustment cost. Then these entrepreneurs are producing the input good. They are selling then the input good to these retailers. And these retailers are the ones that are facing monopolistic competition. They are facing price stickiness. And they are selling these differentiated retail goods to the final good producer that then is the one that is aggregating everything to the final good. And we have, of course, then the central bank. Of course, if anyone has any question, please stop me. I didn't say that, but entrepreneurs are maximizing profits statically, meaning, so these are the profits of the entrepreneur. So this F here is the constant return to scale production function. MT is the relative price of the input good. And then they're paying wages and they're paying the rental rate of capital on the capital they're using, subject to, again, the borrowing constraint. So they're going to be maximizing these profits, what I say statically, because then like the dynamic problem they have is the dividend versus saving problem. So they can decide whether to keep, so this is, they can decide whether to distribute dividends here or just increase the net worth they own, so the capital they own. This is what they're choosing. Let me first explain you the problem here. So this is the value function of the entrepreneur. So what they're doing is simply discounting the future stream of dividends plus the liquidation value, because they're going to retire at an exogenous rate eta. So they receive the shock and they're going to retire. When they retire, they just distribute all the capital they own to the household. So when this shock hits, they just liquidate the firm and then they're going to be replaced. We're going to see this in the next slide by a new firm. And so they can decide to distribute dividends or to accumulate capital. And the resources they have is the return on the capital they own, which is this part here, because this is the capital they own. Remember this A. And if they're operating, they're going to get profits. If they're not operating, this is just going to be 0. So this is going to depend. So we're going to see that there is this threshold, which is going to be this set star that I'm going to explain in the next slide. But if I am operating, this is I'm going to be my profits. Why do I show you this this formula? You might say, okay, I don't know what this is. This var phi t is a function, as we see here, of wages and relative prices. And what I want you to notice is that this slope here is what is going to tell me how much excess profits I'm making from the marginal firm, the one that's in the limit between operating and not operating, which is going to be this threshold that we're going to see in the next slide. So this slope here is going to be important for what I'm going to explain later on. That's why I'm writing it here. And the MRPK, which is going to be key, the key heterogeneity that we're going to be exploiting in this model, is simply a function of productivity and these prices, these exposed prices, with again this var phi t is this function of wages and relative prices. So as I promised, so this is the solution of this static problem, the solution of this problem here up. And since we have constant time to scale technology, it is optimal for firms to, if my productivity is below this threshold, my optimal size is 0. So my optimal size will be not to operate and just be renting out all my capital to the other entrepreneurs. So we say that this entrepreneur is unconstrained because this entrepreneur can reach her optimal size, which is 0. Then if productivity is over the threshold, then they are going to be able to operate at maximum capacity. So capital is going to be equal to gamma times A, and we're going to say that this entrepreneur is constrained. This entrepreneur would want to operate at a larger capacity, but she cannot because of the borrowing constraint. And again, I'm writing here the formula of this set star. I don't want you to memorize it. I just wanted to see how it also depends on these prices, on this var phi, on these wages and relative prices, and on the rental rate of capital. Because we're going to see that then the shocks are going to be changing these relative prices all over, and this is what is going to bring us all the dynamics that we're going to see in the when we're looking at the shocks. This is an equilibrium outcome. Entrepreneurs are optimally never going to distribute dividends until liquidation. And intuition is the following. So I don't know if I told you so. The entrepreneurs are part of the household. So they are small parts of the household. They return to the household. So they are discounting the dividends with the stochastic discount factor of the household. So the intuition that they are never going to distribute dividends is easy. The return of funds inside the firm is always at least the real rate. If I'm not operating, I get the real rate. If I'm operating, I get slightly more. And the liquidation value of the firm is all the net worth. So when I need to exit, I get this shock, then I'm going to distribute all my capital. I do not lose anything. Hence, it is always worthwhile to keep all the funds inside the firm. Regarding the new entrepreneurs, we're going to have new entrepreneurs replacing the exiting ones. They're going to inherit the same productivity, but they're going to start with a lower amount of net worth. So the capital they're going to start with is going to be lower. So this is the distribution of firms. So in continuous time, the joint distribution of firms is given by the Kolmogorov forward equation, which is what I'm showing you here. Again, I do not want to enter into details due to a lack of time. I just want you to notice how the evolution of this distribution over time depends on the idiosyncratic productivity shocks, so the shocks that the firms are receiving. It depends on this S, which are the entrepreneur savings. This S there is simply this S that I wrote here, okay, the operating profits plus the return on capital. So how this capital of firms is changing, because remember that the dividends are optimally 0. So everything that the firm owns is reinvesting in the capital of the firm. And the rate at which entrepreneurs retire, and the size with which new entrepreneurs are entering. Due to the constant time to scale assumption, we can simplify slightly this. We can look at the distribution of net worth share. So we can only need the amount of capital held by firms with productivity set to characterize the equilibrium. So from now on, we're going to be working with this as a distribution, this net worth shares. The model then, once we start aggregating, it is isomorphic to a standard representative agent Nuke-Nishan model, with the sole difference that we're going to have endogenous TFP. And this endogenous TFP is simply going to be the expected value of productivity conditional on firms that are operating. So graphically, we will have something like this. So this is the net worth share distribution, the one that we were just looking at, and productivity is going to be the integral over this area. So the expected value of firms that are operating. So any shock that is changing either savings of these entrepreneurs that are going to change the shape of this distribution, because it's going to change how this network distribution evolves, or that changes this threshold, whether this threshold is moving to the left or to the right, is going to change endogenous productivity and hence this misallocation. But these are not two different channels. These two channels are interlinked by these prices because everything boils down to these prices that we've been looking at before. No, this is capital weight. So this is the one. This is the net worth share. So it is like the amount of capital held by firms with productivity. Sorry, with productivity set. Yeah, so it's capital weighted. So these are all the blocks that I told you I'm not going to cover due to a lack of time. Thanks. So then let's go to equilibrium prices and misallocation to understand all the how everything works. So I'm going to spend a little bit more time here because then the optimal solution is going to be way easier to understand, okay? Well, this is the calibration. I don't have much time to go through it. I'm just going to tell you that we're calibrating this to the Spanish economy. Many parameters here are relatively standard. We're just calibrating the persistence and the volatility of the shocks to match the persistence and the volatility of the MRPK at the firm level data. And we're matching this death rate, borrowing constraint parameter to the Spanish economy, okay? And this is just to show you that despite our model being relatively stylized, so we're missing a lot of important ingredients in the data, but we are matching relatively well the MRPK distribution. So in red here, it is the MRPK distribution of the model. In blue, we have the MRPK distribution in the data. So this is our threshold. So of course, to the left of the threshold, we don't have anything in the model. But then to the right, we are relatively doing a good job in matching this. And this is an untargeted moment. So this gives a little bit confidence that what we're going to show is not crazy, at least. So these are the shocks that we have. So let me walk you through them little by little. I know there are a lot of colors here. But let me start with the orange line, which is a shock to the time preference of the household with no nominal rigidity. So in a world where there is no nominal rigidities. So what happens? Then inflation is not moving because we have no nominal rigidities, right? This time preference shock, what it's doing is decreasing the real interest rates. But also we're having that this price of capital is increasing. And what we're seeing is that then the profits of high MRPK firms are decreasing in relative terms to the ones of low MRPK firms. This is given by this slope of the excess investment rate. It is the slope of this profit function that we were seeing before. So I'm for sure you cannot see it, but believe me, this is the slope of this profit that I was showing you before. So this slope decreases, and also since there is this shock to the time preference, now the household wants to save more. The household is saving in units of capital, so hence we need that low productivity firms, lower MRPK firms now are starting to operate to be able to get like this extra capital, so to give these extra savings to the household. So this threshold is decreasing. This is the threshold set star. So these two things are making that TFP decreases, okay, after this demand. So you have that real interest rates decrease and TFP decreases, but it is because of how all the other prices are evolving, right? Now, if we are introducing nominal rigidities, we have a monetary policy shock. The planner, the central bank is now following a suboptimal Taylor rule, okay? So it's following a standard Taylor rule. Now we have that after this expansion in monetary policy shock, even though we chose the path of the real interest rate to be the same, but the rest of the price is moving in a very different way, even though the real interest rates are moving in the same direction. So we have that inflation is increasing, the price of the input good is increasing, wages are increasing. This is creating a temporary expansion. And this is because the profits of high MRPK firms are increasing relatively more than those of low MRPK firms. This is what we're seeing here, this slope of the profits that we were seeing before. And also the threshold is moving to the right. So we're having less low productivity firms operating and more high productivity firms operating. And this is going to create this temporary expansion in TFP. So I just wanted to keep in mind like these channels, because this is when we go to optimal monetary policy, is going to be all these channels. Then for completeness, we introduce also a time preference shock with nominal rigidities, which is the yellow line. And we see that what happens is that since the planner is following a suboptimal Taylor rule, then the planner cannot keep up with the drop in nominal interest rates, and then the real rates are actually even increasing because of this mismatch of natural versus real rates, because of this suboptimal Taylor rule. So now that we understand more or less the mechanism, let me go to optimal monetary policy. So this is the central bank's problem. So the central bank only cares about the household, so it's maximizing the utility of the household, subject to the parity agreement conditions and the initial conditions. And this is a complicated problem to solve because we need to keep track of the whole distribution of firms. So we're proposing this new algorithm that I won't cover here, but if you're interested in, let me know. So this is the optimal Ramsey policy. So we start from the Ramsey steady state. The Ramsey steady state features zero inflation. And what we do is we let the planner reoptimize. So we wake up today and we say, okay, what would you like to do if you can surprise everyone? We allow you to surprise everyone. Then what the planner wants to do in this baseline, well, let's start with a complete markets case, which is our model just with no endogenous TFP, no misallocation. So it is the same, but without this extra feature. In this case, everyone know, well, it is well known that zero inflation is optimal. Why? Because the steady state is first best. We're introducing the subsidy to undo the markup distortions in both economies. So the complete markets economy is efficient. We do this exercise and the planner says, okay, I don't want to do anything because the steady state is efficient, so I want to stay put and not do anything. However, in our baseline, when there is misallocation, the planner wants to create this surprise inflation. She wants to expand the economy. Why? Because then we're going to have this medium run increase in TFP. And everything else behaves like a monetary policy expansion. Everything we've seen from monetary policy expansion, this is what the planner would do. And now we jump to a different kind of optimal concept, which is the timeless optimal response. So if the planner would behave as she would have as she would have made promises from a time far in the past, what would she do in response to this household time preference shock? So the same shock we saw before. Well, in the complete markets case, we know that there's the divine coincidence, so inflation is zero and the output gap is completely closed. In our baseline, which is the blue line, we see that this is, we also find the same. So inflation is zero. Now there is this slight deviation, but this is just numerical precision. But what matters, so this, remember that now the dynamics of everything, it is exactly the same as in the case of the time preference shock without nominal rigidities, because the prices and everything behaves as in the case of no inflation. So everything is behaving as in that case in terms of prices. But the drop of interest rates is much larger in our baseline economy than in the complete markets economy. And part of this is because of this decrease in endogenous TFP. And why does this matter? Because the planner needs to follow this to decrease real interest rates further to achieve this zero inflation. And this matters because when the shock is large and we are hitting the zero lower bound, then since in the complete markets case the interest rates are going way below zero, it is optimal for the planner to keep a low for longer strategy. So in the complete markets, we have here, the orange line would be the behavior without the zero lower bound. When we include the zero lower bound in yellow, we have a low for longer, but this is just less than 1/4, right? When we are looking at this from our baseline economy, we see that this low is for way even longer because the interest rates have decreased in the negative territories for a longer time. So the planner needs to make these promises of staying at the zero lower bound for much longer to decrease the welfare losses. So I have just 1 minute, so I'm just not going to explain this. But here, what we do in the empirical section is pretty much, so the heterogeneity we're looking at is on MRPK. And what we're showing is that actually high MRPK firms are the one responding relatively more to expansionary monetary policy shocks. So this is what we're showing here. This coefficient is positive and significant. So this is the case in the model, and this is the case in the data. And actually, qualitatively, we're not that far from this estimate. And we also tried to derive misallocation measure that is telling us how TFP changes, but trying to also isolate the changes in the capital allocation. So we are deriving this weighted average MRPK. We compute this in the data and in the model, and the black line is what we get in the data, and this in orange is what we get in the model. So we are under predicting these changes, but we're not that far. So let me conclude. Just we are proposing a model of heterogeneous firms, financial frictions. We are putting forward a new transmission mechanism showing that expansionary monetary policy shock increases investment of high MRPK firms relatively more, improving the capital allocation. And we show what the implications of this for optimal monetary policy is. And we show that there is this new source of time inconsistency, and that hitting the zero lower bound makes a low for even longer optimal in this case. So thank you. Thank you very much.
Thanks a lot for having me. I'm super happy to be here and to have the opportunity to discuss this amazing paper. So first, let me summarize this paper. This paper makes 3 types of contribution. The first one is a positive contribution. The author of this paper shows that monetary policy can influence aggregate productivity through its heterogeneous effect on firms' investment decision. Then they also make a second type of contribution, that is a normative contribution. And they try to determine if monetary policy should use this new channel, this new capital misallocation channel, to increase the aggregate welfare in the economy. And finally, they also make a methodological contribution because they introduce a new algorithm to compute optimal policies in those complicated heterogeneous agents model. Let me talk about this first about this positive contribution. So they try to determine what is the impact of monetary policy on capital misallocation in this economy. So first, they conduct this empirical investigation, and they use a universe of Spanish firms and high-frequency approach to estimate the effect of an expansionary monetary policy shock on capital misallocation. And they show that after an expansionary monetary policy shock, firms with a high marginal productivity increase by more their investment than low productivity firms. So it triggers a shift in the distribution of capital from the low productivity firms to the high productivity firms. It decreases capital misallocation and increases the aggregate GFP. And then they conduct this theoretical investigation because they want to build a model that is able to reproduce their empirical findings. And they build a model that is in 2 parts. The first block is this tractable model of firm heterogeneity. They built on MOL 2014. And this model has 3 key ingredients. Firms face idiosyncratic productivity risk. They are heterogeneous in their network, and they face those borrowing constraints. The second block is a new Keynesian block, standard new Keynesian block, that allows them to study monetary policy in this framework. And how can they replicate this finding that monetary policy affects capital misallocation? So here in this economy, GFP increases when more productive firms produce using a larger shock of the stock of capital. And the stock of capital used by firms depend on their net worth, because of those financial constraints, because of those collateral constraints. And the firms can increase in network by returning its earnings. And here, what this equation says is that monetary policy will affect firms' earnings, so the first part, and it will affect more firms' earnings of the more productive firms. Okay, so the more productive firms can increase more their earnings, and they will be able to expand more, and they will accumulate capital faster after this expansionary monetary policy shock. So it's the first mechanism. The second mechanism, is linked to the fact that in this economy, firms are profitable if their marginal productivity of capital is higher than the marginal cost of capital. So you have this Z-star that determine if a firm is profitable or not. And if the productivity of the firms is higher than this Z-star, the firms will borrow as much as it can and it will grow as fast as it can. And if the productivity of the firms is lower than this Z-star, the size of these firms will shrink to zero and they will lend their capital to the more productive firms. And here, monetary policy can change these stars, and if it increases these stars, it will crowd out the low productive firms, and those firms will shrink to zero and then lend all their capital to the more productive firms. So the second mechanism also triggers a shift in the distribution of the capital of firms from the low productive firms to the high productive firms, what increases the aggregate GFP. And when they calibrate this model to the Spanish economy, it's indeed what you see. When monetary policy affects the relative price in your economy, those two mechanisms go in the same direction, and you have an increase in the aggregate GFP. So this is a positive contribution. Then they try to determine if monetary policy should use this channel. And first, they do this time zero optimal policy when the planner is not tied by his previous commitment. And they show that in this case, monetary policy would like to engineer an expansionary monetary policy because it can affect the aggregate GFP. But if the planner is tied by this commitment, so if the economy is running for a long period of time, the planner cannot surprise the agent, and in this case, it's too costly to use monetary policy to increase the aggregate GFP because of inflation. So we retrieve this usual result that the optimal policy is price stability. So I wanted to thank you for this great paper. I'm super happy to be able to read the new version of this paper. It's super complete paper and well-written paper. And it's an important contribution to the literature. And also I spent a lot of time during my PhD reading this paper, and I've learned a lot about heterogeneous firms reading this paper. So thank you for that. And I just have 3 clarifying questions. So the first one, I'm sorry about the first one, because I think that you hear this question a lot. But what is the cost of having constant return to scale in this model? Because Orbit can say all the time that you need those decreasing return to scale to have this relevant distribution of firms, especially when you run your quantitative investigation. So here, the firms that are too big in this economy are the small firms, and the small firms are not very productive, and the firms that are too small are the big firms that are super productive. So you would like to give all the capital to the already super big firms. So is that something that you see in your data, this correlation between firm size and firm productivity? And if it's not what you observe in your data, do you think that it's a problem? Or do you think that it's enough to capture the dynamic of the constraints, the fact that monetary policy relaxes the constraint of the more productive firms? That's the first thing that I would like to understand. The second question is, I perfectly understand the benefit of an expansionary monetary policy in this model, but I don't really understand the different costs of inflation in this model. So is that only those price and capital adjustment costs, or do you have other type of costs? Like, do you see that inflation, for instance, generates costly redistributive effect across your different type of firms? And do you think that if you have those effects, are they proportional to the firm size? Because in this case, the distribution of firms over their size and productivity will matter a lot, I guess. And do you have a way to compute the cost of inflation by size and productivity, maybe in this model? And the third question is really by pure curiosity. So here you have a model where the cost of inflation is higher than the benefit of this expansionary monetary policy. So I would like to know if it depends on your calibration of the marginal productivity in your model. And could you find some economy, some country where you can see higher level of capital misallocation that will make the cost of an expansionary monetary policy that will help to increase the aggregate productivity better than the cost of inflation that we could have in those type of economy. And thanks again. It was a great paper, and I was super happy to read it again.
Well, thank you, Alice, for your comments. All right to the point. So let me, I can start answering your questions. So regarding conversion to scale, so it's definitely right. Without decreasing down to scale, we cannot match the size distribution of firms, because of the constant return to scale, we can think of it as a limit case of the decreasing down to scale. So it is a limit case. So it's hard to match the size distribution. The purpose of the paper is more conceptual. I'm trying to think about the mechanism, the dynamics. But we want this mechanism dynamics to be something that is plausible. And that's why we conduct all this robustness. So first of all, we're showing that the MRPK distribution is not that far away, because all the heterogeneity here that matters in this paper is along this MRPK distribution. So at least the MRPK distribution is not that much off. We could also you could think, okay, but then in the data you're looking at MRPK, so it could be your results could be driven by small firms that maybe are reacting a lot, like they have very little capital, they're reacting a lot, and the large firms are not actually changing their investment that much. So we do robustness in the data, just looking at so running the same regression, but just only on large firms, or firms that are over the P95 in the Spanish firm size distribution, and we find that the coefficient is 3 times larger. So actually, large high MRPK firms are reacting even more than the average in the economy. So at least this heterogeneity in behavior also happens at the right tail of the distribution. And then we've also performed a lot of robustness tests on pretty much all the parameters. And whereas quantitatively these things change a lot, so the parameters change things a lot, qualitatively we also always see things going in the same way. So the mechanisms, like everything, like the messages we want to convey, they are there. So this would be my answer to this question. Then. So about this question too, the thing is that the way, like the inflation, the cost and the benefits of inflation in redistributive terms are given by these changes in prices, because the price adjustment cost itself is bared by the retailers, which are the other agents in the economy. The planner does not really care about whether it is these guys or these other guys that pay the price. The plan only cares about the efficiency, because all the profits of all the agents in the economy are going to the household. So and they don't care about the redistribution of profit itself, just in terms of the efficiency. So there is this redistribution along the MRPK distribution given by the changes in prices. This redistribution from the retailers to the producers, because the markups are decreasing. The markup is the inverse of the intermediate price. So there's this redistribution also after a monetary policy shock, and this redistribution also among the household and the entrepreneurs via changes in capital, so the capital they own once they have the shock. So there are all this redistribution. So there's these redistributive effects along the MRPK distribution, which is different than size, which is what you were asking. I think to look at this along the size distribution, probably we'll need a different model. Going back to your previous question along having decreasing to scale, so it would be super interesting actually to write a paper on this, having like a realistic size distribution, seeing what would be the mechanism that would matter for this heterogeneity along size, which probably is there, but yeah, this is out of the scope of this paper. And finally, question 3. Indeed, it does depend. So if we have like a more compressed MRPK distribution, we have that this benefit of expansion in monetary policy from the time zero perspective would be lower quantitatively. Again, we've checked with a lot of different parameterizations, and it always goes qualitatively in the same way. Quantitatively, it matters a lot, this distribution. So yes, it matters. And I don't know if anyone has any more questions. I don't know if we have time for more questions.
Yes, we do.
Please
go ahead.
Thank you.
I think we need the mic, otherwise we. Sorry, sorry.
Should I start over?
Yes, sorry.
So anyway, congratulations. I was just wondering how your model and findings relate to the zombie firm literature, where when interest rates are low for long, you start to see more misallocation because hurdle rates are falling, and it means that less and less profitable projects with low MRPKs start becoming positive NPV and getting undertaken. So, the entire mechanism relies on the monetary policy driving up Z star and crowding out the less productive firms and therefore driving up aggregate TFP. But the zombie firm literature, really finds opposite effects, that the longer that interest rates are low, the more misallocation you see. So that would be interesting.
Let me just collect some
Yes.
questions. Then it's Hélène.
Thank you. Yeah, great paper, great discussion. So I think it relates a bit to what Anusha just said. So about the Spanish economy, we have had also this literature about capital misallocation due to, entering the euro and decrease in capital cost. So I wonder to what extent, if in your model, you don't have heterogeneity across the net worth constraint, right? Your kappa, whatever is kind of homogeneous. I wonder if, so I know it's even, more difficult, but if, so in the data, there wouldn't be a lot of heterogeneity there. I'm thinking about, real estate, of course, and so all the collateral intensive constraints, which we also, I think, know that react more to monetary policy. So I don't know if you could introduce that additional dimension or maybe discuss it, and that could mitigate a little bit this issue of, what type of firms are the one growing faster and maybe also the effect on productivity. I think maybe it would be worth thinking a little bit about that.
Hi, Bea, thank you very much. That was great. So yeah, as you mentioned, we have a very similar paper, no? So I guess we've been thinking about these things for a while, and I think my comment relates to their comments, which is there's a difference between a temporary monetary policy shock, well, sorry, a temporary interest rate shock and a permanent interest rate shock. And one thing I was wondering is how much of your mechanism is coming for things that look like the balance sheet effect? So it's, I guess that's what Ale said, which it's a temporary response, this increase in TFP. Well, maybe if you had a permanent decline in interest rates, does that lead to a permanent increase in TFP? My impression is that it won't, and that maybe other mechanisms will start kicking in there that lead maybe to low TFP. So maybe to understand this, it's more, can you explain a little bit the difference of your mechanism between what's a balance sheet channel and what's the role of these other frictions that you have, like the markups? Do those things matter for this mechanism in terms of thinking about long-term, short-term effect and so on? Thanks.
I think we have Maria Sunt and Monica, and then you can answer their question.
Thank you.
Yeah, I wanted to build a bit on what Anusha was saying. I think you have to discuss those channels because, for instance, even on the Spanish data, people tend to find that lower interest rate mean that the banks allocate more capital to high risky companies. And on the inflation side, I'm thinking of a recent paper of Viral Acharya that is forthcoming on the JF that would argue that these prices of capital would decrease. He says that zombie lending and low interest rate are related to deflation. So I'm wondering how you think of this in the context of your empirical analysis and in the context of the models.
Along the line of what Elaine was saying, a second dimension of heterogeneity among firms may be how many people they employ. So if I'm a policymaker and I'm also concerned about employment in the economy, I may want to redistribute funds towards small, inefficient firms just because they employ a lot of people. And I'm wondering how you think about that.
How much time do I have? So I don't know how detailed can I be?
7 minutes.
Okay. So thank you very much for all the questions. They are all right to the point as well. So actually, regarding the zombie firms, we actually started talking about zombie firms in the paper. We stopped because then everyone was talking about the zombie firms, and we could not go on. So then we stopped. So it is true that one of the main differences with this literature, and I think this relates to a lot of points, is the fact that permanent versus temporary shocks. So here we're looking at temporary monetary policy shocks in the price of nominal rigidities, which is very different to other models that are looking at the real side. We have a size-dependent borrowing constraints, as you were saying. So this side is different. I'm actually like working at the ECB in our productivity group in a working group, and we've actually had a look at zombie firms among all the well, not all, some countries, because we can have like some micro-distributed exercise, and we saw that actually in this period, zombie firms with balance sheet data that has the whole population of firms did not increase that much, as these papers are finding, using Orbis, using some other data sets that have larger firms. So actually, the share of zombie firms has not increased that much. And actually, the findings we find in there regarding zombie firms are more along the lines of this literature, that it changes the rate at which zombie firms end, like you enter into the zombie firm status, you exit the zombie firm status, but many times the status is something that is temporary. It is not that you are just a bad firm that stays this forever. So I would say that even though that's true, there can be these differences between permanent and transitory shocks, which might bring something different. This is not that far from what we find in this working paper with a lot of European firms with firm level data. Regarding the capital misallocation, so this Gopinath paper that also again this, so it is definitely true. So again, they are looking at this when Spain joined the Euro country. So is this decrease in interest rate that is permanent, and that you can see it. They do need this size dependent borrowing constraint to actually be able to match like this pattern. So this is true. Again, this is a different setting because these are permanent. It prefers forehead decrease in interest rate. This is monetary policy shocks, which by construction they are very different. One thing that actually I would like to add on that is the fact that in Spain, and in many countries, asset-based borrowing is not that prevalent. Many times it is cash flow borrowing. So the fact that you're borrowing against your cash flows, not that much your asset-based. In Spain, it was important the real estate, but even in Spain, it is more prevalent cash flow earnings. So while this mechanism for sure is there, it's true, it might be happening. I'm not sure if it is the full story. Again, these things are super interesting. Probably we would need to build like a way more complex model to have this in, and it might change things. But for now, this is outside the scope of the paper. Regarding Victoria's question about temporary versus permanent, part of this is because of this. I think other part comes from this, the fact that there are nominal frictions, because actually in the nominal, in the model with nominal frictions, if we have a permanent decrease in interest rates, things behave very similar to the temporary one. Okay, so to how the temporary, the only thing that the fall in TFP is more permanent. But everything behaves very similarly. So it's the models are different. No, because I'm talking about the demand shock. The demand shock that decreases because a monetary policy shock, yeah, and it needs to be like yes. Yeah, exactly. And again, so I think what I already answered goes more along your question regarding this, the fact that banks allocate more credit to firms that are worst. We could say it's that mechanism could be there, but there are a lot of reasons why this might not be the only mechanism or the driving mechanism. And regarding, yes.
Opportunity are not going to be absorbed. So I think that all the debate is that whether there is enough investment or there is some overlending independently of the firm.
Yeah. Yeah, definitely. Yeah. So this could be there. So that's completely true. Underwriting employment, this is a super interesting question that we cannot answer with this paper, with this model, but it would definitely be a great paper to write, because like here, so I was saying, like the planner only cares about the consumption of the reparative household and about allocative efficiency, because all the profits are given to the household. He doesn't care whether it is entrepreneurs that have the capital or it is the household, or if there is redistribution along the entrepreneur distribution, only if it improves allocative efficiency, but the rest is shut down here. So including these other concerns would certainly be super interesting and might change things for sure. But yeah, would be interesting. Okay,
good. We'll
perfect.
stop here.
Thank you very much.
And now it's time for the second presentation. Just a reminder, if you want to talk, ask for a microphone, because we hear you, but they don't hear you from home. So that's okay.
So I'd like to thank a lot of people here. So first of all, the conference organizers for organizing such a conference. I think it's super important to have this. Then, of course, the program committee for including our paper, and our discussant, Anna, who had the patience of receiving a late version of this paper because we're still working on it, and we did a pretty big revision. So let me now start by motivating. So there is a very wide and growing literature that shocks matter and they propagate through the supply chain. They don't just cancel out in the supply chain, but they actually might be amplified through the supply chain. And there's evidence that various kinds of shocks propagate through the supply chain. So starting with liquidity shocks, shocks to financial distress of one firm, they can spread down the supply chain, productivity shocks, natural disasters, cyber attacks, and so on. Now, in this paper, we're going to focus on smaller but more common types of shocks. So these are the standard monetary policy shocks, conventional monetary policy shocks. Okay. Now, why would conventional monetary policy shocks propagate through the supply chain? Where there's actually a very broad literature and established literature that actually shows that this can actually happen. So monetary policy shocks can be transmitted both from the demand for goods. So if in a tightening of monetary policy, this increases the costs of investment and therefore reduces the demand. So from the downstream firm to the products of the upstream firm. Okay. But it also can propagate downstream. So there is also this so-called cost channel of monetary policy transmission that similarly contends that if you have increase in production costs, then this can increase the prices of the supplier firms going. So then it can be propagated downwards. Okay. So this is what we are gonna test empirically in our paper. And we contend that changes in monetary policy conditions can actually lead to what we called monetary policy bottlenecks. And what do we mean by this? Well, because firms in a supply chain, they rely on a variety of specific goods from the upstream firms, and they sell specific goods to the downstream firms. Then if you have financially constrained partners, either downstream or upstream in the supply chain, then your partners could suffer from production disruptions due to changes in monetary policy for the channels that I've just mentioned. And if it's difficult to substitute these partners, then this can produce these monetary policy bottlenecks. So it can lead to disruptions in the firm due to these disrupted partners. Okay. Now, this is an empirical paper. So how do we do? So we basically use firms from the US. I will show you the data in a moment. And we are going to analyze whether the financial health of clients and of suppliers affects the transmission of monetary policy shocks. And to do this, we're basically going to have a measure of the economic activity of a firm. We measure it with sales and purchases of the firms. And we are simply going to regress those. So when we look at downstream transmission, we focus on client financial health and the interaction of monetary policy, and we look at the firm sales, okay? And to look at the downstream transmission, we focus on the supplier health and interactions of monetary policy, and we focus on the purchases of a firm, okay? And importantly, we're gonna explore the heterogeneity in these relationships according to the nature of the traded good, okay? Now, there are many endogeneity issues that have to be tackled in this empirical approach. So we're gonna follow two complementary empirical approaches. So in our main analysis, we will focus on a very large sample of firms from the US. So that's gonna give us sort of external validity, but we are gonna have a very imperfect proxy of the actual health of the downstream and the upstream. So the clients or the suppliers, which is going to be based on the average health in the sectors that buy from the firms or sell to the firms, okay? And for identification, our assumption is simply that, you know, client and supplier sector health is going to be largely exogenous to the firm's activities. And we're going to use the usual monetary policy surprises also for identification. Now, because we have very imperfect measures of client and supplier health in our main sample, we're going to focus on a smaller sample to complement our approach. And in this smaller sample, I will show you in a second, is a bit selected, has some caveats. But in this sample, we can actually observe the actual financial health of the business partners for a subsample of firms. And then what we can do is we can compare the sales or purchases across different partners of the same firm so that we can control for all demand and supply of the firm and look at the heterogeneity in the financial health of the business partners in order to establish this. Okay. So these are our findings. Let me go from the least exciting and least new to what we think are the more interesting insights of our paper. So first of all, we show evidence that is in line with the balance sheet channel of transmission. So this idea that with monetary policy tightening, there is going to be a reduction in the economic activity of financially constrained firms. Okay, so this has been found in the literature. We simply confirm that this is also true in our data. The second and more new result is that we find evidence that there's propagation through the supply chain. So we find that the disruptions in one firm are in one financially constrained firm is going to affect the suppliers and the customers of this firm. So the sales and the purchases, okay? Now, interestingly, we are going to control for the balance sheet channel. So we're going to control for the firm's own financial health. And we find that these effects are significant even after controlling for this. This means that this propagation actually works on top of the balance sheet channel. Okay, and it can therefore affect also firms that are healthy in principle. Okay, we find actually that the transmission through the supply chain, through constrained clients and suppliers, is quantitatively larger than the balance sheet channel. And we also find that the disruption coming from upstream, so from constrained suppliers, is actually persistent. It's persist for at least 12 quarters. Okay. And the third evidence, which we interpret as evidence consistent with this monetary policy induced bottlenecks, is that we find that these disruptions are more severe when the constrained firms sell or purchase goods that are more specialized. We have several measures of specialized goods. We contend that these are, it's more difficult to substitute a business partner that actually sells or buys a specific good for the firm, okay? Now, our paper is not at all about inflation or anything, but one implication of our findings, or one way of looking at our findings, it could help explain why there is still persistent inflation to date, despite several rounds of tightening. And this is because of bottlenecks, potentially due to bottlenecks happening in supply chains that are already stretched after the COVID-19 shock. Okay, so that could be one of the reasons. But we actually don't test for this. This is just like speculation. All right, so let me just go to explain the data. Then I'm going to focus on the main results using the large sample, then a better set of identified results, and if I have time, some small extensions of the paper. So as I already anticipated, our main sample is firm level data from the US. These are publicly traded firms, Compustat, 1990 to 2016 quarterly data. So to look at transmission from the client side, from constrained clients to the firms, we're going to focus on the sales of firms. And for suppliers, we're going to focus on the purchases. And as our main measure of financial health, following the literature in this field, we're going to use the inverse coverage ratio, which is simply defined as the interest expenses divided by earnings. Okay. Now, our proxies for client and supplier financial health, as I said, they're just proxies. In this sample, we don't observe the actual health. So we're going to approximate that using the input and output matrices from the Bureau of Economic Analysis. And we're simply going to estimate the average financial health of all of the clients in the sectors to which the firm sells to approximate the constraint of the client. So it's really a sector weighted average of financial health. We're going to do a similar thing to look at the suppliers, okay? Averaging using as purchases, as weights, the amounts purchased from in the input-output matrices, okay? Now, in order to keep some exogeneity, so we know that a lot of sectors, the main client and supplier of the firms are within their own sector. So we're going to simply exclude the own sector of the firm in the calculation of these averages throughout the paper. Okay. And then in terms of monetary policy data, we're going to use changes in the Fed funds rate and monetary policy surprises provided by Refet, Gerkenyak, and co-authors. So our methodology is pretty standard, simply a local projection methodology, where we're going to take some measure of the firm's financial activity and regress that on interactions of changes in the monetary policy rate with client or supplier financial health. And so when we focus on the bottlenecks coming from the client side, the main dependent variable is going to be sales. The main variable of interest is the interaction with client financial health. And we focus on sales, as I said before. And for supplier bottlenecks, we focus on purchases as a dependent variable. And we look at the interaction of supplier health with changes in the interest rate. And of course, our main object of interest is the coefficient of that interaction. And everywhere we're gonna control for the firm's own financial health and a wealth of controls, including interactions of many firm characteristics with the changes in the monetary policy rate. Okay, let me skip this. Now, this is just like a baseline result. So confirmation of the balance sheet channel. This is the whole curve of the local projection for the interaction of the firm's own financial health with changes in the monetary policy rate. So I'm showing you here with interactions with changes in the Fed funds rate, but these results are robust to using the monetary policy surprises as our main measure of monetary policy. But this is just like the starting point. Okay. Now this is really the more newer result. That's our contribution, our first part of the contribution to the literature. And something that I didn't mention is on the upper panel, we always have firm sales. On the lower panel, we have firm purchases. In the upper panel, we're looking at client sector health. So we're thinking about client-induced monetary policy bottlenecks. And in the upper panel, we're focusing on supplier-induced monetary policy bottlenecks. Sorry. And as you can see, so we find a strong result, reduction in the economic activities of the firms when there is when firms are more financially constrained, right? So we also find that the transmission is quantitatively important. So these are the estimations, and here I am just standardizing. I just want you to focus on like the coefficients that are in blue for the client bottlenecks. And in parentheses, we have what the reduction, the differential reduction of an increase of 1 standard deviation in the financial health of the clients will lead to a lower increase in sales of 6.5 percentage points, for example, in the specification in column 1, which represents 30% of the variation in the dependent variable. So if you just focus on the parentheses, these are really important numbers, and they are larger than the effects of the firm's own financial health on the dependent variable. And the same is true for supplier-induced monetary policy bottlenecks. This is the same that I showed you, but using monetary policy surprises. We also check different measures of financial health. Here we have the debt, and it's robust. Now, this is our third and also the contribution of the paper, which is that, so we estimate separately the coefficients for the interaction of client health and changes in monetary policy for the firms that sell specialized good, which is the dark curve, and for firms that sell non-specialized goods. Here we use the definition of paper by Rauch and co-authors to separate between specialized goods and non-specialized goods. And you can see that it's always below when it's specialized goods, both for client financial health and for supplier financial health. Okay, so this is what we interpret as the bottleneck effect. And this result is robust to using monetary policy shocks, monetary policy surprises. I'm not showing it here in the slides, but it's in the paper. And for different measures of specialization. Here we use, for example, the patent count, the number of patents as our measure of specialization, patent citations, and we find consistent result. Okay. Now, this was like the sample that has external validity, But there are many issues of identification, which we try to approach, excluding the firm's own sector in the calculation of the financial constraints, using the monetary policy prices. We also use a quantitative approach of Emily Oster to quantify how much the unobserved variables would have to matter in order to render the results insignificant, and these factors are really large. But nevertheless, we want to nail down identification a little bit better in a more restricted sample. So what we do is we use a segment file of Compustat where we actually can identify the most important clients from which each firm is to which a firm sells to. So according to some regulation, firms have to disclose the name of the clients that account for at least 10% of their sales. And we take this information, we manually match it to client names from Compustat to obtain the balance sheets of these clients. And we're going to estimate equations. So for sales, when we look at client bottlenecks, where we basically have the same idea. So interaction of the monetary policy rate with the financial constraints of the clients, and a set of controls, including firm times time fixed effects. This firm time fixed effect controls for all time varying characteristics of the firm and compares the interaction across different financial constrained clients. And we can also do the same from the supplier side, but with a big caveat that in this file, the Compustat file, firms disclose their most important clients, but a firm that is a most important client or somebody is not necessarily their most important supplier of that firm. Okay, so it's an imperfect sample to look at the supplier bottlenecks. It also has the disadvantages that it's a selected sample. So we only observe very large clients because they have to be at least 10%, to account for at least 10% of sales for very large publicly traded firms. In the US, they have yearly frequency, et cetera, et cetera. So the sample has many caveats, and in particular, it's more suitable to look at client bottlenecks. But here are the results. So when we look at the transmission through constrained clients with specifications that have different saturation in our model, we find always a significantly negative result. So more constrained clients lead to lower sales for the firm. And when we estimate regressions separately for firms selling specialized versus non-specialized good, we find that the results come mostly from the specialized goods. Now for suppliers, as I said, the sample is less perfect. We try to obtain more information from our sample by using weights in our regression. So input taken from the input and output matrices to obtain more information from the sample. And we really only find a significant result in the less saturated regressions. We also did this separately for firms selling specialized and non-specialized goods. And we find a little bit more significance with all of the caveats with the specialized goods. Still, we think this evidence goes in line with our main hypothesis that it is monetary policy bottlenecks that is driving the results. Let me skip the extensions due to time constraints and just show you the key takeaways of our paper. So monetary policy shocks can affect both the aggregate supply and aggregate demand by creating bottlenecks in the supply chains. So these bottlenecks act through the weakest link in the supply chain. So the firms that are if the clients or the suppliers are financially constrained, that's going to lead to this transmission. These bottlenecks are quantitatively important. Supply bottlenecks are more persistent. They last for at least 12 quarters. And supply and demand bottlenecks can affect firms that are unconstrained. And so we see our literature as contributing to the literature on monetary policy transmission, a very large literature. Of course, network propagation of shocks, but especially this paper looks at monetary policy transmission through the supply chain. There are two very related papers. So what do we do relative to these papers? So first of all, we focus on conventional monetary policy. So that's closer to Ali and Michael's paper. We find that monetary policy transmission also is affected by the firms upstream. But most importantly, we highlight the role of financial friction, so financial constraints upstream or downstream in this transition, transmission, and of these bottlenecks that are induced by changes in monetary policy. And that's it. So I'm really looking forward to Anna's discussion.
Yeah, I think that's okay, great. So thanks so much. I think this conference is great. I participated to the first online edition, and it was already an amazing opportunity for a fresh out of the PhD person, and it's getting better and better every time. So this time I got the chance to read Emilia's paper, which is really great. So thanks a lot. So what is this paper about? It addresses a long-standing but still extremely topical question, which is whether monetary policy has real effects and through which channels. And as an employee of central bank, of course, this is super relevant for me. So what's the contribution of the paper? Well, to uncover a new channel of transmission, which is distinct from the direct effect, which is the balance sheet effect through which monetary policy we think transmits. And so this new channel of transmission operates via production networks. And this new channel is potentially very relevant, as the paper shows. Why? Because it affects financially constrained firms, but also firms which are not financially constrained. So it's something that matters for all firms. And they show that also quantitatively is very big, even bigger than the direct effect. So it's a very important channel to look at. And so it's very topical paper, super neatly executed. So I really suggest reading it. So let me jump into the mechanism just to, I mean, Emilia explained it very well, but let me review it once more. So let's say we are a firm, we're in Sweden. So we are producers of pepparkakor. I don't know if you know what they are. They are like Swedish biscuits. You should all try them. And we need some flour to produce the pepparkakor, but we also need some distributors of the cookies. So the direct effect of monetary policy would tell us that when there is a tightening and we are the producers, we face higher borrowing rates, and so this might constrain our investment. So that's the usual balance sheet channel. But what the paper is about is about a new channel, which is indirect and which operates through production networks. So let's think about our supplier of flour. When there is this tightening of monetary policy, our flour supplier borrowing conditions might worsen, and so we might get less input as a pepper-cackle producer. And so unless I'm able to quickly substitute my supplier with other producers of flour, well, this might really affect my production. And the same goes for the downstream side. So the client, I need a distributor of my cookies. And if my usual distributors get constrained in their financial conditions, they might be less able to buy my cookies. And so I'm faced with lower sales. So unless I'm able to quickly substitute for them. So that's really the type of bottlenecks that the paper is thinking about. What's the method that they use? It's an empirical paper. They use 2 sets of data. First is firm level data from Compustat, and they rely on input-output matrices to calculate the financial health of the supplier and the client sector average. And the identification is done by assuming that the average financial conditions of the upstream and downstream sectors are mainly exogenous to the pepper-cackle's producer ability to supply the cookies or demand the flour. But then there is a subset of firm. It has some challenges, but I find this set of results very useful, where they are able to match firm to firm. So every firm with the exact suppliers and clients, even if it's only the big ones. And so this allows for a calculation of an exact financial health of the supplier and the client. And here the identification is assumes that the monetary conditions affect the firm's sales uniformly across clients or purchases across suppliers. The main results are that the financial health of upstream and downstream firms is important for monetary transmission. And in particular, that this bottleneck effects operate on top of the direct effect of the balance sheet, going through the balance sheet, and they are quantitatively big, even bigger. And moreover, there is an asymmetry between the downstream and upstream bottlenecks. In particular, the downstream bottlenecks induced by the financial health of clients are less persistent than the upstream ones. So the upstream ones seem to be more worrisome in a sense, like more constraining. All right, so I have 3 main comments, more like ideas and suggestions on things that they could explore further. So the first one is on the non-symmetric effects of monetary policy bottlenecks. So now we are in a policy tightening, so bottlenecks might be particularly severe. But let's imagine that we are in an easing cycle. I wonder whether monetary policy easing would help reducing the financial constraints in the same way as the tightening generates the bottlenecks. To be a bit more specific, look at whether positive monetary shocks have a different impact than negative monetary policy shocks. Why? Because if a monetary policy easing happens in a situation when the clients and suppliers are not financially constrained, well, then this channel should be muted. We shouldn't see any bottlenecks being loosened. But instead, if the loosening hits in a moment when the clients and suppliers were already financially constrained, then monetary policy should be powerful in easing the bottlenecks, right? And we might see some asymmetries between upstream and downstream substitutability. So I think this could be nice to explore if you can. The second comment that I have is to think about the network structure and how that might affect the bottlenecks. So at the moment, you use the average financial health of the downstream and upstream
sectors. But I would speculate that probably the network structure matters. And in particular, I was thinking, if a supplier, for example, is at the beginning of the production network, there is no accumulation of these bottlenecks before, because it's at the beginning of the network. But if the supplier is along the network itself, it might be that these bottlenecks compound. And so this might be interesting to study. So if you could have a measure of upstreamness or downstreamness or position in the network, maybe you could look at this and for example, see whether it's true that there are more upstream bottlenecks when a firm operates down the line, like towards the end of the network, and vice versa, where there are more like bigger bottlenecks downstream when a firm operates upstream. So this is something that you could do already with your input-output network of sectors. The last comment is on the type of shock that you're looking at. So now you focus on monetary policy, and of course, it's very interesting, but I think that your mechanism is more general, this channel of bottlenecks. Basically, every shock that changes the financial health of clients and suppliers might trigger this. And so I was thinking whether you could explore the quantitative relevance of monetary policy-induced bottlenecks versus bottlenecks generated by other shocks, like other macro shocks, maybe like some supply side, like TFP shock, as we saw before, or even the second moment shocks like uncertainty. I think there is a new paper by Segal and Grigors, and they try to look at that. So I think you could maybe try to run a horse race between various shocks and see whether the monetary policy-induced bottlenecks are big. So I think it's a great paper, tries again to show us that monetary policy has real effects and uncovers a new channel via production networks. I think I'm out of time. Thanks a lot.
Thanks a lot, Anna. These are really great comments. We've already discussed a little bit and super well taken. So thanks a lot. So the only one that we have thought about and actually done something is your first comment on positive versus negative monetary policy shocks. And so we do find like the point estimates are consistent with the tightening driving these results. But the period that we have has a lot of easing periods. So we have very wide confidence intervals and cannot really nail that down. We hope we can update the sample because it's limited right now by the surprises that we have until 2016. But we're certainly, I mean, it's like an important ingredient, and your other comments are super relevant, super well taken. Thanks a lot.
Okay, thanks. I just wanted you to talk maybe about a slide that you rushed through, which is the role of trade credit in all of this. So maybe I'll give you time. I know you had it, but I was interested in knowing how it relates to the mechanism through sales.
Yes, sir.
No.
Thank you. The outcome variable that you are examining is in dollar terms, which is the product of quantity versus price. I'm wondering whether you have a way to disentangle the two, because they could mean different policy implications. If it's through quantity, it might be because, for example, when the supplier is constrained, they have difficulty in producing goods. But if it's price, I'm wondering whether that's because when the suppliers are constrained, they are depleting their inventory at discounted price, so that the customers are actually not get hurt from this, but it will be reflected in a lower dollar term.
I think we have Melina and Beatrice. You all have the same question.
Okay, well, so my question is also related, I think, somehow, but I was thinking whether you think that the financial condition upstream and downstream are really exogenous. Maybe they are like for these very big firms, like you're looking at Compustat, but there are papers saying, for instance, when you're winning a government bid or when you know that you're going to have like a big supply, like someone demanding your goods for a long time, you're getting more credit. Because if you're borrowing against your cash flow, that means that you're going to have like a steady cash flow because this big guy is going to buy. So either because of procurement or because you have like a very big contract with a big firm, this might be important for your own financial conditions. I'm not sure it's true. It's Compustat, so these are big firms. So I'm not sure whether this is that relevant or not, but yeah.
And we have Larissa.
Yeah, so I actually had exactly the same question with the trade credits. I'll leave it out. So how it plays out, and basically, I mean, because also you worked on trade credits, so I'm sure you have something to say about it. And the last thing, what I also wanted to ask, why basically the effect of supplier is stronger and more long term. I mean, it was very persistent. The two graphs that you showed with the sort of with the client, it went down and up, so they were easily able to recover. Does it mean that it's easier for them to switch maybe the customers relative to the suppliers? So it would be interesting to understand, and the magnitude of the effect is much larger for the supplier as well as. So it would be interesting to understand sort of we see the main result and I believe it, but in a sense sort of the mechanism and channel behind why the effects are don't seem to be symmetric or similar. Thanks.
One more question. You see, you have lots of great minds think alike.
Thank you. Can you just elaborate on the monetary surprises data set that you have used? Is it just the changes like in interest rate or in open market operations or what? Thank you.
Ettore?
Of course, we are talking about an environment in which just in one currency, right? So because you could have maybe substitution with supplier, maybe in other denominated in other currencies, maybe, which could neutralize some effects. So, I mean, the exchange rate could matter a bit in this. Of course, now you have Compustat, only dollars, but something about the currency could matter also, no? Thanks.
Right. So thanks a lot for lots of questions. So about the trade credit, yes, this is something we definitely looked at because we wanted to see what is the effect. And we actually found that if anything, suppliers will give even less trade credit to constrained clients. And firms are also, so if anything, we found a negative effect of trade credit, which means that actually trade credit does not help to mitigate these supply chains, bottlenecks. Yeah. So for our client supplier matched sample, we don't observe the trade credit. So we can only look at it at the big sample. And there we definitely find that, when clients are constrained, we find lower amounts of trade credit taken and vice versa. So yeah, it's not what I would have expected to see, but that's what seems to be. We can look at it more closer if we had more detailed data, but yeah. About quantity versus price, yes. So we are super aware. We have the product of these two. So we cannot disentangle. We don't have, unfortunately, this fantastic Swedish data on prices. So we cannot disentangle this. I agree completely with you that this is would be super interesting, especially for the downstream transmission from the suppliers if they increase the prices. One thing that I do want to say about this is that, I mean, an increase in price would go against us finding a result downstream, and we still find super strong effects downstream. So our interpretation is that these supplier-driven bottlenecks are really super important, which brings me to Larissa's question about why they are more persistent. So this is really a question that has been puzzling us for a while. This is my view on this. It may not be my co-authors, so take it with a pinch of salt. But there is a wide literature that shows that, you know, when suppliers are having some kind of problems, clients are going to demand less. So why? Because of a price issue. So Chevalier 1996 has this paper. And or, you know, the quality could be going down when you're financially constrained, or the clients could, if they buy a durable good, they might be factoring in the fact that the supplier might go bankrupt, and therefore they might actually demand less. So that's one interpretation which I've thought about, but it's certainly worth a little bit more investigation on that side. And Beatriz? So about the endogeneity, absolutely, yeah. So we try to deal with this endogeneity of clients' financial health with the firm's financial health of the type that you're looking at by excluding the sector of the firm. When we're calculating this, it's imperfect. But I think that here the actual matched sample where we have the clients, the actual clients, and we can fix the firm. And we're simply looking at heterogeneity across the financial health of the clients while fixing everything else of the firm constant. That helps to mitigate that this is what is driving the result, I think. Monetary policy surprises. So this is Refed Gerkanyak's measure, Sack and Swanson. So it's the market reactions to the monetary policy decision on the FOMC dates. That's basically how these surprises are calculated. And about exchange rates, yes, we are really looking just at the US. There could be other types of in international trade factors that mitigate this. We are just focusing within composite firms actually operating within the US. So yeah, that's one caveat of our approach. Thank you so much for all your comments, questions.
Good, then we can have a break now, and we can reconvene at in half an hour. Okay, so I think it's time to start. So if you... Good. Then it's a pleasure to start with the new presentation, the next presentation, the last one before launch. So Isabel, you have 25 minutes.
Thanks very much. Okay, thank you. Thanks very much for having me in. It's a pleasure to be here. Very impressive to present in front of a whole woman crowd, and always very stressful to present in front of that many macroeconomists. So hopefully what I'm going to talk about today is still of interest to macroeconomists. This is joint work with Julien Martin and Raphaël Lafrange-Jossier. Raphaël is my PhD student, now working at the French Statistical Institute, which explains that we have very good data. So as you probably noticed, inflation is back. We've discussed this a lot in the US and European context. We've discussed extensively the evolution of the consumer price index, which has been growing very fast in the last 2 years. Perhaps a bit less discussed is the fact that the PPI has grown even faster, even when you exclude the part of the PPI which is driven by the energy sector. So this is this line here that you see. The PPI without energy has been growing much faster than the CPI. In the context of Europe, another extensively discussed element is the role of energy as a cost push factor for inflation. So energy prices have been growing very fast as well in Europe, which has led to a number of policies that were meant to deal with this rise in energy prices. So this graph is showing the evolution of three important sources of energy for firms, because we are going to look at the impact of energy prices on firms. So this is the evolution of electricity in pink, then gas and oil. As you see, all of them have been rising over the last 2 years, and the evolution has been quite heterogeneous depending on the type of energy. So here, I should mention the fact that these data are taken from the French PPI. So these are energy prices that are set to businesses. And this is an important element to keep in mind, because in the French context, as you perhaps know, the French government has imposed a price cap on electricity and gas as a reaction to the energy crisis. This price cap applying mostly to households, and firms have been led to, have supported very large increases in their energy consumption. So this is what you see here. Energy prices have really grown very fast, especially in 2022. So the question that we're asking in this paper is fairly simple. What is the impact of these energy price shocks on firms? So we are going to use for this data on producer prices at the very micro level, and then we'll try to say something about the impact in the aggregate. So more specifically, I'm going to show you results that are exploiting monthly micro price data that we are going to match with measures of the exposure to the energy crisis at the firm level. And the first thing that we are going to document based on that is the very strong degree of heterogeneity across firms in terms of their exposure to the energy crisis. So very often we think of the energy crisis as some form of aggregate supply shock. What I'm going to argue is that actually in the context of the current crisis, the impact has been very heterogeneous across firms, because firms are not equally energy intensive, and because their mix of energy, which we are going to observe in the data, is very heterogeneous as well, including within a sector. So then we're going to exploit this heterogeneity to estimate the impact of the energy cost shocks to producer prices. So again, exploiting the fact that some firms are more exposed than others, and estimating from this heterogeneity the pass-through of energy cost shocks to producer prices. we find that the pass-through is very large, basically full pass-through and very fast. Within a quarter, shocks to energy prices are already shown in producer prices. And the second thing that we document is a very strong degree of asymmetry. So the positive shocks are passed much strongly than decreases in energy prices, which in the context of the current energy crisis is important because prices have gone up very fast, but are not now declining. And the asymmetry is going to be important in driving a possible transmission to prices. And finally, we try to quantify the kind of aggregate effect of what we see in the data. So quantify the impact of energy as a driver of inflation in our data, and discussing both the distributional impact. So again, we find firms are very heterogeneous in terms of their exposure to the energy crisis, and thus this has consequences on heterogeneity in micro level inflation rate. And then the impact on the overall PPI, we find that we can explain about 10% of the evolution of the PPI over the period that we cover. Okay, in terms of the literature, so as I said, we are trying to contribute to a very large macro literature, which basically tries to dig into the current situation and trying to understand what are the roots of inflation, both in the US and in Europe, emphasizing the role of demand versus supply shocks. Here, we are going to bring micro price data to this. And I think what is a bit distinctive to in what we do is really this ability to measure both prices and exposure to energy cost shocks. In doing this, we contribute to this literature that is a bit closer to my usual research interest, which tries to estimate the pass-through of cost shocks to prices. So there is a large literature on this in trade, but also in other fields. And this literature is basically like digging into micro price data using shocks and trying to estimate this. So here again, we are going to have a specific focus on energy and the recent episode of the energy crisis. And as I said, we are going to document a strong degree of asymmetry in the pass-through, and there is a lot of literature on that topic in both IO and macro. And so we are also going to try contribute to this. As I explained at the end of my presentation, this is still very much a work in progress. So as I said, a lot of what we do is based on amazing data that we got access to thanks to Raphael. So we have access to the survey that is conducted by the French Statistical Institute when producing the PPI. So this is a monthly survey. We are going to focus on the manufacturing sector. And so the survey is built in a way that firms are first selected from a survey of manufacturing firms. And something that is important is that the survey is constituted so that to have a good coverage of each market, which while minimizing in a way the number of firms that are surveyed, meaning that we have a data set that is very much biased towards very large firms. And this point is important because small firms have been covered by the price cap that the government has implemented, but large firms, to a very large extent, have been exposed to the energy crisis because they either rely on fixed-term contract with the energy provider or are directly priced on spot prices for their energy consumption. So that's how the firms are selected. Then once the firm is in the sample, it's going to stay there for on average 5 years. And then each month, the firm is going to report the evolution of the price that it charges on its main products. I should have a S here because a lot of our firms are multi-products, and on its main partner. So at the end of the day, our sample is constituted of about like 2,300 firms, about 10,000 different products. we are focusing on manufacturing and obviously excluding energy, mining, and tobacco, which is a very small part of the sample. And what is very nice is that we cover data up to end of 2022, so we really have the energy crisis in our data set. So just some very simple stylized facts on the evolution of prices. So this is a distribution of quarterly price changes that we have in our data. In orange is the pre-crisis period, and blue is 21, 22. And as you would expect, so there is a lot of heterogeneity there. We see a kind of shift to the right in the latest years of the sample, so higher price increases, and also a kind of pronounced decrease in the number of zeros here, meaning that the frequency of price adjustments has increased in the latest years. So in terms of the overall effect, so this is just showing the evolution of the mean price adjustment in our data and comparing this with the evolution of the inflation rate. And as you would expect over time, so in the pre-21 period, the statistics are fairly stable, and then starting in 21, the average change conditional on the price adjustment has increased quite a lot on average in our sample. Okay, so that's for the price data. And then, as I said, what is really nice is that we can match this with information on energy consumption. So here we are going to exploit another survey from the French Statistical Institute, which main purpose is to measure energy use for firms in the manufacturing sector. So not all firms are surveyed in both data sets. So at the end, we end up with a bit more than 1,000 firms. But what is nice is that in this subsample, we have a lot of information about energy consumption in real and nominal terms. And we can also observe the mix of energy consumption at the firm level. So this is what we are going to exploit to measure exposure to the energy cost shocks. So the energy cost shocks that we are going to define at the level of each firm and over time is going to be a bit similar to a shift share. So basically we observe pre-sample the composition of energy consumption, the share of electricity, gas, and oil in energy consumption. And then we are going to apply to these shares the mean evolution of prices for each energy type that I already showed you before. And as I have shown before, the evolution of those prices is quite heterogeneous depending on the type of energy, with gas and oil rising very fast and the price of electricity rising as well, but to a less extent. And thus, we are going to exploit the fact that those firms that are consuming or using more gas in their production process are going to be more heavily exposed to the energy crisis. So that's the energy cost shocks. And then we're going to exploit a second level of heterogeneity, which is the fact that firms might be more or less energy intensive. And to control for that, we are going to use a measure of exposure, which is the ratio of energy consumption over variable costs, which we obtain by merging our data with balance sheet information. So this gives us like this firm level measure. So this is just to show you on average across sectors that the energy mix first is mostly explained by the three sources of energy that I'm going to exploit. So basically 99.5% of energy consumption is due to one of those three types of energy, and also across sectors, but this is also true within a sector. There is quite some heterogeneity in the use of basically gas and oil on top of electricity, which is the main source of energy for most firms. The second stylized facts that we recover from this data is the contribution of energy to variable costs, which I think was an important statistic to bring to at least public debates, because in the middle of the energy crisis, there were a lot of debates about firms being strongly exposed to the crisis. So we went to the data And this is what we obtain. So on average, energy contributes to variable cost, contributes to 2.5% of variable cost for the mean firm in our data. But of course, there is a lot of heterogeneity, and some firms are very energy intensive. Part of this heterogeneity comes from the heterogeneity across sectors, so chemicals or mineral products are more energy intensive sectors, but there is also a lot of heterogeneity within a sector. The second is on heterogeneity driven by this mix of energies at the firm level. So again, here what I'm showing is this sort of shift share energy cost shock. And as you can see, again, there is a lot of heterogeneity in our data, both pre and post energy crisis. Of course, during the 2 last years, there has been a shift to the right. So a lot of firms have been exposed to positive energy cost shocks, but there are still some firms that enjoyed a bit of a decrease in the cost of their energy because oil prices have gone down quite quickly in 2022. But again, what is important is there is a lot of heterogeneity. And then when we put together these 2 elements, we recover this shock that is going to be the main variable of interest in the rest. Okay. So from this, what do we do? The first thing is estimating the pass-through of those shocks to prices, and that's the main part of the paper. So in doing this, we are going to be very reduced form. So what we do is estimating this equation that has on the left-hand side the evolution of the price of a particular firm at a particular time for a specific product. And we are going to regress this on measure of exposure to the energy crisis, including some lags to allow for some like smooth transmission. And then we can control for a number of variables. But more importantly, we are going to be able to control for fixed effect at the level of each sector and period, meaning that we are going to recover identification only from the heterogeneity across firms within a particular sector. So this is where it's particularly useful to be able to observe these energy cost shocks or exposure to energy cost shock at the level of a firm. So everything I'm going to talk about is using this sector time period fixed effects. Of course, like identification is challenging in these times for a lot of reasons. Some reasons are due to the fact that we're using micro level prices and those zeros are a problem. Firms do not adjust their price every single month. And this means that a lot of the observations are zeros. I already showed you this here, sorry. So you do have a mass of zero here. And the second problem is due to the fact that this is a period which is in general a mess. There are a lot of common factors. Some of them are going to be controlled for using the fixed effect, but still understanding the pass-through requires to take into account the fact that this is an environment in which a lot of things are changing. So in terms of the first problem, what we do is to combine several types of estimation using either monthly or quarterly data and taking into account the zeros, so using a balance panel, or doing what has been done in the literature on exchange rate pass-through, which is estimating the pass-through conditional on a price adjustment. So basically here, what you do is to look at a given price adjustment and cumulate the cost shocks that happened since the last time the firm has adjusted its price. So at the end, what you will see here is that it doesn't matter whatever the way we treat those zeros, we find very consistent results, which is basically on average full pass-through of the shocks onto the prices. So this is what you have here, the level of the pass-through. There is quite some heterogeneity in point estimates, but the estimation is not super precise. So all of those coefficients are not significantly different from one, meaning that in the data we find a very strong degree of transmission of the shock to output prices. When we have a structure of lags in the monthly panel, we find that there is a bit of a smooth transmission channel, but basically everything is done after a quarter, meaning that there is quite fast transmission of the shock to output prices. So in the rest, I'm going to only use the quarterly data, but again, we did a lot of robustness based on these different ways of treating the zeros. Okay, so that's for the timing. The second problem is that this is a period where firms are all hit by, to some degree, by the energy shock. We do take this into account and exploit the heterogeneity, but in the meantime, there are still a lot of things that happen. And in particular, firms are not only expected to adjust to their own shock, but also the shock of their competitors, of their input suppliers, etc. So this is what we call commonalities. I don't know if the word is well chosen, but basically what we have in mind is that potentially we might underestimate the pass-through because there are a lot of things that are going on. So we try to control for those commonalities, and in the rest, I will systematically control for that using two variables. One is taking the average change in competitor prices in the exact same product market at the same time to kind of control for what competitors are doing. And the second one is a vertical kind of price control that exploit changes in input prices for suppliers of the firm. Okay. And in both cases, we find coefficients that are positive as expected. The point estimate that we recover from the pass-through it decreases a bit when we control for those, but is still not significantly different from 1, meaning again that we still find a strong degree of pass-through for the shock. I need to accelerate a bit, so I'm going to skip this and go to the last piece of micro-level evidence, which is this asymmetric pass-through. So we distinguish between positive and negative energy cost shocks and find strong evidence of asymmetry. So in particular here, you see that we find the pass-through on positive shocks to be complete and a pass-through on negative shocks that is much smaller, 22%, and not significantly different from no pass-through at all. So this is consistent with some evidence, both survey evidence regarding the current period and some earlier empirical evidence that there is a strong degree of asymmetric pass-through. In the paper, we're trying to dig a bit into the reason for this asymmetry. And here in the literature, there are several theories of why the pass-through might be asymmetric. Perhaps the one that is the most familiar to people in macro is really like this idea that pricing is state dependent. And if the profit function displays some asymmetry, then you're going to observe a faster pass-through of positive than negative shocks. And actually, this paper is making this point in the context of the current crisis. In IO, there are a lot of papers arguing that collusion is easier to sustain when costs increase. And there is also a literature that is using models of imperfect information, arguing that firms are going to be more willing to pass positive shocks if they think that consumers are going to interpret these positive price increases as a consequence of a shock to costs in the whole market. So I'm running out of time, but basically we try to test those different stories. And here again, there is still some work in progress. We do not find much evidence for the collusion story, but we do find some evidence that the salience of the shock might be important here. So what we do more specifically is to measure the salience of the energy crisis based on Google Trend data. And then we interact and find that there is a very strong degree of pass-through in those periods in which basically all medias are talking about the energy crisis, and thus everybody's convinced that everybody's hit by a very strong energy cost shock. I have perhaps 2 minutes left or 1 minute left to talk about what it implies at the macro level. And here, I won't need more time because what we do is fairly simple. We have our estimate of full pass-through at the level of individual firms. We observe shocks for each individual firm in our sample. And then we just use this to do some form of back of the envelope calculation. So at the level of each firm, we can say something about what our model attributes to energy for the dynamic of inflation. And then we can aggregate at the level of each sector or the whole economy. And what we can do as well is to control to some extent for the amplifications through production networks. So here we are going to bring input-output data so that we can also take into account the fact that, again, all firms are adjusting their prices and thus all suppliers are selling price increases to their partner, and this induces some amplification. The bottom line of what we find is that at the level of individual firms, we can explain 25% of the observed heterogeneity in inflation rates by basically heterogeneity in firms' exposure to the energy crisis. Okay, so this induces a lot of, basically the energy crisis induces quite important distributional consequences. And at the aggregate level, what we find is on average 9% of the observed evolution of the PPI over 21-22 can be explained by the energy crisis, with of course a lot of heterogeneity across sectors. As I said before, chemicals, mineral products are sectors that are heavily exposed to the energy crisis. But what is more interesting, I think, in this graph is the fact that there is a lot of variance, including within those sectors. So even in the chemical or mineral products, there are firms that were hardly exposed to the energy crisis and some that were very heavily exposed. Overall, we find that 70% of the variance is within a sector, okay? And then the amplification through input-output network is not huge, but this is because we've estimated the pass-through of shocks to suppliers to be only 50%, so we are kind of conservative here. There is a bit of an amplification, but we don't go very far beyond 10% when controlling for those. I'm running out of time, so I'm just going to leave you there and looking forward to the discussion.
All right, so I'm glad to be here. And thanks to Daria for inviting me. I'm a sub, so someone pulled out as a discussant, so she asked me to do this, but this has been really cool because, you know, it's difficult to discuss this paper. It's a really good paper. So that's kind of tricky, but I have just a few comments. So what do they do? In this paper, they estimate the transmission of energy price shocks to producer prices using microdata that runs from Jan 18 to December 22 on French producer prices and firms' energy consumption. And they do find almost full pass-through for positive shocks and less than full pass-through, much less than full pass-through for negative shocks, so asymmetries that we know well from theory and other empirical works. And they study why these might have happened, looking at, for example, competition issues or, situation where inflation is high, you might have a different behavior in pricing in response to positive shocks, an acceleration, for example, of the time at which firms revise shocks upwards, which doesn't happen, when there are negative shocks. But their model, the estimates cannot explain well the moderate pass-through that actually has been observed from 21 to 22 between the energy price spike and manufacturing inflation in France. Okay, so you have to correct me if I'm wrong, because I might be actually. And there again, they study why these might have happened quite carefully. And they say, well, maybe it's the low share of energy and variable cost of firms, a bunch of heterogeneities that, characterize the different sectors. And there's a good discussion of the possibilities that might explain, the fact that they cannot account well for what is observed in practice. So my general comments is that this is, of course, an important policy question. I'm now working for a central bank, so I remember that it's all about prices, not fiscal, like at the IMF. It adds to the recent literature, and there's actually a really neat paper, for example, by Matthias Klein at Sveriges Riksbank with Alhander and Carlson on, it's actually the transmission between PPI and CPI, so it's slightly different, but, the issue of pass-through is, is a permanent interest of monetary policymakers. And of course, there's the forthcoming 26th Geneva report by, a group of great women that is gonna, throw some lights on these issues and looks at the shocks and the mix of shocks and how these shocks might impact pass-through, in a variety of countries and so forth. So this is on everybody's mind because we are in a period of very large shocks. And, we hadn't seen these kind of shocks in a long time, and it's kind of scary. And we see that, going on to inflation and people concerned. So it's politically a very hot topic. So the paper, as I said, is very well organized and it's targeted well at addressing this question. And they use data very carefully. So I have just a few questions. So my first reaction was that the sample used here in estimation encompasses the pandemic and the war in Ukraine. And I think these are different animals. And to some extent, it'd be interesting to understand if there are differences in price setting behavior, not just in the face of energy costs, but really there are a bunch of other things that were very different across these periods. And so treating the sample as a unique, period of behavior is may be a big course. The second thing is about model specification. I have a couple of questions, really, just not comments. And also I'm interested in the relationship of the predictive power of what they do with the INSEE avionic, because INSEE avionic is a model that has been worked on by your PhD student. So it's never quoted and it does exactly a lot of these things. So it studies the distribution from energy costs to producer prices. And it comes up with some numbers. So I was just interested to see that. And then I just want to comment on some EU and French energy markets characteristics that I didn't see mentioned. I think that might be important to account for. So I need to go fast, but so the first point is the general point I just made. Yeah, I just have 5 minutes. So here, this is a chart. I think you showed this chart at the beginning. Is a chart of PPI for electricity and gas. And you can see the big spike is the spot price. So that's the wholesale market price for energy and electricity and gas. And then I think the price you're using for measuring the energy shock is actually the lower thin, almost invisible line, which is the PPI B2B, which is the price that gets of energy sold at firms. And you see there's a massive dichotomy between the shock and the actual price that hits firms. Now, for electricity, it's almost stationary, but if you see for gas, it isn't. And that's where my comment on, the differences in COVID as opposed to the war in Ukraine matters, because there might be a role for dumbing things out or for using interactive dummies in the model and so forth. So that's the first point. Here's the model specification. Isabel explained it very well. So basically in English, it's a price adjustment in period T for product K of a firm F. So how do they change the price? As a function of the change in marginal cost of energy, plus change, which is the first term there, plus changes in other input prices. So this is a bit about the downstream story, upstream story, plus some fixed effects, which are, measures trends. And so the first comment I have is when they compute the change in the marginal cost of energy, they use a non-time varying share of energy E for the sector. Okay, so everything's time varying, but the share isn't time varying. And if you look at the monthly electricity consumption by industrial companies connected directly to RT, this is a database that INSEE uses. You can see there have been huge gyrations in the consumption of energy because companies have tried to save energy or tried, to reduce production. So I wonder whether that assumption on the constant share is, it's something that might be run some sensitivity on. The second thing is fixed effects are time varying. Here's a T subscript there, but it's unclear whether this captures well deviations from demand and labor trends and employment adjustment costs. I come from an era, I'm old, so, we had, as an example, the Rodenberg, structural dynamic model price setting. Then we had Arges Bordone, the end of the 90s. Then we had Gali Gertler, Lopez Salida in 2000. And, we used to have, just marginal costs. And these basically are price setting models that we're trying to address here. And the question is, there isn't a marginal cost and those fixed effects. And I wonder if that is the best way or it's efficient. And finally, I think that these fixed effects could be interacted with a sanction dummy or a Nord Stream 1-2 sabotage dummy. So maybe people, this is a new dummy that we should maybe use, but for France, more generally in Europe, the bombing of Nord Stream created a massive explosion of gas prices at a time when we thought it was over. We thought, in August 2022, prices came down quite a bit. So this is the last slide. So there's a bunch of characteristics in EU energy markets, electricity market, since markets were liberalized in Europe in the 2000s. The wholesale market price for electricity is fixed on the marginal cost of production of the last power plant called on. It's a principle called economic precedence. And so basically the price moves from the cheapest energy used. So if you use a lot of energy, they will start pricing first with the renewables, which are the cheapest. And then they move to nuclear. In France, there's a lot of nuclear. And then finally to thermal power plants like, coal, gas, and oil. And so gas prices wholesale, we saw, spiked a lot. And so, and unfortunately, there was a bunch of other events happening that impeded a lot of use hydro, large hydro, and also nuclear. In France, there was all of a sudden in 2022, a lot of cracks were found in reactors. About 12 reactors out of the fleet of 56 French reactors were found due to, they believe, stress corrosion. So this had to be taken down, and nuclear power production sank by 23% just in the year to August 2022. So, there's been a disconnect between wholesale and not, but there's been a quantity or a supply constraint that was quite severe. And there, Isabel mentioned energy price caps. There have been a lot of policy measures trying to curb, the kind of transmission. Some of that might be interactive when firms were smaller, and which was done, it might have, interacted upstream to the bigger firms. We don't know. But importantly, there's, fixed contracts are not talked about in the paper. And of course, you have a contract for enterprises, that engage in contracts for above like 36 kilovolt amps and gas and suppliers, you will have fixed contracts. So my question is, how do you account for this in the context of your estimation? There's also, France has like actually almost a waiver on EU electricity market wholesale price fixing, which is very specific to France and ensures, a bonus on like a discount because companies can actually access nuclear power at a lower rate under certain conditions. So to conclude, I think it's a great paper. It's asking an interesting question. Maybe my view, just as having read it very quickly, is to think more about possible structural breaks of the sample and characteristics in the electricity markets, and then some isolated events. For a lot of these things, the role of long-run inflation expectation is important because again, the COVID lockdowns versus the war in Ukraine have very different expectation profiles. And, you want to think about that when you're trying to estimate behavior on price setting. So I think thinking of this might help reconcile your predictions, but sorry if this wasn't making a lot of sense, but it was rushed.
Okay, no, thanks very much. Very interesting discussion. A lot of points that, are well taken. So let me perhaps answer on I think the very important question of basically the characteristic of the market and what this means for firms' actual exposure to energy price increases. So it's true that basically in France, at least, so there are three different kind of options for firms. So some are covered by regulated prices. So those firms are not exposed at all to the energy crisis because of the price cap. These are very small firms. And then there are two possibilities. If not under regulated prices, there are firms that have a contract that is basically based on spot prices. So they're exposed to even higher price increases than what I've shown. And then the third possibility is firms that are covered by a long-term contract, which might or might not imply completely fixed prices. This we don't know. A long-term contract doesn't mean that your price do not change, but we know that a number of firms are covered by those long-term contracts. So it happens that in the context of the energy crisis, I think we all realize, at least in France, that we know very little about those contracts and what firms are exposed, etc. So INSEE has conducted a specific survey on firms to learn about the characteristic of their contracts, so that now we know a little more. So it's basically, so they ask firms whether they are covered by spot prices, long-term contract, and in terms of long-term contracts, whether those contracts were renegotiated in 2022, so during the current year, meaning that they would be exposed to the energy crisis at the moment of the contract renewal. So what they show is that 50% in the manufacturing sector, 50% of firms in the manufacturing sector are ultimately exposed to the energy crisis in some way in 2022, and for electricity, and 2/3 for gas. And they show that these are mostly large firms that are the most exposed, meaning that in our sample, we think that a lot of firms are exposed, but indeed, we don't know to what extent, because some are exposed to spot prices and others are going to renegotiate their contract, which means the price is going to increase, but to what extent, we don't exactly know. So ultimately, we might be able to merge our data with the survey. Again, thanks to Raphael, but for now we haven't been able to do so, and we might we are very likely to end up with issues with just the size of the sample. Again, we are not working with tons of firms, so we have a bit of identification issues, but potentially we might be able to also control for the fact that the firm has a contract that is going to renew, etc. Since we cannot as of now, what we do is a bit like conservative. We observe the mean evolution of prices to businesses. So indeed, we are not using spot prices. We use what the electricity providers are saying they transmit to their business partners. And we assume that all firms basically are exposed to this evolution of prices, which creates a measurement error in our data, which we would expect it has a downward effect on coefficients, which is even, in a way, I think, reinforce the main point, which is that there is a very strong transmission, despite the fact that we are not measuring the evolution of prices perfectly. I think the constant share, indeed, what we do is like in the tradition of shift share, in the sense that we are fixing the consumption of energy and the mix to pre-sample period, and then we just let the shock vary due to the evolution of prices. We should expect firms to also adjust their energy mix. The extent to which they can is a bit unclear. It always depends a bit of the technology. So here again, we're kind of conservative. Perhaps there is some additional effect coming from adjustment in consumption. But here we are basically like, just fixing things. Okay, we are not talking about Raphael's other contribution using avionic. Avionic It's one of the models that I don't know why, but the French administration always has fancy names for their models. So avionic is the model of input-output production that is used by INSEE. And Raphael has done some simulations based on this model for what is the impact of energy prices and the energy price cap. I think there is a bit of an issue in this publication, so we are not going to insist on this in the paper, but they are assuming the price cap is applying to the whole industry in France, which we know is not true. So I think, I mean, in a way, it's still interesting to see what is the potential impact of decreasing the impact, I mean, or absorbing a bit the impact of the energy crisis. But I don't know. I mean, we should not take those as a truth, because it's simulation, and simulations that are based on the assumption that there is no transmission at all of the energy crisis to energy prices that firms actually pay. So we are going to keep it like this and not mention this point, because I mean, publishing also within the INSEE is always complicated, because everything needs to be coherent across different publications. And here I think there is a bit of a smaller trick. What else? I don't really, the fixed effect, I'm not sure I understood, but we can discuss. Our fixed effects are not time trends. These are like actual fixed effects. So we are controlling fully as much as we can from the evolution of demand and supply in this particular sector at that particular time. But perhaps I missed something, but for sure we cannot interact with some specific events, because these are already absorbed into the fixed effect. Long-run inflation expectations, that's where the macro people are coming in. I'm sure it's very important. Actually, we discussed a lot, because we did this first for a policy publication, and people were like, you're not explaining much of inflation, so it's not possible. And I was like, who knows, perhaps expectations matter as well. Ask macroeconomists. I don't know. I think it's very interesting questions. Also, I mean, it's a bit related to what I was saying. We are trying to still work on this question of the asymmetric pass-through and what it comes from. And I think it's a very interesting result. Here we are kind of constrained by our lack of knowledge of the macro literature, but we are trying to learn and get feedbacks from people.
Good. Questions? Helen?
Thank you. So yes, very interesting. So I mean, interested indeed on this asymmetry of pass-through. And so you hinted that the salience effect seemed to be something that actually explained it. So are you saying that then it seems to me in the media, we did talk also quite a bit when the price of energy was coming down, but are you saying, so then the salience doesn't play in the same way, or is just that actually the media exposure is very asymmetric? And in which case, you know, we might be wondering whether some lobbies are pushing for the media to cover some developments and not others. I mean, I think this opens the door to a lot of interesting issues here. So I wonder if you could say a little bit more about that.
Monica?
Yeah, same here. Very super interesting. I especially thought this comparison with the competitor price change is extremely interesting. I thought, could you do more here and look at firms that do not change their prices as their competitors do, and just look at their characteristics, like who is not moving with a herd, especially during time periods where this is already salient, or is everybody moving even, you know, everybody is changing their prices when this is salient, and then when it's not salient, some are not moving with their competitors. Can you say more about that?
Okay, so I'm going to start with the last question. So, I mean, we try to do a lot of things on heterogeneity across firms. I did not have time to talk too much about this, but at the end, results were a bit disappointing. And I think here we are kind of hitting the limit of what we can do with the sample. So we as you saw, the estimates are not super precise because we don't have a lot of firms. And so in particular, we pushed a lot trying to see whether some firms were passing a larger share of their cost increase. So in particular, at the beginning, you would expect that firms that are more exposed should pass more, and firms that eventually are not that exposed can take the benefit of this particular moment to kind of compress their price. We did not find any such heterogeneity. But we also think that potentially it's because we don't have enough data and enough power for identification of those. So the only thing that is somewhat coming in terms of heterogeneity is along the size distribution. We find that large firms pass a larger share of their costs, which is not necessarily what you would expect either, because you could expect that the large firms are taking also this opportunity to increase further their market share. That's not what we have in our data. But again, even for this, the problem is that we have this sample that is very much biased towards very large firms. So it's not clear that even the intuition that we have are still correct in this type of environment. So I think, these are very important points. We tried and we did not get much. The salience on Hélène, we think it's an interesting point, an interesting result. And the reason why we started thinking in terms of this type of models is that we argue there is a lot of heterogeneity. So we've heard a lot about those big chemical firms in Germany that were complaining that they were very much exposed, etc. But then when you look at the data, first, very much exposed means 10-15% of your cost, which is a lot, but again, we are not talking about like a change in, I don't know, wages that constitute a much larger share of variable cost. And the second thing is that even though these firms might very well be highly exposed, there are competitors that are not. And so we thought that this heterogeneity was interesting to dig into. Again, when we looked in the data, we did not find heterogeneity depending on your exposure. And this might be related to the fact that although there is strong salience about the fact that there is a shock, there is no way you can learn about what is your supplier's exposure to the shock. So basically everybody can pretend to be this very large chemical firm, BA, whatever, and to be extremely exposed because they have this technology that involves a lot of gas, and then they can pass they can pass more than 100% of their own shock because the shock is very salient, and everybody would interpret an increase in prices as being a consequence of the shock. So this is why we think this salient story is interesting in this particular context. But indeed, then you would expect that the same is true when prices go down. So this is an interesting point. I haven't thought about it too much. I don't know. In our period, the decrease in prices is at the very end of the sample. So I would need to check whether we have some periods in which we measure the salience as being large in those periods as well, and try to think about this. I think it's a very interesting question, but perhaps there is an interaction between this salience and competition arguments. And in that case, you would have an impact that mostly kicks in when prices go up. I have no idea. It's just that when you go to a bakery in France, they are going to argue we've increased the price of the baguette by 20 cents because of energy prices. And then you say, how possible it is that everybody, all bakery are supporting that high cost increase. So I think, anecdotically speaking, this salient story makes some sense.
Good, thanks. Then it's time for lunch.
session is better. So we have a very exciting session. So we should get started. The session is on green finance, and the first speaker is Monica Piezzesi from Stanford. She will be talking about household climate finance, and the floor is yours.
Thank you very much. Thanks a lot to the organizers for bringing us to an amazing location. When I, many years ago, as a PhD student, I attended a conference that Nicoleta also attended. We were in Florida, and this was a conference organized by John Taylor about monetary policy. And I thought, I need to work on monetary policy because this is the type of location that I want to be in. And so I feel the young women in this audience probably think I picked the right topic. So here, this is joint work with Shifra Arendine, who is a PhD student in our department, Johannes Beudel, who is at the Bundesbank, and Martin Schneider, who is my colleague. The question we want to address in this paper is, can financial markets somehow help or accelerate even the transition to the green economy? We want to have some idea of how important this channel is, maybe also because we're based in the US, where I don't have much hope for other channels. So I'm really hoping that this channel is working. And so what we do in this paper is we provide new micro evidence and a quantitative asset pricing model with heterogeneous agents. We measure the taste of households about green finance, and we measure their expectations about what they think green assets pay them. We measure also their actual green asset holdings. So how much of their portfolio do they already hold in green assets? We measure their other asset holdings, characteristics like age, income, and overall wealth of the household from a representative high-quality Bundesbank survey of German households. So think of this as similar to the SEF in the US. So it's a high-quality survey that measures financial positions. And on top of that, we were able to ask questions about taste, expectations, and their green holdings. And then we were also able to do some randomized control trial treatments that provide some information to subgroups of this survey. And then we could see how they respond to the information that we provide. So one of the type of information that we did was we explained risk-return trade-offs to them. We also explained to them that green finance may play a role, and then we wanted to see how do households respond to that. And so in the counterfactuals of this quantitative model, we can investigate whether tastes, expectations matter and how people react to this type of information that we provide to them. What we find is that green assets, investments are already popular in Germany. So 1/3 of households already own some green assets. The green assets are mostly risky. So they're equity, there's also some green pensions, there's also some green long bonds, but it's mostly risky assets. While in the portfolios of Germans, bank deposits play a major role. So half of wealth is invested in bank accounts, and green deposits are still a niche market in that space. There's important heterogeneity in green taste among German households throughout the wealth distribution. So it's not just that your university student is has a strong taste for green. It's also very rich households that have a strong taste for green. But also, it's not all positive. It's also negative. You have a very substantial portion of the population that has a strong distaste for green. So in terms of thinking about convenience yields, so what are your non-pecuniary benefits from holding green assets? Those range from positive to very negative. Hedging demand. So if you think about the demand for green assets that only arises because people buy them to hedge climate concerns, again, those range from very positive to very negative. So you have everything throughout the wealth distribution. Yes. It's exact. This is a great question. So by the way, I don't have a discussant, so I'm relying on you to clarify any questions that you have. Yeah. So let me repeat the question. How do we know that what these green assets are? We provide some information I'm going to show you later as to what a green asset is, but it's mostly self-classified by the household. So the household announces they have green assets. It's that they think those assets are green. So we're going to use everything through the lens of what the household thinks. In terms of decomposing the current relevance of sustainable investing in these model counterfactuals. If you look at just taste for green assets on net, actually the prices of green assets are lower in the are lower right now because of this taste. And I will explain you exactly why. The intuition that I had coming in was that, oh, if people have a taste for green assets, those green assets are going to be valued more. Actually, the opposite is happening. In terms of attention to green stocks, the fact that now people are distinguishing green assets from other assets, that's not just about taste, but also about beliefs. So you now have different return expectations from other more traditional assets, and that increases the prices of green assets. So it's mostly the combination of the two, because just taste lowers the prices of green farms. And so this combination of distinguishing these assets, that generates a greenium in the model. So a return difference between traditional assets and green assets. So traditional assets generate more returns in this model due to these effects, due to this attention.
That because of the negative taste.
Yeah. So you're already exactly. So this is exactly what I'm going to show you, is that there is strong enough negative taste for green assets that is actually lowering the price of green assets. And then I'm going to show you counterfactuals that look like there is a chance for green finance to really play a role. One is when we introduce a green safe asset into this world, into our quantitative model, there's such a big demand for it that would substantially boost green investment. The second is if you, in our information treatment, we explain that green finance can play a role, and people react to it so dramatically that really increases green investment. So here is a chance for green finance to help with the transition. Let me show you the type of information that we're gathering from households in the survey. So first we show respondents the following information. We say some banks offer green savings accounts that guarantee that your deposits are used to fund green investments. Imagine your bank offered both traditional savings accounts and green savings accounts. And then we showed them a sequence of interest rate spreads. We say, here's a spread between the traditional and the green bank account. For example, the interest rate on the green savings account is 2% lower per year than a traditional account, or just 1% lower per year, or 0.5% lower per year, or it pays the same interest rate, or it actually pays more than the traditional account, and so forth. And so then we ask, in which case would you choose the green deposit account? And then we classify households by their convenience yield for the green bank account, so how much interest they are willing to give up. So this is the highest spread between traditional and green, at which point they still choose green. So they're willing to pay, give up in many cases, or they want to be paid. So I'll show you the distribution. So here's the distribution. This is wealth weighted. So this is convenience yield from -2%. So these households want to be paid versus giving up to 2 percentage points for having a green bank account. And so you see this is a wide distribution, and it's not just positive, it's also negative. So you have people here, initially we thought maybe they're misunderstanding the question. No, actually it's quite strongly correlated with their other characteristics. For example, it correlates strongly with voting for the AfD in Germany. That's this population. And it correlates very strongly with the survey asks, what is the number one concern about the economy that you have? If you answer your number one concern is climate change, then you're most likely to be in the right side of this distribution. Or if you're more educated, actually, I can say to this crowd, if you're a woman, you're more likely to be on the right-hand side. So it correlates with exactly the characteristics that you would think it correlates with. Then we thought, oh, we can actually construct a demand curve for these green deposits, because we also measure how much deposits these households have together with their convenience yield. So what this plot does, it shows you for every cost of having a green bank account. So these are in basis points. Either you have to pay 2 percentage points or you get paid 2 percentage points by owning a green bank account. If you add them all up, you see that even if the two bank accounts pay the same interest rate, 75% of deposits would be in green accounts. So it's a substantial demand for these green accounts. And then there are these households who need to be paid in order for them to accept a green bank account, while there's a substantial demand at interest rates that are, which indicate that they're willing to give up interest. And then we also wanted to know about green risky assets. So we first explained to them, and so this goes back to the question of Victoria, but how do they know what these green assets are? So we explained to them equity funds consist of multiple shares that are managed by a professional fund manager. In contrast to traditional equity funds, green funds invest more heavily in enterprises that operate in a comparatively climate-friendly manner. So this is the definition of green that they're getting, but it's mostly sort of their own ideas of what it is. Then we asked them to tell us what kind of returns do you expect over the next 12 months of the traditional and the green equity fund. So here we ask for a numerical value in percent. And then we also wanted to know about the risk, but it's very tricky to ask households, what do you think the standard deviation of the return? So what we did is we asked them, if you had to rank the risk of a traditional fund relative to a green equity fund, would the risk be significantly lower, somewhat lower, roughly the same, somewhat higher, significantly higher? So that's the risk question that we asked. And then we looked at the answers. I was prepared to see everything, but actually 82% of households have a reasonable risk-return trade-off in their heads. They expect to make a higher return of the investment that is riskier. And in fact, when we did a randomized control trial where we explained to households what risk-return trade-offs are, they did not change their response. So that group, the treatment group, did not look any different from the non-treated groups. So households don't seem to adjust their answers once you told them about risk-return trade-offs, and that is because the vast majority already has that in their expectations. In terms of the wealth-weighted expected excess returns, on green, households are expecting to make over the next year 7.6%, and on traditional, 8.6%. So that leaves an 80 basis point gap, which is exactly what, if in theory, you would expect that green equity would have a lower expected return. And so the 80 basis point greenium, I view that sort of as consistent with what I would expect as an economist. So I'll show you the model, and then people have some convenience of holding these green assets. They also there's a hedging motive, and the things that we measure are consistent with this 80 basis point. So it's going to be consistent with the quantitative model that I'm going to show you.
Monica, just a quick clarification. What is a green savings account?
So the way we phrased it is we wanted to control for risk. So we said your bank, so imagine your bank, instead of offering you a green traditional savings account or deposit, it's a deposit account, offers you a green account. So the idea was to hold risk fixed and to just ask what is the interest rate that you're willing to give up? And it's a safe, nominally safe asset, but what is the interest rate that you're willing to give up? Anything?
So I have a question because there exist already ethic banks that they tell you that they are like investing and they have safe deposit, that they're investing this in green firms, in green projects. So why do you think, what is preventing these people to actually take their money into these already existing banks?
Yeah, so one answer would be that maybe these banks are not known names. So the typical bank that offers these accounts, so we were Googling, like, where could we open a green bank account? And so the names of those banks, I have never heard them. So it's not Deutsche Bank or, it's not the standard big nationally operating banks that are offering these accounts. And so there may be concerns about risk. There may be concerns of greenwashing. I don't know what it is, but there's something that is preventing households from choosing the existing products. Okay, so here, again, we asked them about expected return and risk. Then we also asked them about the following hypothetical investment question. We say, imagine you've saved part of your earnings and wish to invest this money in an equity fund starting today. Would you rather invest it in a traditional equity fund or a sustainable equity fund? And so then those answers are actually very revealing because 18% of households choose equity funds that they believe are, according to their own answers, they're dominated in a mean variance sense. So they pick green, even though they think that those funds don't look attractive. And so, the other fact is that more households choose the dominated fund when they believe that fund has more risk in it. So for example, households who judge traditional funds and green funds to have the same risk, 24% choose the green fund, even though they believe that's the less attractive fund because it has higher risk. Among households who think that green equity funds have higher risk, 42% choose it, even though it has the same or lower expected return, according to their own beliefs. And so this is very interesting. It's the same is going on for households who choose the traditional equity fund. So there are households who choose to answer that they would put the savings into the traditional fund, even though they believe that the expected return and risk trade-off is not attractive. And so that tells you that there's something else going on in their investment decisions. There seems to be some extra motive for these types of investments that scale with risk because they make it more when they believe it's riskier. And so that would be consistent with hedging demand. So some households may have positive hedging demand, so they hold green assets, and not because they think that those green assets have great expected returns or are so safe. It's because they have a hedging demand to hold these assets. So you would hold green stocks, for example, if you think that there's a chance that we're going to have a very fast climate transition, then those stocks will do well. So you choose them not because you think they're safe or have high expected returns, but because they insure you against that state of the world. Similarly, you might have a negative hedging demand. So if you think equity funds are great, green equity funds are great, but you don't choose them. Instead, you choose traditional equity funds. Then what does that mean in terms of your motives? You may be worried that we're not getting there in terms of the green transition. Maybe there's political backlash. We're not going to have a carbon tax. And so then you think about your portfolio, you think about those traditional stocks, and you think maybe I should choose traditional stocks just because it hedges me against this risk that we're not going to have those green policies in the future. And so that's negative hedging demand, tilting away from green. And so this already shows you direct evidence that there's something going on of people to this question, choose traditional, even though they think traditional stocks have bad risk return properties. And so that's direct evidence that something is going on in the minds of these households, which you cannot explain by typical mean variance analysis. And so this suggests that they have some hedging demand where they choose these assets for different reasons. And so let me
put this, so now we have answers. We know what they're expecting. We know their risk attitudes. We know this convenience yield that they're willing to pay for having this green bank account. So let me analyze this from the lens of a model that we can then estimate and do counterfactuals with. The model is very simple. So it has different households that maximize utility. The utility function has a unitary elasticity of intertemporal substitution. So over time, you have a unitary elasticity, but then it's Epstein-Zinn. So you have a coefficient of relative risk aversion, gamma, which may be high. So you're risk averse towards gambles across states of nature. And so you're maximizing this expectation of a function of your effective wealth tomorrow. And so let me go through this slowly. So you choose consumption equity investments in traditional equity, green investments in green equity, traditional bonds, green bonds, and that all has to sum up to your initial wealth. And then tomorrow you get some returns from these investments. The returns are scaled. You already see there are two taste parameters here. Theta, which multiplies all the green returns. And so this parameter theta captures this convenience yield, the fact that people seem to be receiving a non-pecuniary benefit from holding, let's say, a green bank account that we can measure directly. The other feature of this is the preference shock age, which shifts marginal utility for non-pecuniary reasons. So you get utility out of effective wealth. This effective wealth is multiplied with a random variable age, and log of age is a linear function of the log return difference on the traditional versus the green fund. So it's relative performance of these two funds, and that's exactly is a way to capture these hedging demand for stocks. Let me go through this slowly. So basically this age creates a reason for you to hold an asset because it insures you against certain states of the world. So for example, if you're a positive eta person, so if your slope coefficient here is positive, then you have low effective wealth. See how the age multiplies the returns on savings. So your effective wealth is low if you're a positive eta person when green equity does well, because green equity is here. And so if this is a positive coefficient, that means low age, low effective wealth. How do you hedge against that state of the world? You hold green equity because it does well in that state. Opposite, if you are a negative eta person, then you have low effective wealth when traditional equity does well. So if this return here is high, if this coefficient is negative, it drives down your effective wealth. How do you hedge against that state? Well, you choose traditional equity as an insurance asset. So here the question is, how do you introduce something, a motive for you to hedge tomorrow states of the world that have to do with the climate transition. And so here this is captured by the difference in these two returns. So this is the model. Yes.
Is it similar to saying that agents compute expectations different? Like they see the RG and the RT, no, how do you call them? Yeah, RG and RT as, because you allow them to sort of perceive different means.
Yes. So whatever financial, so we ask them about the financial returns, whatever financial returns they're perceiving, they maximize utility as if they're receiving, let's say, if you're a positive, more higher than one theta person, you perceive that you're receiving more return than the financial return that you're expecting. So that means you're deriving some non-financial benefit, non-pecuniary benefit. It's like money holdings. You hold money because money is not because it has such a high interest rate, or it has in fact zero interest rate, but you hold it because it gives you some pleasure of holding it, and that's the theta.
Okay, so you don't allow them to have different beliefs about the return of green and not green.
They do. So in fact, they do. They have different return expectations for equity, not for safe assets. We can actually see what the safe return is that they're getting on their return, and that's safe. And then we multiply it by theta because that's the amount of return you're willing to give up on a safe asset. And the question about bank accounts measures that directly. So we have directly a measure of your theta. So that's exactly how we map observables to model parameters. So many parameters come directly from the survey answers, like the convenience theta. That's from this interest rate, how much interest are you willing to give up? We have the expected return on equity. We also see their actual portfolio weights on green and traditional equity and their overall financial wealth. And then we have these qualitative questions about risk and also their hypothetical investment question. And so I could spend the rest of my time talking about how we pick those from, but there's an estimation and there's a paper on my website that you can see. So let me summarize how this baseline look like and then jump into counterfactuals. So how does the baseline equilibrium look like with these estimated parameters? If you look at households' aggregate demand for assets, it's actually mostly explained by just myopic mean variance optimization. Given the beliefs that they have, that's in aggregate, basically explaining their aggregate demand, with an important role with what Maria Sunda was already guessing, some important role for negative hedging demand for green assets. So people on aggregate move away from green equity because they have negative hedging demand. How do you make an equilibrium out of this demand side? We don't have much information about the supply. So I'm going to show you two scenarios. A scenario in which the supply is perfectly flexible. So think of this as sort of giving you information about the medium run of this economy, where the quantity of investment or the capital stock of the economy adjusts without adjustment costs. Prices stay the same and just supply adjusts. And the other extreme is think of the short run, supply is fixed and then asset prices change in equilibrium given the payoff expectations of these households. So I'm going to show you both. Yes.
So stepping back, so if we didn't have climate situations and I could call green emerging markets. So this was like choice of household and investing in just advanced economy assets versus emerging markets. I mean, what am I trying to infer here is a preference for some societal, like I want to help emerging markets. It looks, you could actually reconcile the whole choice just by standard, risk return stories.
So these choices you cannot explain just with risk return because they seem to be willing to give up interest just to know that they're investing their money in a green account.
But you said, yeah, so that's cool. But you said that if people believe that there'll be a transition, so they're taking a bet on future returns.
Yeah.
So now, the historical return might be lower. I'm ready to give up money now, but it's because I'm expecting a big return later.
That's one possible explanation for why they answer the survey questions in the way they. So in the survey, we see they are choosing dominated assets. Theory gives you one option to model this, which is to say they're not investing in these assets because they're so attractive, but they're using them to hedge. And so I'm estimating these hedging demands by estimating how big your ADA is, if you're a positive ADA person or a negative ADA person. Helen.
Oh, thank you very much. So I wonder if you cannot go a step further and if you are hedging, I mean, there is a link presumably between their consumption and their portfolio. So if they like green portfolio, maybe they like green goods.
Yes,
green consumption
this
goods.
is a great question. Yeah, we don't have that information. It would be great. So this survey does not have information about green consumption. It would be great to know. I mean, we do have other information, like we have their political party, we have so they say what they voted on in the last election. They say whether their number one concern is climate change or some other concern, like all the the negative convenience yield people, many of those answer that their number one concern is immigrants. Like, you can imagine the correlations.
Right, but that would be great because
yes,
also not only consumption, but you could see whether it's also, or it's through their, the industry in which they belong, like their wage.
Yes.
So
here, exactly. So this is what exactly we had in mind with these hedging demands. There's reasons to hold green or traditional assets that has nothing to do with their financial returns. It's just that you happen to live and work in an industry, like you're a coal miner. What would you do? You would use, green assets to hedge. And so that's exactly the ADA that we're estimating. And so this is unmodeled. We don't have all this detailed information about these households. So you could imagine different reasons for why people hedge. And it's exactly their professions, their concerns about how the political situation is going to develop in the future and things like that.
When did you do the survey? I'm wondering whether this hedging demand is capturing concern about energy prices, because in Germany
Yes.
was a very heated topic.
Yes.
I was to begin with a bit surprised that in a survey you could find evidence of hedging demand.
Yes.
So that could play a role, perhaps.
No, the survey was was before the pandemic, so it was right before. So we did not have a war with Ukraine yet. Okay, so let me. So we have these two scenarios: perfectly fixed supply, perfectly flexible. And so now I can do counterfactuals. And so I can, first of all, show you what happens when you shut down all green taste. So no convenience yields and no hedging demand for assets. The intuition from a representative agent model would be, well, if the representative agent doesn't have green taste, then you would think that green equity values decline because the taste can only increase demand. Here you have a heterogeneous agent model, and it matters here who chooses to hold these assets in the counterfactual, because some agents will stop holding green when they no longer have a convenience yield. And so the question is, what is the population that holds green in the counterfactual? And so we recompute household demands at fixed prices. So this is the completely flexible supply of asset case. So without green taste, green investments actually increase by 30%. So it's a substantial increase. Traditional fall by 10%. Overall, the population of people who hold these assets in the counterfactual likes to take more risk. And so there's many different effects. For the sake of this presentation, the key effect is exactly what Maria Assunta was intuiting early on, is there's a very strong negative hedging demand for green assets. So people who are concerned that there's going to be, green policies in the future will not be enacted. They're worried that these green stocks will not perform. And so what they do is underweigh green stocks relative to their expectations about the return. And so that's the key effect here. So green, if you shut down this taste, green investors, you unleash them. They're very optimistic about the returns, and then they invest more. So taste here holds things back. When you compute the equilibrium at fixed supply, then the price of green stock suddenly increases by 50 basis points. The price of traditional stock decreases. So there's more green demand, less traditional demand. And so without this negative hedging demand, what happens is that you get a greenium of 70 basis points. That happens, and so that lowers green's firm cost of capital. So in the counterfactual without green taste, green firms face a lower cost of capital. So right now, taste holds back green investing. What helps green investing is the following. There's not just this taste aspect to investing, but there's also the perception of these assets. In the old days, we didn't pay attention to emission scores. These stocks were indistinguishable. Now they're distinguishable across different new dimensions. And so now you have expectations about assets that are not perfectly correlated. And so what if households didn't distinguish these stocks? You can do in the baseline, you have these beliefs about these two stocks in the model. They have some returns. You have a taste for green. Now you have a counterfactual in which you're only investing in one stock. And so then we assume that everybody treats this one tree as a traditional tree with traditional expectations, no taste for this tree. And also what happens is that the value in the counterfactual, the value of the stock market declines by 80 basis points. So the equity premium rises by 80 basis points. That's because if you have taste and expectations about two assets, then it's like buying fruit baskets. If you're the kiwi investor who only wants kiwis and the other person is the apple investor and only wants apples in the fruit basket, and the only thing you have is one basket that you buy, the price of that basket is going to be lower than the price of the individual baskets that only have kiwis and only have apples. So in the counterfactual, the value of green stocks fall by more than the traditional, and that means that sustainable investing, distinguishing these assets, opens up a greenium of roughly 1 percentage points. So this goes back to the question, what do you expect theory? Why do you say theory can explain a greenium? It's because of this counterfactual. Yes.
Hi. So this is very interesting because we have stocks that maybe are added into ESG funds and remove, no? So is it true that this is something you could check, no? That stocks or companies that get into these indexes, this would say that they're hurt, right? This is what this suggests.
Yes, exactly. But distinguishing ESG from other funds actually helps both, and more so the green, because there's some green taste and some optimism about green stocks. And so it's better to trade these in different indices than to combine them. Exactly. That's what this model says. And so one could look at data. Let me show you another counterfactual. So there are two counterfactuals. I have very little time. I'm going to show you two counterfactuals, kind of race through them. One is introduce a safe asset, green safe asset into this economy. I know, we can introduce that asset with different interest rate, and the households that have a large enough theta and large enough convenience yield will choose into this green asset. So now we have to be careful because having this green safe asset is going to affect expected excess return on equity because you're now subtracting off of whatever return you look at, you subtract off not just the green interest rate financial return, but also the convenience yield. So you're subtracting off less. So that's going to lower expected excess returns. So the worry is, do you introduce a green asset and suddenly nobody's investing in green equity anymore? And so this is how this looks like. So here, this is introducing as a counterfactual into the model the green safe asset at different interest rates. So here, there's no green asset. Solid means safe. Transparent is equity. So right now in the baseline, all of the green assets are essentially risky equity. And a lot of people hold traditional safe assets. Now you introduce the green safe asset and have people pay 2 percentage points for it. Not many people want that, but still some people migrate. This is the solid shaded area. Then you make it cheaper to have the green safe assets, and suddenly at zero spread between the green and the traditional interest rate on a safe asset, you now have the situation that green investing is much larger, and actually green equity investing is not much smaller than in the baseline equilibrium. So you're not hurting the green stock market by introducing a green safe asset market, because this is a different type of households that are now choosing to have green safe accounts. They're very risk averse. They don't like having risky assets, but they are happy to hold a green safe account. The other counterfactual is we provide a subset of individuals this information. Sustainable equity funds can contribute to climate protection by encouraging enterprises around the world to operate in a more climate-friendly manner. So we just show this. So basically, this is just showing there's green financial products. This may contribute to, operate enterprises to operate in a more climate-friendly manner. Households who see this believe that expected return on green equity are 1.6 percentage points higher. And this effect, this average effect, is entirely driven by households whose number one concern is climate change. So the respondents in the survey that already believe that climate change is important, you tell them sustainable equity funds can help. They increase their expected returns by 4 percentage points. And so suppose you do a counterfactual where everyone who's concerned about the climate change in your survey receives this information. Suddenly, in the counterfactual in terms of aggregate portfolio weights, the share of green equity doubles. So this is another huge effect that you can have by just explaining people who already are concerned that this may really help. And so you see how cautiously this is phrased. It can contribute to, you just explain that this may play a role, and you unleash them. They go for it and they invest in green equity. Okay, so let me stop here. So what I showed you is it's already popular. Right now it's basically all risky and not safe green investments. There's huge heterogeneity. You have to pay some people to have a green bank account. And there's also hedging demands. And these hedging demands turn out to be really important because right now in the equilibrium, a lot of people tilt away from green because they are worried about investing green, because they're worried about future states of the world where we're not going to be so green. And so in which these stocks will not do well. And then in terms of green climate finance, introducing a green safe asset is, from the counterfactuals, a good idea because it's not reducing green equity investments and it's just exploding these green safe investments, and just in providing some information to people who are already concerned about climate change, that this may help, unleashes them. And so I'm overall more optimistic that this has the chance to do something. Thank you.
Thank you, Monica. Since we've had quite many questions during presentation, then we can move to the next paper. That's Maria Assunta Giannetti from Stockholm School of Economics, and she's gonna talk about glossy banks.
Thank you for having me.
And maybe given that now we have discussed, if we can have just short clarifying questions during presentation and then questions at the end.
Okay, so thank you for the invitation. This is joint work with Caterina, who is sitting here, Martina Yasova and Maria Lumiotti. And since Caterina is at the ECB and we use the ECB credit registry, the usual disclaimer applies. These are our views and not the ECB views. So what do we want to do in this paper? In the policy debate, the regulation of environmental and general sustainability disclosure is currently a hot topic, and this is true both sides of the Atlantic. The SEC is discussing it, but this is a hot topic also for the European Commission and at the European Central Bank related to banks disclosure. And the main concern is the extent to which these disclosures are indeed credible. By discussing more about their environmental sustainability, banks and more in general firms can just create a reputation for being environmentally friendly, and perhaps they can just strategically disclose a subset of their policies that are indeed more environmentally friendly, but they might hide and obfuscate the more opaque part of their portfolio. So what we do in this paper is basically asking whether banks that in their disclosure try to create a more more of a reputation for environmental sustainability are indeed lending in a way that is coherent with what they say. And we are not saying that they are lying. We mostly think of strategic disclosure of positive part of their business that might not be reflected in their lending activities. So in order to answer this question, we start collecting the investor report and sustainability report of large systemic euro area banks. And then after having performed the textual analysis, we relate what the banks say to what they actually do when they extend new loans to borrower. And of course, we will have the challenge to classify borrowers based on whether they are a borrower or green. I will get more into the data in a moment, but we will use different methodologies. And having done this enormous data effort, basically, we arrive to the conclusion that these banks are mostly overemphasizing their climate goals and environmental credential while lending to polluting borrowers. In my presentation, I will have basically 2 steps. I will first talk about our analysis of the bank's environmental disclosure. And basically what I will have to convince you that we are capturing more than noise, that we are capturing actual statement that the banks are doing about their environmental policies, and that these statements tend to enhance the bank environmental sustainability reputation. And then we will go to Anacredit, and we will use data that are new loan issuance to explore which borrowers are being financed by banks that are disclosing more about the environment. So of course, there is a literature both about the disclosures and about the environmental commitment of banks, but to the best of our knowledge, we are the first to actually look into environmental disclosures. And I would say that one of our important contribution is that we are among the first to use credit registry data and to go beyond the syndicated loan data. And as you will see, this is very important because syndicated bank loans have features that are very similar to those of the bond market, are to very visible borrower. Anyone can be aware of these loans. While when we consider loans to medium-sized small firms, that's an opaque part of a bank portfolio, and it is important to know whether what banks are doing when no one is watching. So our main data source is, again, Anacredit. And in all the empirical analysis, I will not focus on past exposure, but I will look at new loan issuance from a bank. And we created our data set on newly issued bond, newly issued bank loans that started in 2014 and arrives to 2020. Then we will classify these borrowers as brown or green. And as you know, as is also important in this policy debate, this is very hard. So our strength is having a credit registry and to observe basically all borrowers of a bank. So we want to try to use this wealth of data. So in first approximation, we classify borrowers using industry level emission. We obtain from Eurostat emission at the industry country level, and then we classify some borrowers as being brown if they are in industries that in their own country in that year, they are in the top quintile of emission. However, we know that this is scores as you were noticing also in some presentation before, there is a lot of heterogeneity between the borrowers in an industry. So in order to complement what we do with the industry level data, we have two different approaches. One is something that you find in basically all papers that consider brown borrowers. So that is for a sample of very large borrowers like anyone else, we are able to observe scope 1 and scope 2 emissions. So we replicate our test considering these very large companies in the euro area. We try to do better though. So for many borrowers, we are able to observe a business description from Capital IQ, a commercial data set. And then basically we perform a textual analysis of this business description using the European taxonomy of green activities. So basically for some 150,000 borrowers in the euro area, we are able to identify borrowers that according to their business description are to be considered brown. And then we repeat our test in this subsample of borrowers that is not the super large borrowers like when we use scope 1 and scope 2 emission, but is of course smaller than the whole population that we can use with industry level data. So let me, and then we use other financial data, but those are more boring. So let me get to the textual analysis. So our sample includes about 100 banking group within the euro area. And if we consider subsidiary, we have over 500 banks. For all of these, we download investor reports, and then based on a very narrow dictionary, we identify in which part of the reports these banks are discussing environmental issue. To be clear, in our dictionary, we don't use a generic words like sustainable or just environment, but we use very specific words like oil, renewable, gas, carbon, and so on. So what we observe is that these environmental disclosure during our sample period on average have been increasing a lot. So are we just capturing noise? What are the characteristics of a bank's environmental disclosure? So what do you observe is that taste matters. We observe that banks that are headquartered in countries in which there is more attention to social environmental issue are disclosing more about the environment. We don't observe much relation between the environmental disclosure and the financial characteristic of the banks. But another reality check is that banks that are signatory of initiatives that aim to provide more information about the bank environmental impact are indeed disclosing more. And this is what you observe here with these GRI banks. What I consider more convincing of the fact that we are not just capturing noise is that banks' environmental disclosure are positively related with the bank's ESG ratings. We know that ESG rating agency typically read the environmental disclosure in order to come up with ratings. So it is important that this correlation is also in our data. And if we look at whether environmental disclosures are related with activities of the banks that any one of us can observe, for instance, the bank involvement in green bond issuance, well, we observe that there is such a correlation. There are other features of bank environmental disclosure that you might be interested in knowing. So for instance, the banks that disclose more about their environmental sustainabilities are banks that have in the past lent more to companies in brown industries. So in this graph, we are plotting the extent of environmental disclosure on the y-axis, and on the x-axis, we have the proportion of the bank portfolio that we classify as having gone in the past to borrowers in brown industry. So this reveals that there might be some pressure from investors or just from the press to do something. What we will look in the empirical analysis is not the past that can well derive by specialization, but controlling for demand, we will look at who is getting new loans. Another aspect that of this environmental disclosure that I like to emphasize is that the environmental disclosures have a positive sentiment. We perform textual analysis, and we basically show that the measure of environmental sentiment captures that these environmental related words in our dictionary are generally associated with words that in financial statement have a positive sentiment. So what this indicates is that these banks are not just saying we are hugely exposed to climate risk and informing their investors. The disclosure has positive sentiment. So let's look at what high environmental reporters are doing when no one is watching. That is, we look at the amounts of new loans that a given borrower is getting from a bank during a year. Okay, and our variable of interest is whether we classify the borrower as brown or not, according to the methodologies that I described before. And then we ask whether these brown borrowers get relatively more credit from banks that we classify as high environmental reporters, meaning that during that year they are in the top quintile of disclosures among the banks in our sample. Of course, to whom a bank lends reflects the specialization of a country and more in general, the demand for credit. So in all of our tests, it's important to control for these demand shocks. And we do so in two ways. First, we use the usual quasi-mean methodology, and we interact firm and time fixed effects. Now, since we are looking at new loans, we think that it is particularly important also to allow for different methodologies and control for demand at the cluster level. That is, we allow demand for credit to vary between industry, country, and year. We absorb a demand for credit at the cluster level, and then we ask whether a high environmental reporter are sending less or more new credit to these brown borrowers. So if banks were doing what they are saying, what we would expect is that the estimate on the coefficient B2 is negative. That is, banks that are discussing their environmental credential should, controlling for demand, extend less credit to polluting borrowers. What do we find? Well, we find, if anything, evidence of the contrary. That is, banks that are disclosing more lend relatively more to borrowers that are in brown industries, controlling for the demand for credit. And in the last two regressions I am highlighting, we are using interaction of firm and time fixed effect, but we could use in alternative interaction of industry, country, and time fixed effect. Now, this reputation could be coming from the fact that, well, the banks continue to lend to their past brown borrowers, but perhaps they are also going out of the way to fund borrowers in a green industry, to fund the transition to a greener economy. Here you see a first test in which we perform basically the same analysis, and we test whether these banks are lending relatively more to green borrowers. We don't find any evidence of that. So when we consider borrower level emission, the results are pretty much invariant. That is, we continue to observe that even if our sample is much thinner, we continue to observe that banks that are high environmental reporters, if anything, lend more to borrower in brown industry. We perform a lot of robustness analysis. We consider that, for instance, well, but perhaps some of these banks, notwithstanding the sentiment of the disclosure is on average positive, might be discussing the environment together with climate risk. So we perform textual analysis to try to identify those banks. We do not consider those banks as high environmental reporters, but our results are pretty much invariant. I wanted to start to show you what are the mechanisms that drive this behavior. And in order to do so, I will start showing you how these banks establish a relationship with new borrowers. That is, in each ERT, I look at the relationship that a given firm is reporting, and I am looking at whether a bank is a new lender, and I am asking whether the new lender is a high environmental reporter. So what you see here is that when new borrowers are considered, banks that are high environmental reporter actually do what they say. High environmental reporting banks are less likely to establish a new relationship with brown borrowers. The issue is that these banks are also less likely to interrupt their existing relationship with brown borrowers, as perhaps should be part of our intuition, because for banks, existing relationships are very important. So when we aggregate the new credit that a bank extended during a year, so here our unit of observation becomes the bank industry year level, what you observe is that, well, at this level of observation, banks that are a high environmental reporter issue more new loans to brown industry. So there is no evidence that when we look at the new credit issued by these banks, that the Scope 3 emission of the banks are decreasing. So it could still be possible that banks that are exposed to brown industry extend more credit to brown industries because they are trying to fund the transition of these firms to greener technology. And ideally, if we had a very long sample, what we would want to test is whether the firms that get credit from these high environmental reporting banks are decreasing their emission in the future. We don't find evidence of that, but a part of the reason is that this behavior is relatively recent, and we don't see in the future what the emission of these borrowers will be. So in order to ask this question, we have to get a bit more creative, and we try to identify in sample which are the companies in brown industries that are relatively more likely to be investing in greener technologies. So what we know about a green investment is that either should entail research and development, or it should entail still a lot of investment in fixed assets. And when we consider in a triple interaction terms, which borrowers in brown industries are obtaining more loans, we don't find any evidence that these borrowers are investing more in R&D or investing more in fixed assets. Actually, if anything, the evidence is the opposite. We also don't observe that these banks are lending to young firms in brown industries. And for instance, work by Philippe Aguillon would suggest that the firms in brown industries that are disrupting the industry with greener technology are young firms. We also look at firms that have that are signatories of the science-backed target initiative. So these are firms that are committing to decrease their emission. We don't find that these firms get relatively more loans from highly environmental reporting banks than comparable firms that are not signatories. And then finally, we also classify brown and green firms using the textual analysis of the business description. And again, we do not find that green borrowers are getting relatively more credit from these banks. So we try to, so we have to come up with some other explanation. Why are these banks lending more? The evidence to borrowers in brown industry. The evidence I showed you before would suggest that existing relationships are important. When these banks lend to new firms, they are true to their own words. And this is another way to test the same idea. We look at a proxy for the strength of the relationship between the bank and the firm. That is how the proportion of the loans that a bank extended to a given borrowers in the past. What you observe here is that the borrowers in brown industries that appear to receive more credit from highly environmentally reporting banks seem to have borrowers with which the bank has a stronger relationship. We try to go deeper, and what we observe is that the borrower in brown industries that receive more loans from highly environmental reporting banks are borrowers that might find hard to switch to other sources of external finance, also for other reasons. For instance, because they have low profitability, they have low productivity as measured by low sale per employee, and in general, they have a low interest rate coverage. So what this evidence would suggest is that, well, banks seem to be unable to lend according to what they say in their investor reports because of the burden of existing relationship, and also because if they stopped the credit that they extend to these relatively financial unhealthy borrowers, not only they would have to explain their losses, but also their brown exposure to this industry. So our interpretation is that what prevents these banks from greening their loan portfolio is something that is very similar to zombie lending. So we have another way to try to look at this, that is, we look at the differences between banks. In the literature on zombie lendings, the firms that would have a stronger incentive to continue to lend to financially unhealthy firms are the banks that are more reluctant to recognize losses on their balance sheet. So this would be banks with a relatively lower capitalization. And this is precisely what you are observing here. And in addition, of course, large banks that are more visible engage more in this kind of behavior. So let me sum up. Well, what we conclude is that existing concerns by policymakers and at the ECB in particular that environmental disclosures might be cherry picking of part of the business of the bank that are performing well regarding to sustainability are concrete, and that regulation of the environmental disclosure might indeed be desirable. In particular, what is being discussed is that banks that disclose should disclose everything. They cannot just disclose their exposure to a particular industry or their underwriting activity and a subset of this activity. So our evidence support these ideas for future regulations. Thanks a lot.
The discussant is Larissa Schiffer from Frankfurt School of Finance.
Okay, so thanks a lot for inviting me to discuss this paper. I enjoyed a lot reading it, and actually it's very much connected to research that I do. And overall, I think I will not discuss too much what the paper is about, because I think Maria Sunta did already a great job of presenting all the many results the paper has, because I think it is already at a very advanced stage. So let me summarize briefly sort of the paper, and then sort of what I think also aligns actually what Maria Sunta is saying. The main contribution of the paper, gives some comments, and sort of my comments, since the paper is already very rich, is more of general nature, general applications, what Maria Sunta was already hinting for in terms of financial regulation, also what implications, what we will learn from this paper. So what does the paper do? So it studies the lending behavior of banks with high environmental disclosures. They have a very nice data set of European banks' loan issuance, under credit, and environmental disclosure of these banks, where they're basically made a huge data effort on both ends, sort of for the bank side and for the firm side. And what do they find is basically they're interested to understand whether the banks that sort of claim to be environmental, have high environmental concerns, whether these banks are indeed the ones that are lending less to brown industries. But in fact, basically they find the opposite, that is, banks that stress more environmental issues in their disclosures lend more to SMEs in brown industries with or with higher emissions. And at the same time, they do not lend more to SMEs in greener industries and do not engage in transition lending. So when it comes to sort of new and old relationships, or basically supporting maybe brown SMEs to engage in transitioning to greener production, they do not seem to be successful. And the channel here seems to be that banks, especially the weakly capitalized one, are the ones that engage sort of in evergreening with this existing weak borrowers. And I think overall it's a very important and heatedly debated topic with major policy implications. And I think the contribution is relatively clear here. And Maria Sunta also pointed out, I think it's basically to show that it makes a difference whether you look at what the bank is sort of showing on the outside or on the visible disclosure part, where it's talking about sort of it's lending to large firms in the syndicated lending, which has the literature has so far established that when sort of they lend, when they say they're green, they're more likely to meet green firms, but this actually applies only to large firms and less so to this less visible part of the bank balance sheet, which is basically lending to SMEs. And I think overall the paper is already at an advanced stage. It's well written. It has a lot of robustness, a lot of sort of channels, a lot of additional results, where I think I heard also a lot of discussants. So I hope at least I can contribute a bit here. So what will I focus on will be on the sort of the main results and my interpretation of the results and what I think you could do more, but I don't want you to do more. Maybe write another paper on that because otherwise I think the paper will be too large. And then a bit on the channel also, another interpretation of the channel, and as I said, the general implications. So I have several comments on the main three results of the paper. So on the loan volume, so what you're looking at is basically on the left-hand side, the loan volume, and then you have this interaction term of a brown industry or brown company in a brown industry, or basically a high emission company interacted with this high environmental reporters. And what you're basically finding is that this coefficient, instead of being negative, is actually positive, that they actually extend more loans to brown firms. But at the same time, you also showed a similar effect for the green. So the opposite effect, that they seem to lend less to green companies. And what I was wondering is basically whether, since it's defined sort of in terms of quintiles for both emissions and industries, whether you can see how nonlinear the effect is, or where is sort of the cutoff, where sort of in turn it turns to be negative. And also more interesting is actually here, I would even put sort of both in one regression, brown and green, and keeping the comparison group constant, everything in the middle, and to see basically how where they extend more or less loans. And another comment here is from my side in terms of fixed effect, because I also tend to put tons of fixed effects in my papers, is to introduce also bank country industry fixed effect to capture also certain time and varying bank industry matching, because they might be specialized in certain industries, and that's why basically that might account parts to the effect. So, and the second comment on the result is that again, it goes into the direction to explore more the green part of your results, because so far you're focusing only on brown. So on the one hand, you show there are no effects on interest rate maturity. What about collateral? And then I would like to see whether, if you have this data, at least maybe they require higher collateral from these brown borrowers. And what about the contract terms for the green firms? So I think you showed a bit the results on loan volume for the green firms, but I would like to see whether it's basically pictured in both directions. Sort of, is there less knowledge about this green firms? Do they imply stricter contract terms? Do we see more non-performance for brown borrowers and less for green borrowers? So you will see in later slide where I'm actually going with this. And here is also only a small comment in terms of the green transition. Basically, you show that the paper, that the banks do lend to brown firms, but not to support green transition. Here you might add, you can consider another proxy would be green patents. But let me, given that I have only 5 minutes, go to the main other thing that I was thinking about is your main channel. Yeah, so you're arguing here that weak banks engage in brown lending to zombie and relationship firms. And I think a potential other channel is actually related to your other paper that you have, is basically, and this is sort of my general thinking of this paper, is that these banks, you show that have sort of in the past had larger shares in the certain brown industries. So basically they acknowledge, so sort of they accumulated the knowledge about this brown industry. So for them, maybe it is even very hard to switch to lend to these customers, because first it's this SME lending sector, so they face all these different difficulties that these green firms tend to be small, opaque, with less reliable information. So it's harder for banks to form the relationship, the new relationship, and there's also no support for the government to initiate this new relationship. So I think you can easily test for that. That is actually driven by the expertise. That's, even if they want to, they can't, because it's basically too risky to lend to these type of borrowers. So my idea would be here that actually they maybe not adapt to finance the green transition. And then this relates also to my general implication. When I was reading the paper, I was thinking about maybe actually they're facing a trade-off between sort of balancing this climate risk and the financial regulation, because on the one hand, they want to appear to be greener, but at the same time, they face sort of capital regulation, right? And they don't want, as you said, especially the weak banks are the ones that are trying to engage in evergreening of zombie firms to sort of keep their asset ratios low. So I think overall, they're shying away from reporting basically lending to brown firms. and lending to green firms for climate reason, but it could be basically that the banks are just less likely to extend new loans because of financial regulation that it's not supporting this green transition. So one of the messages could also be that this capital regulation hinders actually banks from lending to green SMEs because they are more likely to be younger, capital intensive, more risky firms that basically, as you said, right, you can also look at that. What about initiating new relationships with the greener firms, right? So I think there's a balance that banks have to or traders they have to face, and they seem to favor, of course, financial regulation because that's probably which is more binding for them. And this goes a bit into the direction what you were saying. What about the disclosure of these banks, and where are we heading? So should we force banks to disclose more on their balance, more on what type of lending they're doing? So what I found so far is that the new initiative for now, as of 2024, and some banks do report this already, so you might use that, is this green asset ratio that seems to favor just large firms. So it's really interesting. So it's not that off balance sheet is completely out, and they're not sort of looking at all at small firms, and there's only some of them that could commit to this more balanced one that includes SMEs. But I think it seems like the banks already are sort of preparing for this green asset ratio and what they're disclosing, because I mean, you could put it down for, at least for the banks that are there. So this is actually what's driving probably their behavior, because they know this is what will be disclosed. This is what is coming also in the future. I do not care too much about SMEs. And then I have some minor comments. There's one sentence. I think there was something missing there. And also in terms of, you could also use select the emissions of firms. So overall, I think this is a great paper, and with huge policy implications. And I think there's a lot to think about. What are the general applications sort of financial regulation, and how can we encourage banks to disclose more on this SME side, which I think regulation doesn't seem to do. And what I would also encourage you to do, maybe to look more into this green firms and see what's going on there. But maybe that would be in another paper. So good luck. And thanks a lot.
Mike? Okay. Oops. So we can open up to questions. Anusha? There. Oh.
So I want to begin with a comment which Maria sent yesterday after seeing Marieka's film, that I don't know if you realize that this is a 4 women co-authored paper. So we talked about women's networks of co-authors, and I think this is a first for me to see a 4 women co-authored paper. The other is also sort of a comment, which is it's ironic that what seems to be preventing the greening is the evergreening, right? And so, and you know, Larissa, you mentioned it as well, but that was kind of striking during your presentation. And then the third is a question, which is, have you considered you know, what is the economic significance of these results? Like, what are the euro numbers on your results in terms of, you know, the fractions of new loans?
You want to take a few questions?
Yeah.
Then Linda?
Yeah.
After you.
Okay. I was wondering whether you can observe the interest rate that the banks are charging for those brown firms. It could be that when they are under pressure, and then during the negotiation, the firms are accepting higher interest rate, and in return, like they are lending higher loan.
Yeah, so I wondered about the extensive margin. So going with the, you know, evergreening and kind of traditional business. I mean, on establishing new relationships, it could be that there's a tilt towards establishing new relationships with green firms while you're still maintaining your long relationships that you've had, and you may even be changing the lending terms. This already came up, and changing the collateral and so forth. But you know, maybe there is an effort to support even if you tend to be tilted historically brown.
Ellen?
Thanks a lot. So tell me if I'm wrong, but I think you use the emissions at the sectoral level because you don't have the...
I also use a borrower level in some,
okay.
and the business description. Yeah.
Okay, but so if we think about the transition, so it is pretty clear that we cannot stop lending to certain number of sectors right away. So we cannot stop lending to, you know, some energy sectors, etc. And so what's the strategy of some of the people? It seems to be that you pick the best in each sector and you kind of lend preferentially to that.
Yeah.
So I wonder if you see any evidence of that, because that can be a rational, to some extent, strategy. Same thing in the mining industry. We do need some of these things for a transition. So I'm a bit worried that if we kind of categorically, you know, put everybody in the same bucket without realizing that we do need some of those financing, we are.
Yeah. So can I start replying, because otherwise I get too chaotic. So I mean, we are also, so we want to use all the borrowers, but we are we have to go for a second best choice, that is to use industry level emission. Said that is we have other proxy, but I think that to continue to use other borrowers in what I showed you, we can do better. And the tests that I like more are let's use brown industries, because I think those we can agree what is a brown industries, but then let's look at heterogeneity between the borrowers in brown industries. We could use a patent also, as Larissa was suggesting, but currently we do all of these based on financial information from Orbis. So what I would expect is that the best in the brown industries that are changing are investing more, either in R&D on fixed asset or have high profitability. We find that it is not the company that are investing more in brown industries that get more credit from these banks. In fact, I think that on fixed investment, we find a negative effect. And I showed a table in which the companies in brown industries that are getting more loans are the one with low profitability, low interest rate coverage, and low productivity. So they are not lending to the borrower in brown industries. Let me get on this extensive margin. So to some extent, in what we are doing here, focusing more on brown industries, we think of the scope 3 emission of these banks' portfolios. And so that's why we focus more on that part of the analysis. And the way in which we think of it is that the relationships are important. So I showed it with the probability of new relationship or a relationship termination, but I could do something that is similar to what Larissa was suggesting, or go one step before. That is, if I consider bank borrower fixed effect, I would consider that is how is the lending of a bank changing over our sample period as the environmental sustainability awareness of this bank revealed to the market seems to be changing. So how is this changing? And it is equivalent to what I showed, that in that regression, I would find absolutely nothing. These high environmental reporters continue to lend to those borrowers as they were doing in the past. Now is green lending and green relationship. So when we look at this new relationship with green borrowers, we don't find differential effects. Our interpretation was that these green borrowers are attractive for different banks. So it doesn't matter what is the taste of the reputation of the bank, different banks want to lend to them. Said that, what Larissa was suggesting, that the green technologies are very risky. And another reason that can prevent banks from taking these active roles is green technology, might be like new internet companies, might be like AI, they have to be funded through different instruments. And that is something that we didn't get in, and could be an interesting topic for a different paper to look at the risk of these borrowers and you know, for which investors the participation constraint is satisfied. So supply of credit can be measured in different way. We use a quantity in our narrative, but all what I told would be carrying through if I looked at interest rate. Indeed, we have results for interest rate, and we have also results for maturity, because by shortening maturity, a bank could be monitoring more, and we don't observe that. So
there was still Victoria.
That's
also
sorry for
I had more of a comment, maybe you thought about it, because I found the results very concerning. And I'm also remembering that you show that these reports are very correlated with the ESG scores that they get. So that means that someone is actually monitoring this and they're still getting these high scores for ESG.
Well, there is a lot of debate about ESG scores, and you know, Larissa would know much more than me on that. But the rating companies that perform an ESG score don't have much more information than what the company is telling them. And you know, ESG scores are. There is a lot of debate about they don't capturing what they should capture.
So they don't observe like loan portfolios. I mean,
no, of course not. This is something that I cannot observe either. So that's I can only observe the results. So that's.
Mariassunta, I wanted to ask something, whether we can be maybe a bit more optimistic in the future. So this period was a period of TLTROs, so focusing on enlarging the amount of loans, irrespective of profitability and so on and so forth. So maybe it was just easier for banks to rely on existing relationship, on brown firms, maybe because the green ones are more risky, but then out of these policies, we would be banks could rely more on loans to green.
Yeah, so I think that is interesting. Would be interesting to explore now that the banks are contracting their portfolio, to whom they are contracting more their borrowers, and indeed the credit tightening might be green or brown. We don't know. Said that, I told you that my sample goes from 2014 to 2020. But if I show you the dynamic of our estimates, the significance really comes from 2017. So this behavior is that at some point it became the benefits from disclosing for certain banks increased, and then we have enough cross-sectional variation to estimate a significant effect. Said that in 2020 rates were negative, so I cannot say anything about the policy tightening.
Thank you. So we can close this session and have a break. The last session before the panel is on dynamic carbon emission management. Sorry. And we have an interesting presentation by Francesca Zucchi from the ECB on dynamic carbon emission.
Thank you very much. It's a great pleasure to be here, and thanks a lot for including the paper in the program. So this is a joint work with Cecilia Bustamante, who is at the University of Maryland, and I'm at the ECB, so I should start by saying that these are our views and do not necessarily reflect the ECB. Okay, motivation of this paper is that, as we all know, several countries around the world have adopted or are in the process of adopting carbon pricing mechanism. So as you can see from this map, the most prevalent carbon pricing mechanism are virtually two, or a hybrid combination of the two. So the first is the emission trading system, like the one that we have in the European Union. So under emission trading system, carbon credits give firms the right to pollute and therefore to produce and are tradable. That is, firms that have a shortage of credit can go buy them on the market, and firms that have an excess of credit can sell them. The other carbon pricing mechanism is a carbon tax. So under a carbon tax, a central authority sets a predetermined price that emitters have to pay for a given volume of emissions. And as you can see, some countries have also considered a hybrid combination, which is the blue area. And more and more countries, as you can see from the red area, are considering one or the other. So regardless of the pricing mechanism, a key unifying feature across carbon pricing mechanism is that they impose additional cost on firms. So the question that we ask in this paper is what are indeed the incentive posed by carbon pricing on firms, and therefore how firms should best respond to it. And in fact, the idea is that in this new world in which we live in, so in a world in which carbon emissions are priced, firms have to develop a carbon emission management that encompass several different tools, as I will explain shortly. So this is what we do in the paper. We take a theoretical perspective and we try to understand what are indeed the incentive that carbon pricing puts on firms and how therefore firms respond to it when allowing for a rich set of tools that the firm can adopt to minimize the cost of carbon pricing on them. And therefore, we study both the emission trading system and the carbon tax system. And obviously, the trade-off that firms face are governed by the regulatory environment in which they operate. And we consider a dynamic model because, in fact, we believe that firms react dynamically to the cost they face, and therefore they try to have a dynamic interaction across the different policies to minimize the cost associated with carbon pricing. And in particular, we allow firms, first of all, to optimally decide on their production rate. So obviously how much they produce depends and affects how much emission, the gross emission they will produce. Second, we allow them to invest into greenness. And we allow for a broad heterogeneity in the type of green investment they can undertake. And so to fix ideas, we think of two extremes. So on the one hand, you can think of abatement projects, which are all investment that only serve to reduce your gross emission and therefore have a lower carbon tax liability or have a lower need to go buy credit on the market. So you can think of planting trees or buying international carbon offset that in fact reduce your net emission as a firm, but do not change the firm technology. So the firm technology will remain exactly as it is, but the firm will be able to offset some emission, and so will have a lower tax liability. At the other extreme, you can think of green innovation. So green innovation is really meant to be the type of investment that changes the firm technology. And so it really leads to a transition to a greener economy. Of course, therefore, green innovation have a long-term effect if it's successful, so it will permanently make the firm more sustainable. But this comes at a cost because, green innovation is is definitely more costly. It has a long gestation period, and it has an uncertain outcome. In other words, the firm will be investing for a number of years, like without knowing eventually whether it will be able to get something out of it. In fact, eventually, like this can be a complete disaster or failure. Okay. Under the ETS, we also allow firms to optimally manage and trade the carbon credit, which is an additional policy the firm can choose. So key in the model is that the firm net emissions are endogenous, so we don't impose that firm have a given level of emissions. So these are endogenous and the outcome of the firm optimization problem and vary over time as the dynamics and the choice of the firm unfold. So let me give you a preview of the result. So the first result of the paper is that, in fact, we show that carbon pricing leads to a reduction in the firm emission, which is good news because it means that what carbon pricing mechanisms are supposed to do are really doing this. So they lead to a reduction in emission. And this happens through twofold channels. So first of all, firms reduce their optimal production level compared to laissez-faire. And second, they engage in green investment. At the same time, we also show that as it becomes costlier to comply, firms actually have the incentive to shift their green investment mix towards abatement and away from innovation. Why? The reason is that, as I just mentioned earlier, innovation is very uncertain and it takes a lot of years to materialize. So when firms are faced with higher cost of carbon regulation, they just want to minimize this cost. And this is immediately possible with abatement. Whereas green innovation has a very uncertain outcome. It materializes down the road in an uncertain number of years. And so a tighter carbon regulation actually leads firms to shift to abatement. So the second result has to do in particular with the ETS. And we show that firms that have a large balance of carbon credit are actually less committed to curbing their emission. And the reason why this happened is that the cost that is associated with buying carbon credit makes firm behave in a precautionary fashion. Like, is this typical, like the intuition in a cash inventory model? So when a firm is running low of credit, it will be more likely to be in the need of go and buy credit on the market. So what happens is that the firm tries to slow down the consumption of its carbon credit by decreasing its production and engaging more in green investment, and this will lead to lower emission. At the opposite side, when it has a higher carbon credit, the firm is very far away from being in need of buying credit, and so it will relax its commitment to becoming green. So this informs of the implication for a regulator of allocating too many carbon allowances for free, because in this case, firms will be really more relaxed, and it will take a longer time to go to a decarbonized economy. So the last set of results, think about the endogenous design by regulators of carbon regulation. And what we show is that carbon pricing and innovation subsidies really should be thought as targeting very different objectives, because carbon pricing guarantees that firms will commit today to lower their emission. But at the same time, you have to give subsidies to innovation to make sure that the reduction in emission won't just be driven by abatement, but also it will be innovation-led. And so subsidies play an important role for firms. All right, let me jump into the model. So we consider a firm that has a stochastic flow of carbon emission. And let me describe this equation for you. So this equation implies that the more the firm produces, this endogenous quantity Y here, the greater the firm emission. up to a parameter nu, which is industry specific. So in other words, here you can think of this parameter as like being higher for a firm that operates in a oil industry as opposed to a firm that operates in a service industry. So the firm has a way to reduce its net emission, and it can do so through innovation first. And G, this G here captures the firm degree of sustainability or greenness, which grows thanks to innovation-driven technological breakthroughs. And also the firm can reduce its emission by investing in abatement here. And and as you can see, the more the firm will invest in abatement, the more it will be the reduction in the net emissions. So here you can see that for a given level of production, the firm has two tools to reduce its emission, which is innovation or abatement. And the more the firm will produce, the more it will also be the volatility of emission. So the firm has several endogenous choices to make. The first is on production here. And obviously, production increases the firm emission, but also boosts the firm revenues. And we assume that the firm faces the pro-ESG demand function, which is consistent with several surveys, and as it's been raised by the discussion earlier. The firm can invest in green investment, and green investment can be abatement, denoted by S, which entails quadratic cost. And as you can see here in this previous slide, S shows up immediately. So if the firm invests more in abatement, it will be able to decrease its expected emission by more. At the same time, innovation in the model is denoted by Z. And as you can see in this equation, innovation doesn't show up in the dynamics of emission. Why? The reason is that innovation actually affects the quantity G, but with a lag and in an uncertain fashion. In particular, we use the modeling that is standard in the macro and growth literature. So we assume that the more the firm invests in innovation, which is a quadratic cost, the more likely the firm will be to attain a technological breakthrough, which comes at the Poisson rate, which is a function of Z. And upon a breakthrough, so upon a technological breakthrough, the greenness of the firm will increase by a factor lambda. So the firm is now operates in a carbon pricing system, which can be either the carbon tax. So under the carbon tax, the firm pays a tax kappa on its positive net emission, which will go and drain the firm profits, which are given by revenues, net of abatement cost, net of innovation cost. And alternatively, the firm could operate in an emission trading system. So in the emission trading system, it's more complicated in a way because the firm has to have like carbon credits denoted by C to back its emissions. And so the stock of carbon credit is depleted by more emission the firm makes. But the firm can increase its carbon credits by go and buy them on the market. And obviously carbon credits decrease if the firm decides to sell them. And we model the purchase and the sale of carbon credit by assuming that there's a bid-ask spread, which is consistent with the fact that firms are now going to a carbon credit exchange to do their trading of carbon credits. And obviously, the firm will be a function of sustainability irrespective of the environment it operates in. Okay, so let me jump into the results of the paper. So first of all, we compare the carbon tax system with vis-a-vis laissez-faire. So what we show is that under the carbon tax, the firm underproduces compared to laissez-faire, and the firm underproduces more, the higher is the carbon tax rate. Moreover, the firm invests in abatement, whereas the firm has no incentive to invest in abatement in the laissez-faire case because carbon emissions are not taxed. And under the carbon tax case, the firm will invest more in abatement the higher the carbon tax rate is. And lastly, the firm will invest less in innovation compared to laissez-faire if it's a polluter. And so what does this tell us? So a direct implication of the results that I just showed you is that compared to laissez-faire, firms that face a carbon tax will exhibit, first of all, lower emission because the firm produces less and engages into green investment. But at the same time, because abatement increases and innovation decreases, the firm will exhibit an investment mix that is tilted toward abatement and away from innovation. So, in other words, the carbon tax is effectively making the firm less polluting. So it's reducing the firm carbon emission, but it also implies that the firm will shift its efforts toward abatement and away from innovation to reduce its cost of carbon pricing today. Okay, so let me now move to the ETS to see if we have these results confirmed or if we have additional results. So under the ETS, the firm is not just a function of the greenness G, but is also a function of the amount of carbon credit it has. So the firm accumulates carbon credits up to an upper bound, which is endogenous, and it's the point at which the firm decides to start selling credit, whereas at zero, the firm will have to go and buy credits on the market. So the marginal value of credits inside the firm is the, if you like, the first derivative of firm value, will be largely affected by the cost of carbon credit. And over this interval, over this internal interval, the firm will set policies as in the carbon tax. So let me show you the comparison between the ETS and the laissez-faire case. So what we show here is again that under the ETS, the firm underproduces compared to laissez-faire. And here, you remember in the carbon tax case, here we have the kappa, which is exactly the carbon tax rate. And here we have the marginal value of carbon credit inside the firm, which is driven by, in fact, the cost at which the firm purchases credits on the market. And similarly, the abatement, the optimal abatement rate is again driven by the marginal value of credits inside the firm, which is again driven by the cost of carbon pricing. And again, we can show that polluting firms, so firms that are the net polluters, decrease their engagement in innovation under the ETS. So again, we confirm the same intuition as before, that net emissions are lower than under laissez-faire, but the firm shift the investment mix towards abatement. So under the ETS, we have additional results because the firm, so we can study the optimal policies as a function of the carbon credits of the firm. So what we show is that the production, the rate of production of the firm increases with carbon credits, whereas its investment into greenness, so either abatement of green innovation, decrease with carbon credits. So overall, the expected net emission indeed increase with carbon credit, which goes in the direction of what the results I mentioned at the beginning, that firms are less and less committed to reducing their carbon emission when they have a larger credit balance. So let me show you some more results that come from the model. So here, what we can show is that like the net emission. So as you can see, the firm dynamically adjusts their net emission over time. So the blue line is carbon credit, the red line is carbon tax, and the black line is laissez-faire. So what we see here when we look at this chart together is that firm, as I mentioned earlier, increase their emission with the level of carbon credits, but at the same time, they decrease their engagement in green innovation. And this lends theoretical support to an empirical paper by Patrick Bolton, Kasperczyk, and Biederman, showing that the more polluting firms are in fact less engaged into green innovation. So the last chart here, in turn, is showing you that when shows the innovation share, which basically is the weight of green innovation over the overall green investment mix, so abatement plus innovation. And so what you can see is that the firm reduces its engagement in innovation when it's running out of credit. Why? The reason is that abatement allows the firm to reduce immediately its pace of consumption of carbon credits. And so when running out of credit, it's optimal for the firm to invest more into abatement rather than innovation. And you can see a similar result when thinking about optimal policies as a function of carbon price, either in the carbon tax or in the carbon trading system, which are the blue line, and the carbon tax is the red line. So here on the x-axis, you have carbon pricing. So what you can see is that as the carbon price increases, the firm invests more in abatement and less in green innovation. And overall, the innovation share, so the weight of green innovation, decreases with the carbon price. So as it becomes more costly to comply, again, it's optimal to shift to abatement, because abatement allows the firm to reduce the cost of carbon regulation immediately. So then we consider the effect of introducing innovation subsidies. So when introducing the subsidies, we can see that this effect of carbon pricing of shifting the green investment mix is at least partly undone, depending on the size of the subsidy. So what you can see is that green innovation unambiguously increase with the green subsidy, and also the weight that green innovation has over the overall green investment mix increases. And this not only that, but also the firm total green investments, so abatement plus green innovation, increases. So now the question is, how should we think about carbon regulation? So to answer this question, we consider a benevolent regulator that can optimally choose carbon regulation, so either just the optimal carbon price or the mix of carbon pricing and subsidies, and given the social cost of carbon per unit of emission. So in this setup, we assume that there's a final consumption good that serves as a numeraire of the economy, and we consider a continuum of polluting firms that produce input and that are used in the production of the final consumption good, and the final good is produced competitively. So we consider a representative agent with log preference, where its consumption is given by the labor wage that is provided to the final goods sector and is pinned down competitively, the dividend that comes from the firms, which obviously will be drained if firm invests more in green innovation, and at the same time it will increase if the firm produces more. And it will be drained by the social cost of carbon, which aggregates emission over the continuum of firms in the economy. And also it's affected by government transfers, so carbon taxes, increase its consumption and the subsidy will decrease it. So we calculate the greening rate of the economy, which is really like aggregating the different G, the different sustainability, and the improvement is sustainability in the different sectors. So what we show is that carbon pricing here, you can see increases with the social cost of carbon and also the innovation subsidies. So this is not surprising. So the interesting chart is over here. So The magenta line is the case in which the regulator uses both carbon pricing and the subsidy. The black line is laissez-faire, and the red line is the case with carbon pricing only. So what this is showing you is that the greening rate of the economy is lower without the subsidy, much lower than the case with the subsidy. And the reason is, again, that absent the subsidy, carbon pricing leads to less green innovation. So again, like what I described you in partial equilibrium, it continues to hold in general equilibrium. So a larger carbon price leads firms to shift from green investment to abatement. However, like complementing carbon pricing with the subsidies can actually stimulate a faster greening path, which is key here. So I think I ran out of time. So let me just conclude by saying that we try and formalize the firm trade-off under different regulatory environments, and we think about how it affects the firm green investment mix, and we try and think how different tools, policy tools, can help firms stimulating green investment. So thanks a lot, and looking forward to the comments.
Thank you. Discussant is Giorgia Barboni from Warwick.
Perfect. Thank you. So thanks so much to the organizers for having me here. As a sort of disclaimer, it was a huge boost of self-esteem when I was given to discuss a theoretical paper for those who know me. My background is more on finance and development with an applied approach. Nevertheless, here I am. And I think, well, I mean, with my discussion, I kind of would like also to provide some useful suggestions for the policy panel that is going to happen soon. So I hope to be able to also contribute to Francesca's and Cecilia's paper. Okay, so let me start by simply summarizing what this paper is about. So the main research question is how should firms best manage carbon emissions? So what the authors do, as Francesca has perfectly and timely discussed just earlier, is that they set up a theoretical framework that outlines firms' optimal carbon management policies under different alternative regulatory systems. They look at an laissez-faire type of policy, carbon tax systems, and cap and trade. What the results show is that carbon pricing systems, either they be carbon pricing system, either they be carbon tax systems and this cap and trade, are effective at reducing carbon emissions vis-a-vis the laissez-faire policy. Firms under producing carbon trading systems compared to laissez-faire, and also carbon pricing systems may discourage long-term green innovation in favor of more short-term sort of abatement strategies. And in the paper, they show the key role of subsidies in fostering firms' engagement in green investment and green innovation. So this complementarily. Okay, having said that, first of all, I think what we always wonder is why does this paper matter? Well, it matters for at least two reasons. First of all, because market prices do not reflect the true cost and economic, environmental, and health implications of burning fossil fuels. And so when you put a price on carbon, that makes more polluting fuels, products, and services more expensive. And finally, those who emit greenhouse gases pay for it. Now, what the rest of my discussion will be about is mostly focusing actually on the motivation of this paper, kind of thinking about models like this also developed in central banks. If we were to bring these results, say, in round tables with especially representatives of emerging economies, we have a COP28 in 2 months. So what do we learn from models like that? So, first of all, the first question that kind of came to my mind while reading this paper is, this model kind of builds on the assumption that somehow these carbon pricing systems are simultaneously available. What I'm trying to say here is that, of course, it's a theoretical construct when you compare different systems, that essentially they are some sort of available to the same firm, that they can choose which tool should be better suitable for them, but also that firms can actually access to these type of policies. There are no friction whatsoever that they face. Now, let me be a little bit more pessimistic about these assumptions. Francesca had a map that showed essentially which countries have different carbon pricing policies. This one, first of all, shows which countries have a carbon tax. And there's a huge set of the world where there's no color at all, where you can infer that essentially there are no carbon taxes at all. And in Canada, for example, there are only at subnational level. This is a map taken from some World Bank report back to 2022. How about the level of carbon taxes? There is also quite some heterogeneity on the carbon taxes that are applied. And only in Europe, Sweden, for example, these are like the highest ones. Otherwise, I mean, they tend to be pretty mild. And instead, which countries have a carbon trading system? Again, this is a very sort of advanced country luxury that we have. China has somehow introduced something like this, and we know also the US and Canada as well. But I would say by looking at this, to me, this looks really depressing. And I don't know if the policy panel will shed light on this or will provide some answers to that. The last bit that I kind of wanted to highlight when we think about tools that firms avail from when they have to decide how to manage their emissions is about their effectiveness in really reducing carbon emissions. So this map shows essentially the share of CO2 that are reduced through this carbon policy, carbon reduction policies. This is slightly not updated because of China, but again, nevertheless, the effects is pretty heterogeneous across the spectrum. So all of these maps, what I want to try and say with that, and this will be essentially the rest of my comments for the next 5 minutes, even less. So first of all, I think that institutions play a big role in trying to implement and make these policies effective. I would say, but maybe this is just my opinion and take it as it is, that the results from this theoretical framework definitely does suit firms operating in a more advanced economies. And it's also true that most large firms, those who can apply, who can comply to these carbon policies, precisely operate in these economies. However, China and India, for example, are projected to be the largest polluters in the coming years. And so it is somewhat natural to wonder how can institutions and regulators help emerging economies curb their emissions. So would the results of this model apply also to this context? What can we bring again back to the round tables with central banks from these countries? And then somehow related to that is the role that multinational firms could play in this scenario. So the way I've understood the model is that firms operate in a given location where exactly the policy apply. But we know that the reality is also that we have conglomerates, multinational firms, and somehow we also know that even though, I mean, I would say the confirmation that the pollution haven hypothesis does really apply, I mean, is a bit mixed evidence on that. But we also know that sometimes firms do actually use countries, or at least they source some of their production in countries where the regulation is less tight. So I would be also curious about whether this model can give space to the role of outsourcing. There was a really nice Journal of Economic Perspective issue on all these this year. But also in some sense, when we think about the laissez-faire sort of scenario, where in countries where essentially there's some sort of pressure for firms to be even more polluting, because there are also other countries where, in fact, a part of the firm is subject to these carbon emission policies, then again, just to go back to this point, the laissez-faire may be a scenario where firms may paradoxically be encouraged to pollute. So having said that, I have just one more slide with comments about how I think this paper could be very informative and how I would like it to be pushed a little bit further. So first of all, as I already mentioned, as Francesca has explained quite clearly, the model highlights how in countries where carbon pricing systems are available, in the short term, emissions abatement may happen, and in the long term, green innovation takes place if subsidies are provided. Sorry for the typo. There is something that is a really, I think, important, and it's really at the core of the debate around the climate change, and it's the fact that however this goes, this still may exacerbate already existing inequalities, particularly between advanced and emerging economies, or even within countries where you have, for instance, different sort of speeds at which economic growth happens. So I wonder whether the model can accommodate solutions for these, even to explain potentially rising inequalities, or even how to solve inequalities. That's really like a big question to ask. And at the same time, Francesca has also explained that there are heterogeneities that the model, again, allows for. I wonder whether we can also think about friction in fiscal policies. And what I mean by that is the enforceability of carbon taxes in different countries, which goes hand by hand with trying to think about additional firm heterogeneity or heterogeneity in terms of the regulatory context where firms operate. So to conclude, I found this paper very interesting. It gave me a lot of food for thought, as it shows how firms can manage the emissions based on existing policy. I think that it nicely complements all this literature that we know about that focuses on green innovation and subsidies to innovation. I think that there is a lot of potential for this model to provide concrete, relevant results to influence policies, particularly in emerging economies. Thank you so much.
So we have 5 minutes before we start the panel. So is there any question? Helen.
Thank you very much. I was wondering what difference it makes, if any, if there is a well-defined upward-sloping price for carbon, whether the conclusion that the firm is, not innovating and rather doing abatement is not overturned if the slope is sufficiently credible, because in the end it won't be enough. I mean, you do need to change the production structure. So I was wondering whether this is a possibility in the theoretical analysis, and of course, then the idea would be to try to maybe quantify a little bit where that, how we could have that trade-off rather than the outcome that is given currently by the theory.
Okay, so I have a question about so just to understand better, the model distinguished there are two options here. There's firms can abate emissions or can innovate in green technology that then eventually, if successful, would lead to a reduction in emission. I think in the real world, it's not exactly like that. So that's where, I'm coming from when we then start thinking about policy. So abatement, there's a lot of criticism to offsets. And so, ETS inclusive, and there's a huge literature that it actually doesn't mitigate the problem at all, because you can plant trees and then, in a country where it's not observed and and then they're cut the next year, and then they're planted again, and they're sold 5 times. And you think you have a forest somewhere in the world, but you really don't. So that's a simple explanation. And the green innovation, I don't see it as something that every firm has to invest in. So take the metal industry. The way they will become green, if they ever will, is to adopt, for example, green hydrogen. They're not going to be the ones developing the green hydrogen technology. They will adopt it. And then once it exists, to have a carbon tax will push them to adopt it, because it will be penalizing not to adopt it. But it's only the larger firms. Take, for example, in shipping, here we have Signe, who's a Dane and knows a lot about shipping, for sure. The Grimaldi group in Italy invented technologies and was a piece and parcel with the invention of green innovation in painting with non-toxic silicone the hulls of the vessels to increase energy efficiency during routes. And so that saves a lot of energy. And but the smaller firms, smaller fleets, they wouldn't have to do that. They could just adopt that technology. So I'm not clear what's the reward, how this model can be adapted to capture, the actual practicalities of choices.
My question was very similar to Nicoletta, in the sense that it seems like maybe you're putting assumptions to be very much against this investment. Maybe it's not so risky, maybe it's not so costly. Maybe I was wondering, what is it in the model that makes the results so stark?
So thanks a lot for the comments. So we'll try to put them together in the interest of time. So thanks a lot for the nice discussion. So you actually brought up several different aspects that are actually trying to address in a follow-up paper, and probably also respond some of the other comments. So in terms of the type of investment, which probably goes also in the direction of the heterogeneity dimension that Georgia brought up. So we try to take the two extreme, but in a way, we realize that in the middle there's adoption, which is after an innovation is brought to the market, obviously firms can just adopt it at a lower expensive price, because you just don't have to find it. And actually, this is an aspect that we are developing in a follow-up paper, so shelfless self-promotion. So, and in this paper we also include financing frictions, which is another aspect that it's a big drag on green investment. So, in a way, it's totally true that there's a lot of discussion about abatement, whether actually it's certified, is backed up by projects that help green the economy. Let's say we don't take these more prosaic aspects of these, but we want to have a structure in a sense that you can think of many different type of investment that the firm can take to become green, and we try to polarize to have the extremes. But yes, in a follow-up paper, we also captured heterogeneity further, and also the financing frictions that can be behind that. In terms of the upward sloping price for carbon, so the idea is that, so right now, there's not such evolution in the model, but we are working further on this general equilibrium stuff. So the idea is that actually, if you were to start with a low carbon pricing and increasing over time, actually, that is definitely the optimal policy, because if you start low, it means that you are incentivizing, so you are front loading green innovation, and this is awesome because it means that you are already helping the economy transition to a greener and innovation-based technology. So our model would tell that this upward sloping pattern is actually optimal indeed. In terms of yes, so inequality between different economies. Yes, so it's again like it goes in the direction of perhaps like introducing this financing friction. So to further elaborate, which is something that we are doing in another paper. Role of multinational firm. So is so I guess the issue would be there to have regulatory arbitrage between different jurisdictions. So I guess if you introduce carbon pricing, then like it would be even more less so that firms would be incentivized to invest in green innovation. So I mean, like this would be something interesting to add to a model, but I mean, I think it would corroborate the idea. So I think I should stop. Thank you very much.
Yeah, she's coming.
I'm here. So I'm not Sumaya Keynes. Very sorry about that. So Sumaya is with us, but she's not feeling well. So we wish her a very prompt recovery. And in the meantime, so I'm going to be filling in for her. And before I move on to this great panel and with my wonderful speaker, I just want to make two very quick little announcements. So the first one is that the ECB has every year a Young Economist Prize. And it's for students, okay, final year students, essentially people around their job market. And we have very few women applying. So it's very much in line with the film of Marieke of yesterday. And so we do want a lot more women to apply. So I'm just making a general call here to the community to encourage the young female students, PhD students, to actually apply to that prize, which is a very nice prize with a lot of visibility, also some cash associated to it, prestigious. So please do encourage your young colleagues or here some people as well to apply. That's the first thing. The second thing is that CEPR is doing every 2 weeks, so bi-weekly, a seminar series on Zoom in which young female, also academic, whether it is final year PhD student, postdocs, or assistant professors, may present their work in a nice environment. So if they want to try something a little bit, you know, daring or whatever, they can do so and have some comments. It's hosted by some senior women. And it's every 2 weeks. So please, if you are interested, again, encourage your young colleague to apply. Send an email to vicepresident@cepr.org, vicepresident in one word @cepr.org with your paper. And then we can try to schedule you. Okay, so that's my two announcements. Now, sorry, now we are going off to the business of the day. So this is a climate on a panel on climate. And macroeconomic policy stabilizations, evidently central banks, so monetary policy, financial regulation, So we are all aware now, I think, that climate change is with us. We all believe in scientific evidence here, so I think there's no ambiguity. So the question is, what can we do about it? How should we think about the interaction between monetary policy, financial regulation, and what we can do for climate change? And we have here three wonderful speakers who can enlighten us. And there will be also some time at the end for questions. So we are going to start with Signe from the Danish National Bank, who is going to tell us about how you see the mandate of the central bank. Should we do something? Shouldn't we do something? What should we do? Signe.
Yes, thanks a lot. And thanks for inviting me to this very nice event. It's a very unusual crowd to be speaking to and very impressive. I just want to say that first. Yes, so I want to give you the helicopter view of why this is something that we talk about as central banks. So it's not anymore a question whether we will have climate change. It's sort of a known unknown. We will have it. And how much we will have will depend on how we respond to it now. And most countries have signed up for a transition. We have transition goals, we have plans. The transition is going to have to be massive if we want to reach these goals and plans that we have. And that means that we will have major shifts in investment flows from fossil fuel-based investments and economy toward a renewable or sustainable economy. And this is going to be massive. It's not just little marginal tweaks. It's going to have to be huge. And it's also going to feature changes in demand and supply of goods and services towards sustainable versions of these. So we will see, we aim to see big changes and very disruptive changes coming up. And as we just talked about in some of the papers, is that this is not going to happen by itself, just by knowing that we want that to happen, because we have mainly market-based economies. And we have here a problem that's caused by missing market. So we have externalities. We also saw that they are not priced to the extent that they should be. And so the market is just not going to deliver this transition that we need, even though I thought Monica's paper showed that some people will actually willingly pay for it, but I think that probably will not be enough. And that's where we come into the picture of central banks, because we are often looked at as who's going to achieve this. We will also have to have a massive policy push, and we don't have it yet. We have plans and goals, but we don't have the policies in place yet to achieve this. We're often, I think you will confirm, we're often asked that, well, central banks, you can just make sure that the money goes where the transition is. And there we always have to, I spend a lot of time explaining that no, central banks are not in the driver's seat here. And for many reasons, not just because it's not our mandate, but for many reasons that we can get back to. The fiscal policy, standard setting, and elected officials in most countries, at least in I think the countries that we represent, that's where they're in the driver's seat. And that's where we will need to see the action. But that certainly does not mean that central banks are also not part of the answer. We very much are. I think the main role that we have is the role that we always have is our mandate. Again, in most countries, I'm speaking for a certain set of countries here, but our mandates are to ensure stability, price stability, financial stability. And I think that it's not hard to see when you look back at the last couple of years that when we don't have financial and price stability, it's very hard for policymakers to have the proper attention to the long term, which is needed to achieve the transition. We also need price and financial stability if we want to have long-term clear investment horizons for private sector to take the hard decisions that will need to be taken in order to finance the transition. So I think that is our main role in the transition. And it's also, that doesn't mean business as usual, because to achieve financial and price stability when we have such a disruptive future ahead of us is not going to be doing what we always do. We need to have, and I think that's what we will be talking about, we need new tools, we need new ways of assessing dynamics of inflation, the role of inflation expectations, a new energy structure and how that affects shocks and propagates through markets. We also need to assess and price better financial risks and look at financial risk assessments. And these things are going to be different in a new economy. And we don't have the history to guide us. We need to base it on what we think is coming. So those are some of the overall considerations that we have as central banks. And I think we can dive into many of these going forward. And just the last point is that we also, of course, we're also organizations within economies that have goals around transition. That means that we, as all other organizations, we also have to have transition plans and make sure that our operations move toward a net zero economy. And that for us involves, for instance, our management of reserves. And it involves a lot of other things. That's not under our mandate. It's as an organization.
Thank you very much, Signe, for setting up so well the kind of general framework in which the central bank kind of have to operate now. And so I'm now going to ask Anna from the Riksbank whether she agrees that central banks are not in the driving seat, but however, that there is a lot of things that maybe can be done and so maybe some tools to be thinking about and also maybe whether we, as Signe said, we need to adjust our models and to take into account this new reality of climate change. So how do you see things from the Riksbank?
Yeah, thank you. And first, I also have to say it's so good to have you all here in Stockholm. Thanks to CEPR for organizing this, and thanks to the research department at the Riksbank, and particularly Daria. Thank you.
Yeah, that's worth. So
I'd like to end with talking about what I think central banks should be doing, but I think it's really important to see and say immediately that I think it's wrong to think that central banks can replace inaction by other policymakers that have better tools. That's the really important thing. But Signe, you just mentioned the long run. So climate change, we actually know what will happen. We have the IPCC report. There's some uncertainty in the data, but we know a lot. And I do read these IPCC reports. It's a challenge as an economist, but I read the last one, not the full one, but the summary for policymakers. And there was one sentence that really stuck with me. It's on page 15. I checked it. And it says, climate and non-climatic risk will increasingly interact, creating compound and cascading risks that are more complex and difficult to manage. And as a policymaker, that is a true challenge because we have the physical risks, the droughts, the flooding, the extreme heats, all of these things that we know about. We have the transition risks from potentially more climate action coming. We have the economic risks associated with the physical and the transaction risks. It's threats both to financial stability, but also to price stability, to output, to inflation. And then we have political risks on top of that. So you have the physical, the economic, and the political risks. So if anyone wants a challenge in terms of doing a macro model of this, that would be nice to see. But it's a true challenge as a policymaker when you're facing that sort of congruence of different risks at the same time. From an economic perspective, and Signe has already mentioned this, climate change is really a failure of putting a price on the negative externality, the emissions of carbon. And the first best policy option would be a price on carbon, either through taxes, carbon taxes, ideally globally, or an emission trading scheme, maybe in combination with subsidies. The whole idea is we need to change relative prices. And I wanted to mention one example, because you already saw the graphs on some of the countries that have carbon taxation. And we're one of the first countries to introduce that in the early 1990s. And it's been gradually increasing over time. And right now, there's a discussion whether more carbon pricing in whatever form it might cause inflation going forward. We're just living through a period of high inflation. So there's this whole discussion on greenflation. So since 95, when we introduced carbon taxation, energy prices in Sweden have increased by almost 5% per year. It's quite a lot. Inflation during exactly the same period of time, using our preferred measure of inflation, CPIF, has been 1.8%. So the carbon taxation has increased energy prices, but it's been a relative price change, exactly like you want to see. And then if you look at households' expenditure for energy, you know, the share in the CPI basket that's being spent on energy is actually it's been constant over time. So what's happened is that higher carbon taxes has increased energy efficiency, more fuel efficient cars, better appliances, more energy efficient homes, etc. Exactly like you would want to. And that's despite not every country having it. So you can assume there would be a lot of carbon leakage, but you've seen a reduction in emissions. You're researchers, so you know that this is just one example, doesn't mean it would translate into a larger setting. There's quite a lot of literature now on the effects of carbon taxation, ETS, etc., on inflation, and they mainly find similar results. And just to summarize that literature, let's see if I have it. Yeah. Well, it says that carbon taxes mainly change relative prices, not the overall price level. The effect on inflation depends, of course, on monetary policy having an anchor for inflation, and rather modest effects overall from carbon taxation. So that's the good news. But of course, this is over a period when inflation was relatively low and stable. So going forward, it might not be the same case. So that's something for us to discuss. Last thing I wanted to mention is central banks and our role. There are a lot of questions that will be important for us going forward. One is the transition might have an effect on R star. We can come back to that. The other thing Signe also mentioned, climate change is likely to hit mainly energy prices and food prices. Volatility in those prices are not easy for central banks to handle. Typical supply shocks, we tended to see them as transitory. We might not be able to see them as transitory going forward. And I think the role of central banks, it's not at all to drive climate policy because we don't have the best tools, but we should do research. And I'm a little bit sad because for many years now, it's been so many people saying that there's a risk of mission creep, but that scare of mission creep have been so strong that quite a lot of people have been scared of doing research, even within the central bank community, even on things that are important to us, like the macro developments, inflation. And I really hope that that can change going forward. So we can do research, we can contribute in that sense. The other one, you also mentioned it, is actually look at our own asset holdings. There are lots of different ways at the Riksbank. We're doing it from a risk management perspective. So we're not saying in any way that we're trying to actively do climate policy, but with a lot of assets on our balance sheets, we have to consider risks on our balance sheets. That's clearly in the law, and therefore we can do certain things. We have worked a lot with transparency. We've also said that we exclude, for example, buying corporate bonds where we don't have clear disclosure, so we can't really know the risks. And then finally, we do work as central banks in a lot of international organizations. So we have the NGFS, we can pool resources to do research, exactly like the NGFS is doing. And we're also in a lot of standard setting bodies towards financial markets, like Financial Stability Board, Basel Committee. That's a good fora for international cooperation, I think. So I think that's really the role of central banks in the transition.
Thank you so much, Anna, for making my role as a moderator so easy, because you kind of given us like a lot of very important topics, and we will come back to them. We will discuss, you know, this idea of relative price adjustment and how do you deal with an upward carbon price path when you have to forecast your inflation path, for example, whether that matters given the current macroeconomic environment and the high level of inflation. That's a very good topic, I think. The tools, so you take a risk management approach, but that may not be the case for everyone else. And the role also of climate on R star, which is also a very important topic. And with that, and we will, you know, follow up on that. And with that, I'm now turning to Megan to tell us about the Bank of England and the view on all these issues.
Yeah, thanks so much. And thanks also for me to the organizers for inviting me here to speak. We decided I would have the highest stool because I'm the only non-Scandinavian on the panel, and consequently a lot shorter than everyone else. Look, I thought I would talk about climate change with respect to monetary policy because it's a much harder argument to make, actually. Everyone kind of understands the financial risk side of climate change. Everyone's pretty comfortable talking about that. But when it comes to what it means for monetary policy, it's a lot less clear. So I thought I would focus on that. I would agree that central banks aren't in the driving seat. We can't really fix climate change, but it affects what we do so much that we need to understand it. And actually, we know a lot, but there's a lot that we don't really understand, in part because it depends so much on choreography, how long we dither before we really address this, whether we use sticks or carrots, what the impact on R star is. So there's a lot of work that we really need to do. I guess I'd start off by saying that the macro impacts are possibly huge, but the biggest impact really is that this amounts to a pretty significant supply shock. So I just plucked a few statistics out. There were thousands I could have chosen from, but Mark Carney has pointed out that over the course of this century, climate change could just wipe out growth for the equivalent of 10 years. That's pretty significant. The IEA says it to be on track for 1.5 degrees of warming, and we're already pretty close to that. Global investment has to rise from about 2.5% of global GDP a couple of years ago to around 4.5% of global GDP by 2030. So to your point, we're going to have to mobilize huge amounts of funding and capital in order to actually achieve this investment. As I mentioned, the specifics of how this plays out in the economy really depends on the choreography and whether we use sticks or carrots or a bit of both. And that's still pretty much up in the air. But fundamentally, as Anna's highlighted, this really amounts to us deciding that we're going to put a price on carbon, which we had previously considered to be free. And so that is an adverse supply shock. Jean Pisani-Ferry has suggested it might be a supply shock of the magnitude of the 1970s oil price shocks. Although, that happened really quickly. This will happen over the course of a number of years. So it could be huge. And on top of that, I'd highlight we're also likely to face other possible adverse supply shocks if we continue to have movements towards deglobalization. If we have additional pandemics, then we may have a series of successive supply shocks on top of this. And as Anna pointed out, central banks tend to think of supply shocks as transitory and try to look through them. But actually, if we do that in the face of these supply shocks, then inflation expectations are likely to be de-anchored. So we need to approach them differently than we have in the past. The second point I want to make is that climate change could really affect the monetary transmission mechanism for central banks. And I'll highlight this happens at a time when most major central banks are already starting to question whether the monetary transmission mechanism is working the same way that it used to, or if things may have changed given a pandemic and a war. Monetary policy mostly works through the impact of interest rates on aggregate demand. And there are a bunch of channels through which it does this. You've got exchange rates, you've got expectations, market rates, asset prices. And I think that climate change could really affect the latter too. With respect to market interest rates, we could see the risk premium rise. What we've seen is that uncertainty about fiscal policy often increases inflation volatility, and that could increase the risk premium. We've also seen that climate disasters tend to cause households to hoard savings, and so that could also affect the market interest rate change, whatever central banks are doing. And also what we know is that uncertainty tends to cause firms to delay investment. In the UK, the agents have been reporting that actually a bunch of investment has been delayed because of uncertainty around the environment generally, and also around policy. When it comes to the asset price channel, you could have a sharp repricing of assets if you've got a major climate disaster. And that affects the collateral that households and firms have for borrowing. It also could hit bank balance sheets, and so could affect lending as well. And so the two of the transmission mechanisms that central banks rely on might not operate the same way that we tend to think that they do. And then finally, I'll just finish by talking about R star. R star should shift. We just don't know exactly how, because there are some factors related to climate change that will push it up and some factors that will push it down. And we're just not sure which ones will overwhelm the others. And I'm not going to guess here, but just to lay out some of the arguments for you, if we have a huge amount of investment in green technology, which seems necessary, that should boost productivity, that should push R star up. There are really big upfront costs to these kinds of investments, so we might see public debt also rise. That means there's less household wealth to finance corporate investment, and so that should also push R star up. But on the other hand, R star has some factors pushing it down. Higher risk premium, as I've already mentioned, pushes R star down. If households hoard more wealth in the face of uncertainty, that exacerbates the global savings glut that we have. That could push R star down. And then finally, climate disasters can hit productivity growth, either because people can't work or supply chains are scuppered, or it could happen indirectly in that firms have to divert what might have otherwise been productivity enhancing investments in favor of climate abatement. And so that could push R star down too. And given that R star, in theory, at least, is kind of a useful tool for central banks to figure out how restrictive or not policy might be, that will certainly affect what central banks are doing forward. I'll leave my comments there.
Thank you very much, Megan. So thanks a lot for diving into the R star debate that was starting to be outlined by Signe and Anna as well. So maybe we kind of push it a little bit more here. So yes, so that's a mysterious object that tends to be quite at the center of focal attention for central bank for monetary policy. So we do have the usual, secular trends, which some people are still debating exactly between the productivity slowdown, the demographic forces, etc. And on top of that, now we have these two kind of opposing forces that were outlined by Megan. So we have the uncertainty, but we also have a potential investments, and we have also military investment, which is a kind of new thing that we have to add to the mix. And we may be also underestimating the depreciation of the existing capital stock. If we do have very severe climate issues, and so how do you weigh all that? I mean, how do you see this? I mean, do you tell me? So whoever wants to jump in.
I can be very brief because I see it exactly like you do. We simply don't know. And we're following very closely any information that comes in, any way of allowing us to assess in which direction we're heading. And then we have a sharp focus on when we're assessing how tight monetary policy is, we're looking at what markets expect. So we do have measures of R star that are based on market expectations. They currently tend a little bit upwards. But so that gives some information about what other people see
about R star. Yeah. Okay. Very good. So there's a big margin of error in the R star.
Yes.
Anna, you want to add something? Or?
No, yeah. I think Megan summarized the whole literature, and you added to that with all the other things going on at the same time that we have to consider. As a policymaker, we are always making decisions under a lot of uncertainty. And for many years, people thought that R star was probably higher than it turned out to be. So central banks were signaling that, okay, rates are low now, but soon they're going to start going back up. And I think as a policymaker, you have to take some sort of risk perspective on this when we move forward. What is the risks of signaling that we'll soon be cutting or soon be continue to raise rates, and knowing that a lot of people are expecting R stars to potentially be trending upward? We don't know. But in my own thinking, I'm thinking that, okay, say that we are reversing that trend now, then I have to think about that when I think about what we think in the longer term might be more normal. So for that reason, I think we have to be cautious, evaluate all these facts, do a lot of research, but do a risk-based approach to what we are signaling in terms of forward guidance right now. For me, it's speaking to rates likely to be higher for a bit longer than some households are expecting right now. But very open for the fact that we have to constantly evaluate and then adjust if that's not the case.
Very interesting. So I think there's a lot of papers to be written on this. I see that you want to interject. Okay, so let's hear from Linda.
So a follow-up question. With all the demand shifts, supply shifts, relative price adjustments, and some upward price pressures that will be part of this transition, what's your view on 2% inflation target being too low?
I can start. I don't think 2% inflation target is too low at all. I think that low and stable inflation has served us well. I think it will be more challenging. I think the key challenge will not be to keep inflation at a low level. I think we will get back to around 2, but I'm concerned about the volatility around too. We've been, for past 30 years, we've had, if you look at the volatility since inflation targeting was introduced compared to the 70s and 80s, it's quite remarkable how low and stable inflation has been. And I think these supply shocks will cause volatility. Yeah. And that is problematic given that, you know, we set policy and then it will take a while before we see the results. But just to remind about the supply shocks and what we just lived through, as I mentioned, we've had 5%, not quite 5%, but almost 5% increase in energy prices over the past 30 years per year. The supply shock we had now, the pandemic, post-pandemic effects in combination with the war, energy prices peaked over 40% in annual terms in 1 year. That has an effect on inflation. So we have to see the size of the different shocks. And I think we will get much more research out of this episode to guide us going forward.
Yeah, I would just add to that on the volatility point that a lot of it is also driven by policy uncertainty. And so it's not our job to set policy. Central banks aren't the best actors to set policy, but insofar as all the actors in the economy aren't sure what the policy is going forward, the more inflation volatility I think there might be. And so I agree there probably will be volatility around our 2% target. I guess I'd also say that to go from 10 to 5% inflation was always going to be easier than going from 5 to 2% inflation. That doesn't mean that a 2% inflation target is inappropriate, though. I think it's the right target.
But if I may add a tiny bit to this type of question. So it was very interesting what you said about, you know, the price of carbon, the tax, carbon tax in Sweden having been so high and increasing, and the Swedish economy managing with that and with a 5% increase on many years. So that means a lot of relative price change. Yes. And this is something that somehow the Swedish economy structure could accommodate. But do we think it's a general feature? So do we think if we really project the carbon price increase of the type that Sweden has done, in other countries, this relative price adjustment will, will go through without too much problems? Is it something when, thinking about future inflation path, you think about it, this change in relative price and how you're going to accommodate it in the economy?
So yeah. Let me just say that I really hope that this is going to be a problem that we will have to face, so that these carbon prices are coming in and will affect prices. And then it's very difficult to say, but it raises a very important issue for central banks, and that is to know. I think that one of the recommendations we have made around carbon taxation is to make it very clear from the outset how it's going to increase going forward, so that we know both for investment horizons where it is, but also so that we can adjust expectations, because it's all about expectations. If we can explain very clearly what's going to happen, it's going to be a lot easier to manage in terms of inflation expectations.
Very good. Well, we see some backlash in terms of carbon pricing, so yeah, that's an important juncture to be making these points, I think, absolutely. On the, so I will take some, sorry, I would just like to have one more topic and then we kind of open up. On this issue of the tools of central banks. So there's the purchases of assets, there's the collateral policy. So should we be using these tools, kind of buying only some type of green assets as opposed to brown assets? Should we adjust the collateral policy with, again, according to the color of the assets? How should we think about these tools? Should we use them or not?
I think we can all answer from our perspectives as central banks. It's very hard to give a general answer to that, because it depends on how the central bank and how the portfolio looks from a central bank perspective, and also mandates and many other things. So for us, we have a very large portfolio, which reflects the fact that we have an exchange rate peg. We don't have an inflation target, so I didn't have to address the 2% because we don't have that. We have a large portfolio. It's all invested in foreign currency, and the main goal of that is to ensure that we have liquidity and that we have safety, so that it's always ready to use in case we need to use it for defending the peg. And given that, we have a little bit of wiggle room. It's very small, but we do have some. And how we look at this question is that, first of all, if climate reflects risk, if there's any risk we need to have that reflected. And that is from the safety and even liquidity perspective. So it's important for us to also adjust it according to risk. Now, there's a very small part of our portfolio for which this is relevant. And for that part, we are taking that risk perspective into account. And then we have a second part, which is that we are, as I mentioned in the beginning, we are a part of Denmark. We are a party to the Paris Agreement. We do have certain goals, and we are a central bank. We do not want to be in direct opposition to agreements that our government has signed off on. That means that we also aim to be Paris aligned in our investment. And when I say aim to, that's very important, because it's very difficult to know whether we are and whether we can be or not, but we aim to do that. And the part of our portfolio where that makes, where we can actually use that, and that is mainly our relatively small corporate bond ETFs and stock ETFs. We have made sure that those are, for all practical purposes, what we can assess, we have made sure that those are Paris aligned. And that's our first step. We want to look at our entire portfolio, but most of it is really short-term money market placements, government bonds, where it's still very, very difficult even to measure these things. But I think that we're slowly moving in that direction.
Thank you. So other institutions may want to jump in.
Do you want me to start?
Sure, go ahead.
Yeah. No, but I think we have to divide it into, I mean, there's the balance sheets of different central banks looks rather different. In our case, we have the monetary policy portfolio. We have government bonds, covered bonds. We have some municipality bonds, and a small share is corporate bonds that we bought during the pandemic. And what we have said is that this is the monetary policy portfolio. We do take risks into consideration always. For example, when we bought, now the corporate bond portfolio is being reduced quite, we are not actively selling, but we're not reinvesting anything. So what's happening here is that we put certain limits. We say we don't buy corporate bonds longer than 5 years maturity. It has to be investment grade, and we need to see whether we can assess climate risks, so whether they are actually reporting. And we're also being transparent in terms of saying that we're measuring the carbon emissions related to our corporate bond holdings. But it's monetary policy, so these kind of portfolios will go up and down over time. So we don't think that that's climate policy, it's risk management. Then we have the foreign exchange reserves. And there, the new law that came into effect as of January 1st says that we should take into consideration risks, returns, but also sustainability. But that's mainly government bonds. So we've done some reallocation across some Canadian and Australian provinces. We have some of their bonds just to reduce the average carbon footprint. And then we're also measuring the carbon footprint. So we're being transparent again. Mm-hmm. But these are small things. These are not really climate policies. This is, again, long-term looking and being transparent about what we have on our balance sheet.
Excellent. So,
yeah, sure. The Bank of England was a front runner in greening some of its asset holdings. But, the Bank of England is shrinking its balance sheet actively now. And so while, the Bank of England was greening its asset purchases in part because of risk management, I think also, as Christine Lagarde has been quite open about, if you really want to have market neutrality, you sort of have to start greening your portfolio. So that's a factor as well. But given that we're shrinking our balance sheet actively, that means that we're not reinvesting. And so we're doing less of that overall, just in terms of sheer volumes. Inflation is our primary target. And secondary to that, provided we hit our inflation targets, we can pursue the government's goals, which includes sustainability. So, we've been shrinking our balance sheet because it made sense from an inflation targeting perspective, but it also has knock-on effects for greening the portfolio.
Very good. So I think we had some questions that wanted.
So a couple of points that relate to what you guys said, and maybe you can comment on this. So the first one is about carbon taxes and the impact they have on relative prices. So Sweden has started transitioning to a more sustainable energy mix a while ago, and this is not the case of most countries on the planet. And when you apply carbon tax to a country that doesn't have an energy mix which has dirty and green, having a carbon tax is just inflationary. I mean, it's like if I told my kids, I'm going to cut your allowance if you don't eat apples, and they try to eat apples, but I'm not buying them. And so, that's just going to make their purchasing power lower, and it's going to be a conflict, a social conflict, because, people are just going to see. So these also apply to greening portfolio because, bank reserves are large and there aren't enough green bonds, or maybe there aren't enough really green bonds out there. So, again, these are all, wishful thinking, but the truth of the matter is that it's very complicated to implement these policies without being inflationary. And so, your reaction to this, I think a synchrony between, goals and, the reality of things. The other thing is there's this paper, and I think it's go back to what Linda was saying, and she must, of course, know the paper by Marco Del Negro. Marco was visiting the Riksbank just a couple of days ago with Di Giovanni and Cogra, and they basically, it's a February 2023, and they do a two-sector New Keynesian model where they ask whether, green transitions are inflationary and what should central bank do about it, and they say, yes, they are. That doesn't mean central bank has to renounce to the target, but it creates an additional trade-off. And that trade-off would depend on, the flexibility of prices in the dirty and green sectors, and also whether there's carbon taxes or subsidies that work trying to correct equilibrium. And so in that sense, I do actually think that rethinking the inflation target, I mean, why do we have 2%? Because they're quality bias, that kind of, we need to have some grease in the machine. I see sustainability as a quality improvement to products and services. So one could argue that, making goods not just, more tasty, which is a quality development, but also sustainable adds to quality. And if that's expensive in the time and horizon of transition, it might be legitimate for central banks to temporarily increase their targets. Now, whether this is feasible or not and acceptable socially, I don't know. So I just want your reactions on these 2 points.
Okay, so who wants to react to this? So Ivor or
But I can comment, because I think it's important. And also, if you look at the research, it doesn't matter how you use the revenues from the carbon taxation. So there will always be some people who are hurt and some people who benefit. And the role of parliaments are to redistribute it in a way that you get social acceptance for these kind of policies. And also, like the other paper showed, if you combine carbon taxation with certain types of subsidies, you're likely to get more investment. It can be smoother. The other thing is to do things gradually over time, to not start very fast. Because I think that is one, I actually don't think that, of course, it can be, as you say, inflation in certain sectors, but it doesn't have to cause overall inflation to go up. And I don't believe in increasing inflation targets temporarily, not at all. How would you re-anchor that kind of policy? I don't believe in that. I actually think that when you have a transition, our role will be to ensure price stability, and that will benefit the transition. And then you have to have parliaments who do redistribution, which is very complicated politically. But that would be the first best option, and that unfortunately seldom happens.
Signe, yeah?
Yeah, I also just want to mention that in any carbon tax would have to be part of a broader tax reform that would take into account these inequality sides, because otherwise it won't fly. And probably, I mean, that's already difficult in itself. And just on your point on bond portfolios, we don't have enough green bonds. That's very true. So there are two, when we say we would like to go toward having more green portfolios, in our case, it's really about risk and safety and credit. And so it's not that we don't see ourselves at all going toward a green bond portfolio. There's no way we can do that and ensure our mandate. But what we want to do is be able to measure risk and have that properly reflected. And there is that is just a question of how do we do that? And I wanted to add that there is a big question out there in how we measure the greenness of government bonds, because we do have some measures. We have central banks are now measuring that, and we're actually putting that information out. We're certainly not acting upon that information because there are so many caveats and problems with those measures that they're not useful yet. But moving in that direction of becoming more useful and having good measures of the greenness of government bonds will be very helpful going forward.
So on these measurement issues, so I assume that there's a lot of data or that you would love to have and that you don't have. So any particular, wishes on, for example, what would be the most useful, you think, in terms of disclosure, so that we currently don't have, or any data sources that you would find very, very relevant, and that currently you just have to make guesses, or is it, would you need to have more time to think about this type of issues? I mean, I'm thinking that we don't even have very well harmonized data on carbon emissions so far, right? So it seems like it's the first order object, and we don't have essentially certified, audited, homogenized measures on carbon emission, especially scope 3, obviously. So this type of data which are missing, I assume, are kind of a big issue, because you talk about, greenness of government bonds, but, what's the underlying data that we can use for this type of
It would certainly help the taxonomy issue if we had actual data underpinning what counts as green versus a little bit green versus not green at all. So yeah, that kind of harmonized data would be really important. In the absence of that, I think we've all tried to come up with taxonomies which are imperfect, but are better than nothing.
Right. I mean, I think that's where we are, but indeed, I think that may be like a call for something that would be very, very socially valuable, no? To have a bit more on this, yes.
I think it's an impossible question to answer because, and exactly for what you said, that there's so much that we still don't know, and we need a lot of data to be able to measure risks. We need a lot of data. And scope 3 was the first thing I thought of that would be nice to have. But there's so much data that we need. And what I say is that we have more regulation in place for disclosure. And it's a lot of work for banks. Those are the ones that we hear from. But I think companies also tell us this is really difficult to implement. It creates a lot of work. What we usually respond to, and also we also told that often it makes no sense what they're asked to do and deliver. And the usual response is that we simply have to start somewhere because we need to start collecting all this data. And maybe it's not the right approach to begin with, but it is going to be useful in any case. We'll develop that because data is the first piece of information. That's what we need in order to be able to move ahead with risk pricing.
Absolutely.
But then also, I mean, this approach has to be the only one we can take because it's so easy. You have all this new, it's actually quite a lot of things happening in terms of standardization right now. And it's going to be so easy to criticize it. And you can do tons of research studies and show a lot of, fallacies with these different kind of methods, but it's the only way forward. And then you just have to review it and make it better over time. It's the same thing with inflation data. We've been measuring that for years and you can still criticize it and look at different measures. But you still have to do it, and then you have to be aware of those weaknesses and then try to improve over time. And it's really the only way forward. Measuring things is rather powerful.
Absolutely.
So,
No, that's why I think, we tend to, underestimate in some sense these issues, but measurement is the first.
Yeah. And then, of course, then you have to focus a bit extra on the industries that are heavy polluters because it tends to be easier. Steel industry, cement, these kind of things. I mean, getting to scope 3 is a goal, but in the shorter run, you can actually get better measurements of those things that are relatively easy to measure.
Okay. So I'm opening up for any other question here from the room, because I have plenty more, but I don't want to monopolize the, the topics here. Okay. So we have a lot of shy people around here. No, Monica.
I think this is already a fascinating discussion, and I wanted to bring up a worry that I had during or since the onset of the war in Ukraine. We sort of saw many national governments rush to protect their citizens against price increases in energy, And to me, it made me worry that we're not in this predictable path towards more higher energy prices, but in fact, we're doing erratic things. Maybe it's erratic around a predictable increase, and I hope that's where we are on, but I wonder whether how you have updated your thoughts about this.
Yeah, indeed, it has been pretty, universal, this kind of shielding the consumer type of policies, which, is understandable, but indeed affects the price dynamics in various ways and the expected price dynamics. So is it something you have kind of thought about? Or yeah, Signe.
I'd say that we of course had a very we were very focused on advising. So we have in Denmark we have a role also on advising on fiscal policy. That's quite unusual for central banks, but that's because we have an exchange rate peg. And so if we have a dynamic in the Danish economy that is different from what is being decided by what we see in the Eurozone, then we have to handle it with fiscal policy. And so that's why we have also a say on that. And during the strong increases in prices on energy, we were advising on the government not to shield the consumer directly and broadly. So we had the same advice as the fund, for instance, that we would have targeted temporary relief for households that would be having a hard time bearing this, but that overall that we should leave prices and the price mechanism work. And by and large, in Denmark, the politicians followed that. And there's been a lot of different responses across the globe and even within Europe. But by and large, consumers in Denmark were exposed to the prices that we saw. And so we had inflation going up very quickly. We also had inflation coming down more quickly than average. And I would say one very strong lesson from that is it was incredible to watch the response of the consumers. And it just reinforced my view of how carbon pricing would work without commenting more on the fiscal policy response of other countries.
Can I also signal something? So what we've seen is that we also had pass-through to consumers directly on the energy prices. And then we had energy compensation after the fact. So the full pass-through onto consumers, and we saw that electricity usage went down, but then it also stayed down. So even now when electricity prices are back down, we've seen less usage than normal. Do you see the same? I'm not certain that will continue though, because now electricity prices are really quite low again, but do you see the same effect?
Yes, I don't know where we are now, but it really sensitized the Danish consumer to energy prices. And everybody knows, including me, we all know where to go in on the internet and know what is the energy price, what is the electricity price right now? And do I charge my car now or tonight? And when do we put on the wash? Everybody knows that, and no one knew that a year ago. And it stayed when prices came down. It stayed for a while. I haven't checked up whether it's still the fact, but my sense is that would be the case because we all still look at these prices and we time our activity to that, which is fantastic to see.
Yeah, it's fantastic.
That's how
new habits.
Yeah,
it's we don't know if they're going to last. So that's the issue. Yeah, indeed. Unless we do expect this price.
But pricing really works. Pricing really works here.
Yeah, absolutely. No, that's and this brings me to another question, unless somebody wants to, which is what do we learn? So in the past, we have had, as you said, it's very hard to learn from the past because we have this completely new phenomena, but we did have, so first of all, in the 70s, we did have an energy price shock too, in fact. So what can we learn, if anything, from that? And second, in the, after the 2008 crisis, we did have a lot of change in terms of risk management, in terms of financial regulation for banks, etc. So what can we learn from these past experiences for the current situation, if anything, or should we just, start from complete scratch and think this is completely different? Any lessons? Yes.
Yeah, I'll weigh in. I think the biggest difference between the 80s and today is that we already had the 80s today. And I think we have learned a lot from that. In particular, I think the lesson of the balance of risks around stop-start monetary policy. So the notion that it's better to lean against demand and inflation now than to not do so and have to do even more in the future risking, a big recession as we had in the 1980s. That's a lesson that has certainly been learned, and I think an important one.
Okay, how about the risk management thing? Yes.
Can I
Yeah.
just
Oh, yes,
continue?
yes.
Continue on that one, and that was, I think it's also really interesting to watch these two different energy price shocks that we had in the 70s, and then we just had one now, and then that teaches us something about how the propagation of energy price shocks has changed because of the transition that we already are going through. So we were much more oil price based in the 70s. We are much more relying on electricity today, and a lot of the electricity is produced with renewables. And the renewables are much less stable in the sense that they are dependent on the weather, on sun and on wind. And that was it was not just the shutting off of natural gas from Russia last year that caused that price spike, but we also had these weather-related events that we had a perfect storm that affected prices on energy. And I think that's one of the lessons going forward, is that those are the types of shocks that we will have more of. We will have a different, we will have more energy price shocks that will be on electricity and related to renewables, and they will probably propagate differently through the economy because of this.
Very good. So in terms of this risk management business, to go back to that, so is there anything you can see? So I know it's not directly, related to monetary policy, but we also have these macroprudential policies potentially now, right? A lot of these macroprudential authorities having some overlap with central banks. Sometimes the governor sitting on them. Sometimes it depends on the countries. But do you see there any kind of specific role for these macroprudential policies when we think about this climate risk? Or do you think that we should just apply, the strict risk management type of ideas that we apply for any kind of risk? Any views on this? Or
are you thinking about things like green and brown penalties on capital requirements?
Things like that.
Yeah,
that would be an example of a specific policy which would go a little bit beyond the, pure risk management type of views, and that of course ties in transition risk as well versus physical risk. I don't know if it's something that you have thought about. Or
I think that it's really important that we look at climate risks going forward as potentially systemic and large. And lessons that we've learned is that this very clear focus in regulation on the types of risks that banks are exposed to, and trying to measure them, quantify, and make sure that they hold enough capital and that they have liquidity, that's been very successful. We do stand a much better place with banks in terms of robustness than we did before the global financial crisis. And if going forward, climate-related shocks and risks are going to be much bigger in bank balance sheets, that should be also a focus of that. But going from there to having specific green, brown, and macroprudential, that's a step I will not take at this moment. I wouldn't rule out that at some point in the future that's going to be relevant. But at the moment, I think it's much more important that we get the data and we quantify the risks. That's the main challenge at the moment.
Right. First order of business then.
Yes.
All right. So I think we're close to the end. So if there's any time for one more question from the audience, or if not, I'm just going to ask you very briefly if you want to tell anything you would like these talented young researchers to especially work on related to climate that would be useful for you, or any kind of message you want to give to the next generation of these economists here who are very concerned about these issues. Please go ahead.
I think I highlighted a lot of things we don't know in terms of how every actor in the economy will respond to different policies, different motivations. So there's a ton of opportunity to do research in these areas. I look forward to seeing what you guys produce.
Good.
I always have a favorite, I think that one of the most important things to understand is the political economy around carbon taxation and around getting the transition policies in place. It's because it needs to go fast. and we're not seeing that. And it's not because we don't know what to do. It's for political economy reasons. And so research in that area will be very fruitful.
Yeah, I can add that one of the things that I find fascinating and scary is that even I'm not talking about the policies now, but also the physical risk of climate change is likely to hit energy prices and food prices. And we know that households, when they form their inflation expectations, it tends to be very much energy and food. It tends to be the things that are salient to them, the things that they buy often. And I'd like to see, we know there's a lot we need to learn about inflation expectations. We have not had enough research. Inflation has been low and stable. Do we get more volatility? Hits a lot of supply shocks. Getting more research to understand and learning from the episode we're currently in, when we get a lot of variation in inflation expectations right now across households and firms and markets. I'd really like to see more research on that. It's really important to us as policymakers going forward and be able to keep inflation low and stable, because I still think that's really good for society with low and stable inflation.
Thank you so much. Well, I would first like to thank very much also the Riksbank for hosting us.
It's been a pure
absolutely
pleasure. Thank you.
fantastic. And yes, and you know, that's amazing. And second, I would like to thank really this panel who has been super. I think you would agree. I mean, we have learned huge amounts, and they have been willing to be very candid with us. And so thank you so much for all that. There's a picture.